Good morning, Realty Texas. How are you all doing? I know we're not going to be a quiet class today. We're going to be loud. We're going to be boisterous. We're going to be all the things. Good morning, Mary Beth. Good morning, Tina. Good morning, Kelly.
Good morning.
Kyle. Gavin.
Good morning.
Good morning.
Ooh, this is going to be a fun group. Good morning, Meg, Renee. All the favorite hits. Good morning, Miguel. Miguel is looks like downtown San Francisco at the moment with his new screensaver. Okay. We are going into a 4-day GRI series. This is Monday, Tuesday, Thursday, Friday. We're going to be popping in at 9 o'clock. We're going to be taking half-hour lunch so that we can get out of here on time. We're going to take lunch at 12:30. So write that down from 12:30 to 1. We have to go over some class rules. First, this is going to be for Trek credit. And if you raise your hand if you intend to get Trek credit for this GRI. Okay, excellent. So put CE like Aki did somewhere and like Kelly did so that we can see your screen. Lots of people will be popping in just to take the information and not be getting credit. But remember, Trek wants us to have a copy of this class stay saved for a year and can go back and audit it at any time. And they're going to be looking to make sure that all of the participants that are getting credit are participating, what they have their videos on. And what is the big thing that we cannot do in a Trek class? Does anybody know? Ooh, Tina's got it. We cannot be driving. But that's only part of the story. What's the other part of the story, Tina?
Your camera has to be on.
Well, yes, that is true. The other part of the story about the vehicle.
You cannot be in a car.
That's right. So you were driving on the driver's side, Tina. I just wanted to make sure that everyone understood. It's all the other seats as well. We can't be in a vehicle and take a class for credit. They want someone at a desk with a manual in front of them and prepared to take a class, not in the passenger seat of a car coming in and out of Wi-Fi, in a car. They just don't want that, so they've made that quite clear to us instructors. And if the instructors, if we don't facilitate the class correctly, they can take away our ability to continue teaching the classes, and we don't want that. GRI designation stands for the Graduate Realtor Institute. This is the National Association of Realtors designation, one of the most highly recognized designations at NAR. And this is a 90-hour designation. Raise your hand if you are in your first 2 years. Welcome. So the reason you're taking this class probably is because of your 90 hours. But there are other people here that are outside their 90 hours and probably were licensed at a time where we didn't even have an apprenticeship program yet, and taking it for the designation. So regardless of why you're here, I'm glad that you're here. This is going to be a very fun day for us to fun week for us to all spend together. I just want the 90-hour kids, though, I like to call you kids, that you must take this class plus 2 others. And at the end of the year, I'm teaching the 30-hour brokerage class. And if you're going to be taking that class, the 90 hours from the SAE requirement, 30 of the 90 has to be in brokerage. And if your license is renewing before I teach brokerage, GRI is not the only option. But hear this. If you take brokerage outside of GRI, you're gonna have to take my class or take the GRI brokerage in order to get the designation. I mean, I know a couple of you, at least 2 of you, one is taking Aceable and one is taking a Champions brokerage because their license are renewing before I teach the brokerage class. And I think I teach it in October. It's on the calendar though. Okay, so that's basically the class rules. Today is finance. I imagine for a lot of you that when you were getting your pre-license, that Some of you, finance probably wasn't your favorite class. Raise your hand if finance wasn't your favorite class when you were getting your real estate license. And that's okay. I totally get it. Um, the good, the bad, and the ugly about finance is the good is that we need to understand the finance part of it because it's 90% of what we're doing. The bad is that sometimes it's a lot of numbers, and a lot of numbers people can get number anxiety even before we get into it. But even the better news is there's not going to be any of that today. We're not going to be in numbers paralysis today. We're going to be talking about pre-qualification and underwriting and all of the nuts and bolts of what we do as a real estate agent as part of getting our clients pre-qualified. And that's helpful, and hopefully it will relieve some anxiety because I think they would have been better off instead of calling this finance. I think they should have just called it lending because that would have been a lot less anxiety filled for a lot of students. So I don't want to get caught up in anything to do with what your preconceived notions of finance is. So let's take a cleansing breath and put that out of our spirits and talk about pre-qualification and pre-approval and all of those things that we are dealing with on a daily basis because I think especially right now with the rates going down and all of the confusion in the market, knowing how to pre-qualify a buyer and getting them with the lender as early as possible is really going to help because there's a lot of buyers out there who think they can't qualify and they can. How many of you heard in the last 48 hours, 72 hours that the rates have gone down? Okay. So is that a good message or a bad message to put out there in the world? It's positive. So hopefully you guys are blogging about that, posting about that, because the thing is the buyers have heard that the rates are high for a really long time, and they need to hear that we're in the fives. And the news is not going to tell them good news. The news is only going to tell them bad news. They've proven that to be the case. And so we get to share the good news. And so hopefully you guys will come to Miguel's class, which is our Blast Lab. How many of you have been attending our Blast Lab? How many of you know about the Blast Lab? Okay, cool. So at 2 o'clock every day, Miguel Katie has a blast lab, and the goal of the blast lab is to get marketing pieces out. And so I think that this is a perfect topic for that. Would someone read the learning objectives here on page 2? Would you raise your hand so I can call on you? Thank you, Meg.
Perfect. Upon completion of this course, you should be able to identify different lending information you may need to gather for your buyer and seller, recognize the tenets of lending, how lenders evaluate prospective loans, examine types, advantages, disadvantages of third-party financing, compare the features of different loan products, describe loan processes, explain general lending terms, mortgage documents, and closing costs. Choose the correct financing options in the sales contract and use the appropriate addenda, and know RESPA requirements and identify discrepancies.
Well, that all sounds like time well spent to me. That's exactly what we should be focusing our time on, exactly this list. And I'm glad that we are because this is very timely. Thank you, Meg. Also, not a bad day to be sitting out on the back porch with 75-degree weather, hanging outside. Nice, very nice. So I'm gonna put you guys in a breakout session here early on, get our bloods pumping, get some camaraderie going within the group. Your goal here is to come up with a list of what you need to know in order to be able to invoke a sense of professional competence with you and the buyer. What does the buyer need to have? Um, what do you need to know about the buyer in order to qualify them? What documents, what pieces of information, what good questions should you ask? That is what this exercise is going to be about. So I'm going to put you guys into 3 groups. Please pick a spokesperson like we always do and come up with a list. What do you need to know or inquire about the buyer? And what do you need to know and inquire about the seller? 2 different lists. And remember, when you represent a seller, there are things that you might need to know about that buyer that maybe the buyer agent themselves are not even hyper focused on right now. So come up with a really good list, share it with the class. I'm going to put you guys in here for 8 minutes. Okay. All right, you should have your breakout rooms open. I'll see you back in 8 minutes. Okay, welcome back from your breakout session, everyone. When the rates go down, affordability goes up, and we're seeing that happen right now in an affordability crisis that we have going on in this major metros that we have. Definitely the time to start sharing that wonderful information that things are getting a little bit less expensive for the buyers. All right, group one is Candy, Kyle, Maribeth, and Tina. Who is the group spokesperson for group one?
That would be me.
Hello, Maribeth.
Hello, Jack.
Mhm.
Okay, so we talked about we want to know if they're pre-qualified, and then we talked about the difference between pre-qualified or pre-approved and the difference in that. And the reason that that's important is because sometimes people get a quote pre-approval letter and they may or may not have actually been underwritten. So they may say they qualify, but the lender didn't actually check their bank statements, know what they have as far as down payment money and closing cost money, or verified with their lender if it's full W-2 income, or is it some other kind of income, as in like a bonus that actually doesn't get count because the underwriter might disqualify it for some reason later on. So they really didn't qualify for that much. So it's important to know that whether you're representing the buyer or on the seller side, because you want to be sure that, obviously our common goal is to get across the closing table.
Mhm.
So, and, knowing the timeline that when you're representing a buyer, then you want to know for sure, well, what is their timeline? That if they're qualified, well, then are they qualified right now, or is there a timeline? Because sometimes a lender may say, yes, but you need 2 or 3 or 4 months, but people jump the gun and they start looking, then they maybe neglect to tell us as, the buyer rep that, oh yeah, well, my lender said that I really can't do this until blah, 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 for whatever reason. So it's important to understand a timeline of, like, for example, if they're tied to a lease and then they don't qualify because they can't afford to make a house payment and a lease to finish out that lease. And if they break the lease, then it's going to affect their credit, which would again affect their interest rate and what they actually qualify for. So
Yeah. Good, excellent. And what about sellers?
well, we kind of talked about both of those because the seller, one of the examples that I gave was that I had a seller and we had multiple offers, and we had 3 different people, but one on the third party financing was 9.25. So when I called the lender and questioned about that and just said, is it because of income to debt ratio? And obviously some lenders will tell you more than others, but in the conversation I was able to ask, well, is the fact that this house in a floodplain going to affect their income to debt ratio and how much they qualify for? And she said, well, why? And I said, well, because it's in a floodplain. So they're going to have flood insurance on top of regular insurance. And she was like, oh, well, that could be a problem. Well, the lender didn't know that piece. So their buyer didn't communicate with the lender. But then as the selling agent, I did. But then I was able to take that back to my seller when I presented the 3 offers and was able to give information about each and every, because I had called and talked to the lenders about which one I felt like was more likely to get across the closing table.
Wonderful. Thank you, Maribeth. Thank you, group one. Who is our group's breakout session in group two? Kelly, Meg, Alina, and Rosemary.
That would be me.
Hey, Kelly.
Hello. We said for the buyers, we said it's important to know what their motivation is for moving. Are they downsizing? Are they trying to get into a better school district, etc.? Are they ready, willing, and able? And that goes back to the financing. Obviously, you want to know what they're looking for: neighborhood, area, school district. We said desired monthly payment. That could help you kind of hone in on a price point for them if they're trying to get a certain payment per month. Are they looking for new construction or resale? And must-haves, like if they need to have a big backyard or they need to have an office space, those kind of things. And we had the timeline and financial information as well, but those were kind of the ones that group one didn't mention. With the seller, we said same thing. You need to know their reason for moving. Are they having to sell this home first so they can buy? And do they need help finding that next house? We are going to ask about the neighborhood, HOA, anything special about their home, any repairs that they might know about that they might want to do in advance of putting it on the market. How much might they be willing to help a buyer's concessions, given the market that we're in? Any liens on the property, any warranties that might need to be transferred. And like I said, do they need help buying their next house?
Okay, thank you, group two. All right, so our group three, what did you guys come up with? And then we're gonna go through a list because I've got a half a dozen things that I added to my list from over the weekend that I haven't heard yet. So there's still a lot of things floating out there. So let's fill in the blanks, group three. What do we got?
So for buyers, we need to ask them um, maybe their credit score, their debt to income ratio, their income, and what they can afford as far as down payment, cash for closing costs, and then we need to know time frame, their job situation, if they've been in their job for long enough, if it's salary, maybe the 6 months, or if it's independent contractor, 2 years. And we need to know what financing options they have, maybe if they're first-time home buyers, or maybe they're a veteran, they can do VA. What kind of loan are they doing? FHA, conventional,
Okay, veteran
or,
is an
or
important
maybe
one.
investment. And then what they can afford. You want to know their price range.
Mhm.
That's taken into account all of those other factors, their
Not
motivation and what they're looking for.
Not to exceed price is an important one, so I'm checking these off as I go. All right, good. There's a couple of others. What about when you're talking about representing a seller and an offer comes in, what do you need to know about that buyer's creditworthiness? Uh, what do you need to know to enable to advise your seller of that buyer?
As far as the buyer's creditworthiness,
Yeah, so you get an offer and they're getting financing. What are you going to explore to be able to tell the seller what you've learned about the buyer's creditworthiness in their position?
whether they've maybe owned a home before and their consistent payments with either a rental or maybe their credit history, their history.
Well, okay. All right. Thank you, group three. All right. So let's work together. So if you're meeting a buyer, do you think it's a good idea to ask them if they're going to be paying cash or obtaining financing? Out the gate, probably the very first question. And if they say I'm obtaining financing, what I find interesting is there's a line in this book that says that ask them, how's your credit? And it says that people typically do not lie when people ask them, how's your credit? They usually give straightforward information when people ask them that question. I found that very interesting as well. So, are you going to be obtaining a loan or are you going to be obtaining financing? Yeah, I'm financing. Great. What's your credit situation? It's excellent. Excellent. Okay, great. Reason I ask is because I've got some really good lenders. Some of them specialize in A plus credit and some of them specialize in credit repair. So I just want to know which direction we're going there. So that's good. That'll make things easier for you. Simple, just very, very simple. Not judgy, not judgmental. It's not off-putting. It's just gathering information. So do you think that knowing what down payment assistance programs out there are going to help you open some doors? Last week on Thursday or Friday, I'm not sure which, I asked my staff about a week and a half ago to put together a group of agents that were going to take this down payment assistance from T-Shack. And I guess we dominated that class because half the company was there. Or rather, half the people in the class were from our company, is what I meant to say. But in any event, it was a very eye-opening because there are just so many down payment assistance programs and grants available for buyers right now, and knowing those pieces of information is great substance for conversations at an open house when someone says, "Yeah," or a tenant you're speaking with them, "I just don't have the money to buy a house." Sometimes it's actually cheaper to buy a home than rent a home. And I think if you've done leasing, you realize that that's the case because first months and plus deposit, plus pet deposit, plus application fee, and you put all that together and in purchasing a home, maybe they can get up to 6% up closing costs paid for by the seller and a down payment assistance program. And the earnest money goes back in their pocket and then up buying a home and they're 20 bucks out of pocket. I mean, that can happen. And so there are certain situations, especially for people who are in the lower incomes or available to have special programs to be able to get those down payment assistance programs, which are forgiven if they live in the home for a certain amount of time. Another question I think that's really important is knowing a little bit about what's going on with the rates, knowing what rate locks are about, the difference between in-house underwriting and outsourcing underwriting for a lender and how that can impact the lender. And we're going to talk about that in the class today. I like that you guys brought up new and resale. I like that you talked about what a comfortable payment would be because we can begin to reverse engineer that into a purchase price. I love that Mary Beth said, are you under a current lease? Because that's important because that's going to help us understand at what point it makes sense for us to be in the housing market and looking. Because as Mary Beth said, you start the process too soon or you start a process when you don't currently have them qualified and they don't have any buying power and they fall in love with a home and then they can't buy that home, they're going to be disappointed, and you're going to start off their home search on the wrong foot. Because regardless of what you think the reality is going to be, once they fall in love with a home and they can't buy it, every other home that they've come in contact with, they're going to be remembering that other property, and it's just going to make the entire process less fun. Now, on the seller side, we missed some stuff here, and I know we have a lot of agents who jump into the business as a buyer agent, and so we don't have the experience on the listing side. But if I'm a listing agent and I'm representing my seller and I get an offer, first question I want to know is it financing or is it cash? It's financing. How much down payment are they putting down? Do they have that amount of money? Do they have that much cash to actually put down? And then I want to know what the credit worthiness is. Do they have a pre-qualification or a level of a pre-approval? And several of you spoke about that, including Mary Beth, of the difference between the two. But then pick up the phone and call the lender and have a conversation with the lender. And later in the day, after lunch, we're going to be going through the third-party financing a little bit. And you're going to see in paragraph 6 of the third-party financing agreement that you have the right to pick up and call the lender because it states in the third-party financing very clearly that you have the right to call the lender directly, and the buyer signs it, giving you the authorization to speak to their lender. Under paragraph 5, buyer authorizes buyer's lender to furnish to the seller or buyer or their representatives information related to the status of the approval for the financing. So you have the ability to talk to that lender about their credit worthiness. But as Maribeth said, they're going to share with you what they're going to share with you. But most of the time, the lender is going to try to tell you everything that you need to know to be able to counsel your seller and make them feel comfortable about the contingency that the buyer is asking the seller to grant them. And a financing, a right for the buyer to terminate a contract is simply a buyer contingency. And there's a lot of those contingencies. They've got tons of contingencies, but the financing is just one of them. So we're going to get into some of the stuff that might seem enigmatic from a real estate agent perspective, but we're going to talk about title versus lien. In Texas, there are some states that are title states where a home is granted a title, but that's not Texas. We get a title on a car, but we don't get a title on a house. We get a deed on a house. And that deed is a three party instrument. And I think one of the most easiest ways to explain this is a deed has a borrower, someone who's borrowing the money, a lender, somebody who is forking up the cash, and a third party that who's going to be the person who files the nasty foreclosure in the event that the buyer doesn't pay. And it's that third party that makes the whole system go round. Because if the lender, the person who was forking over the cash, had to actually go and collect it themselves, they would never lend in the first place. The whole system would not work. So having this third party then gives the lender some assurances. I can hand over my cash, and then I'm going to make a return on this cash, and I can be a silent investor in this deal, and somebody else is going to be the bad guy that's going to take this property back, and I don't have to worry about it because oftentimes the lender doesn't have the heart to go and foreclose on a single mom and her 3 kids situation, right? So they don't have anything to do with that. It's all hard coded in the deed. It's a promissory note. And the reason they call it a promissory note is because the buyer says, I promise to repay. And if I don't, this third party is going to go take the property back. And they're the ones that file the foreclosure notice. So it actually becomes very simple when you just remember that a lien is filed against a property and the lien has a promissory note. And the promissory note basically says that the buyer signs that they're going to promise to repay it. Lender promises to fork over the cash at closing. And then the third party is paid to service the loan. And, at the end of the day, this is the original foundation of what has allowed our society to not be a rental society. Because at the turn of the century, we were very much a tenant society. We were not deeply ingrained in home ownership because we couldn't afford home ownership. And that's what this next paragraph and couple pages are going to go over. Is we started with being a nation of renters. And it wasn't until FHA was born, 1934, Congress created FHA, and they created it to be able to allow lenders, the same lender that we just talked about before, to be able to lend their money and have some assurances that they're not going to lose their money. Because at the time prior to FHA, you needed to have 50% down or more to be able to buy a home. And that's a lot of money. People didn't have that much cash. They just didn't. So the federal government thought, wait a minute, maybe we could have an insurance program that would guarantee that the difference between the low down payment, maybe 3% down, the difference between 3% down and 20% down, that they would insure that difference. And so that's when FHA was born. There was no way for non-cash buyers or non-cash heavy buyers to be a homeowner. So FHA came up, and it's interesting because the 20% margin that they want you to put down is because that's how much it takes to foreclose and be able to take the property back and get it in a condition to resell it. And so if a lender lends out 300,000, the buyer put down 60 ish, then if the lender takes that property back and the buyer didn't put down any down payment, then the lender is going to be out all kinds of money because they're going to have to pay all these third parties, or those third parties are going to get paid to take the property back. So that 20% margin is what gives the lender some assurances that I can lend over this money and it'll be protected. But also the money isn't lent over a short period of time. You're talking about 15, 30 years. So it's a very slow repayment of this huge investment. And so that means that it needs to be low risk and high return. And that's exactly what these kind of loans are. So we had in 1934 Congress create the Federal Housing Administration, FHA, offering low down payment, long-term mortgages. And as I said, prior to 1934, when FHA was founded, most Americans could not afford prevalent lending terms of 50% down and in short 5-year repayment periods. It just wasn't a thing. So the creation of an agency to purchase the mortgage notes came next, which is Fannie Mae and Freddie Mac. So you probably heard this term before, primary and secondary markets. How many of you heard the primary and secondary markets and you heard those terms? Who's a little foggy on what the secondary market is? Okay, so we need to, thank you. We need to understand this because it's actually pretty simple. When a lender, like one of our preferred lenders, when they get involved in a transaction, they are going to have an underwriter, and that underwriter is going to go through the file to make sure that as much as possible that that loan conforms to all the underwriting guidelines necessary to make that form what's called conforming. That the buyer's FICO score was in order, that they verified the tax returns, that they verified their income, they verified all the rules, and there's a long list. in order for that to be what they call conforming loan, because there are investors out there who want to make money from these notes. So if you have a $300,000 loan and it's 6%, the interest is going to be more than $300,000. It's going to be about $340,000, whereas the repayment of the original principal was $300,000. So over 30 years, you've got $340,000 or $640,000 repayment on a $300,000 home. Those loans are very valuable. So what happens is a lender will fork over their money and the loan is funded. And sometimes these lenders, they don't have a lot of cash and they don't have buckets of cash that last forever, for sure. So now they've lent this money. So now they can take it and say, okay, I'm going to lend this money in a short term. And now it conforms. And maybe the value of this loan is $300,000 over the next 30 years. I'm going to sell it to a third party. And they sell it. And that person then sells it to a third party, and that third party services the loans and starts collecting the interest over the 30 years. So the lender, they may have taken the loan and used their money to fund the loan. We're going to talk about different types of lenders in a minute, but they may have used their money to fund the loan and then they sell it and then they'll make a spread of 1 to 2%. So a lender will have an underwriting fee, maybe 1% on a $300,000 loan. They're going to get a $3,000 paycheck for closing that loan. And then after it's funded, then as long as it's conforming, they're going to sell this loan on the secondary market to somebody else, and they're going to usually give them 1.5 to 2%, somewhere between $3,000 and $6,000 after closing. That loan originator, that company, is going to get paid again. And so real estate agents very often get 3%, and lenders usually get 1% as an origination charge, and then another 1 to 2% for closing the loan. So real estate agents per transaction make more than the loan originator. They make more than the lenders do. And so that secondary market is just simply selling it to a third party. But the third party is not going to want to buy that loan if it doesn't conform to a set of rules and if it's not insured. And that's what's great about Fannie and Freddie Mac is they are simply an insurance company. An insurance company that ensures that when the buyer buys it, that if the homeowner who has a mortgage, this three-party instrument against it with a promissory note, that if they break their promise and they begin to foreclose, that the lender is going to have an insurance company that's going to give them their 80%. It's pretty much assured, but also the difference, they're going to, whatever their losses are, they're going to get repaid up to 20%. And so they're protected. Lenders don't want it back. That's 100%. That's not what they're there to do. And so when these people buy them on the secondary market, they usually have some third-party company that is a loan servicer. And there's lots of loan services for companies out there, and one of you could become a purchaser of loans. Win the Powerball and have 800 million, decide that you're going to spend 500 million on loans, spend $300 million on that, and hire Chase to be your loan servicer. Certainly possible. So that's all that secondary market means. They're institutions that buy loans, and they make money from the spread. Okay, now let's talk about the different kind of lenders. First, we're going to get really in the weeds here, but we have fiduciary lenders, semi-fiduciary lenders, mortgage brokers, non-fiduciary portfolio lenders. We're going to talk about what the differences of these types of lenders are, because you've probably at some point heard loan officer, mortgage banker, broker, and you've heard all these different terms from these different lenders, and maybe even one of them, one of our lenders recently opened his own brokerage, and I think understanding the differences is helpful from a real estate agent's perspective so that we can help understand from when our clients ask those questions, what are the differences between all these things? So let's start with the difference between fiduciary and semi-fiduciary. A fiduciary lender is one that they lend depositor funds. Think of a credit union. So they are a bank and they take money in from people who open a bank account and they lend that money out, which means they have a fiduciary relationship with that depositor to safeguard their money. And so they're lending out other people's money and they have to be faithful to the bank account funds that they have. So they call them fiduciary lenders because they're lending out other people's money. And some lenders lend out their own money. And some lenders actually will borrow money from a third party, and now they have the liability of repayment, and then they lend out that money, which puts them in a different class altogether. But when you go and deposit money at the bank, you have some assurances that the bank is going to safeguard your funds. It's why you have CDs. Put money in a CD and they tell you, well, you need to not take that money out for 6 months because they're going to lend that money out. And so they're good and they understand, they're good at playing the money game. They know how to make investments that's going to have a return. And their job is to make sure that these are as low risk as possible, both for themselves and for the lender. So because the depositor's funds have terms for repayment that include both floating rates and short-term fixed interest rates with CD terms that rarely exceed 5 years, fiduciary lenders tend to eschew fixed rates for longer than 5 years. Most banks lend at prime, which means they usually lend out less, and they're going to loan the money out for higher, and then that's how they're going to make money on a spread. So this is fiduciary, 100% fiduciary, or they're caretakers of funds from their depositors. Number one, think of a credit union or a bank. Number two is semi-fiduciary lenders. These are people who lend someone's money, maybe not a depositor, but someone's. For instance, a lot of life insurance companies, Guardian Life, Mass Mutual, Northwestern Mutual, companies like that who have these really large mutual funds, life insurance. They are lending out other people's money, but it's not like depositors' money. And so they are not caretakers of depositor funds, but they are caretakers of other people's money nonetheless. And so they're considered a semi-fiduciary lender. They are responsible to the company owners and regulators, as well as those companies and fiduciaries they represent, but not to consumers directly for returning money that they lend to others. Examples of fiduciary lenders would be mortgage bankers, originators, and real estate investment trusts like mutual life insurance companies. So the money that people are giving them, they don't have to safeguard that, but it's not their money, nonetheless. Um, so they are called a semi-fiduciary lender. Now, here we get into, most of you and most of your clients aren't going to a bank. They're usually not going to a credit union to get a loan. They're usually not going to Chase or a credit union. They're going to a loan originator. So now this is going to become a little bit more relevant into what we do every day, which is the loan originators, the mortgage bankers. Now there's different types of these guys. We have mortgage bankers and mortgage brokers. And then we have what's called non-fiduciary portfolio lenders. It's important to understand the difference of these three because this is what we deal with on a daily basis. A mortgage banker, someone like Legacy Mutual, most lenders that you have, mortgage bankers are companies created to lend money from their funds in their name with the intent to sell the loan into the secondary market. This is a company with high liquidity. They got a lot of cash, but you bring a client to them and they're going to do what's called table fund. Now, different lenders handle this different ways. If you are a mortgage broker, you might borrow the money from somebody. So let's use an example for a client. Candy, can you use an example? Candy has a client, and she brings that client to, let's just say Ginger, our in-house lender. Now, Ginger, based on what company Ginger works for, whether she works for a company or opens her own, she's going to go about that transaction in different ways based on the construct of her company. She's going to either qualify this buyer and then right before closing, because maybe Ginger's company doesn't have liquidity, they don't have a lot of cash, then they go to a third party company and they borrow money. So Candy's client's going to buy a $500,000 home, and her client's going to put down $100,000 cash, and they're going to get a loan for 400,000. And Ginger's company in this situation doesn't have 400,000. So they go to the open market and they borrow $400,000 on a short-term rate, and that's where the rate lock comes in because they're already paying for that money. They already borrowed the money because they're getting close to closing, so they have to borrow that money. They bring it in-house. They're already paying for that money, and then they're going to send that money to the title company, and then that it's going to fund the loan. So they borrowed the money to give to the title company to close the transaction. So now the lender is minus $400,000, which is why their underwriter is working so hard to go down the line to make sure that every single guideline matches, because if it's not conforming, they can't sell that loan on the secondary market and get their $400,000 back. And they're going to sell it for more. They're going to sell it for $408,000. So then they get $408,000, and then they take $402,000 and pay back the third party company because the money that they're borrowing is very inexpensive. And so that's how they make their money. That is what you would call a mortgage broker, but this particular one is. Ginger does have the money in this situation. Her company, lots of liquidity. So in this situation, Candy's client is going to fund a $400,000 loan. The lender sends $400,000 to the title company, and it's their own money. When it's their own money, there are less regulations involved because they're not borrowing it from somebody else. It's simply their own money. So their underwriting guidelines is completely up to them of what the rules are going to be. They can have less guidelines, they can have more guidelines. It's whatever they want to protect their own money. And then they sell that to the secondary market. Now, does anybody know what happens if they lend their own money? It funds, and then they sell it on the secondary market, and then a piece of information is turned out to be untrue, and they bought it. Do you know what the requirement is? Federally required that they buy it back, which means now they're stuck with that asset and they never had the money in the first place. So the liability for them is very, very high because they have to buy the entire loan back. And if they buy it back, it could put them out of business. One or two loans could put them out of business because now they're stuck with servicing that loan for the next 30 years. And maybe selling it to a higher risk third party, maybe losing a lot of money, or just what they call portfolio it, which means that they're going to manage it for the next 30 years. So there is some liability there. Or, which also could happen, they fund the loan and then realize that the underwriter made a mistake and it's not a sellable loan and they can't sell it at all and they're stuck with it, which means they don't have the money to repay the third party, which again could be it could be devastating for their business. So again, the banker, mortgage banker, they are lending the money from their funds in their name with the intent to sell the loans into the secondary market. So short term, borrowing lots of money with small margins, but over time, it makes a lot of sense. Versus the mortgage brokers, they are kind of far away from the funds lent because they actually don't lend any money at all. They could be somebody who puts together and puts together a chain of people, and they are a go-between. And we have a lot of lenders like this. They'll have an investor that says, "Hey," and they nudge them. "I've got somebody here that's got a conforming loan. Would you like to buy it?" And they say, "Sure. Uh, tell me the details. Here's all the details. I might be interested in buying it." And then go to the buyer. "Okay, are you interested in this?" "Yes." And then they put a deal together and they broker it. And so they didn't borrow the money. They didn't do anything other than broker a deal. And that's why they call it a broker, because they literally brokered the transaction, but they don't fund anything at all, because they actually do not lend any money at all. When an institution brokers the funds, that institution acts as a go-between, and its responsibility is to the company owners. They have a fiduciary to their owner, but they're not good stewards of anybody's money because they broker it. Now let's talk about non-fiduciary portfolio lenders, because this one I think is the most interesting. There are what we used to call kind of like a hard money loan, but not necessarily. They don't have any responsibility to anybody at all. This would be you if you decided to jump into the world of lending, um, because they're going to buy the loan themselves. They're going to use their money and they're going to get a return. They're going to, if they lend out 300,000, the expectation over 30 years that they're going to get their principal back of 300 and they're going to have a profit of 340, so they're going to get a repayment of 640,000, which is why on an amortization schedule that the repayment of interest is 90% interest on the front end heavy, because there is a very good likelihood that they're going to refinance it in a couple of years. And if it's always this mixed bag of 50-50 principal to interest, investors are not going to be interested in that, because they want to make sure that, that they're going to get as much interest from this as possible. So the principal of the loan is not going down very much. So that if they sell the loan to a third party, there's still quite a bit of equity there. And so in the front end, it's interest heavy, specifically to recoup the lenders from this outlay that they had to get them to profitability or break even faster, so that they can start receiving a profit from this, from lending out the money in the beginning, which is where our three-party instrument comes in. When a buyer buys a home and they obtain a loan, this is where the promissory note comes in. That the buyer promises to repay, and if they don't repay it, then we have lien theory. And the lien theory is where it all starts making sense, because it shows who is going to get their money first. And when you have a foreclosure lien order, the lien is a promise to repay if the home is sold. So if the home sells, they have to repay the loan, and the full balance, if any money is left over, goes to any second liens and subsequent liens, so that the first lien holder, the primary lien holder, has some assurances that they're the ones that are going to get paid. So they can review the documents and say, okay, if this thing gets taken back, I'm going to get my paid first. So then there's my assurances. So then it becomes, the most important question is this house sufficient collateral for my loan in the first place? And what are the chances of this borrower actually going into foreclosure? So we're not going to finish we're going to finish the conversation on the lenders before we go on to the next one. But there's a lot of crossover between these different types of lenders, whether they're a broker, whether they're borrowing money from a third party to fund a loan, or whether they're lending their own money. All of those is a good conversation to understand who it is that you're working with, so that you understand what that lender is going to be up against. Now, lenders have to be licensed no matter what they're doing. So if they're lending their own money, or if they're lending somebody else's, they still have to be licensed, which is what the SAFE Act is all about. The SAFE Act is designed and is the TREX version, or the SAFE Act is the sort of the Real Estate License Act version of for lenders, and they're also licensed. So the Secure and Fair Enforcement for Mortgage License Act, the SAFE Act, places minimum license requirements and stipulations on all mortgage loan originators. So when they're called an originator, they're all called originators. But some of them will have a different class of originator, just like we're all agents, but you might have a broker license kind of thing. And it requires state agencies to participate in the NMLS system. Raise your hand if you've heard of NMLS. Okay, NMLS is a very important thing for an agent to know. It's the National Mortgage Licensing System. It's national. So if you go to any of the signatures or business cards or brochures of a lender, they're required to have their NMLS number on the documents. And you can use that number and go to NMLS, and you can do a search for them, and it will tell you what company they work for, who the branch manager is, if they've had any complaints, what their foreclosure rate is, and then also a history of all of the different places that they've been in the past, and whether or not their license is currently active or not. So this is a way for us to be able to learn a little bit information about who it is that we're working with. Now, there's some exemptions to the SAFE Act because it says that everyone is required when they're doing any kind of lending. And guess what? A home, uh, seller financing falls under the SAFE Act. So if a seller is doing a lot of seller financing, they can fall into the SAFE Act. But there's some exemptions because if someone does one seller financing, then they're not going to fall into the rule. So there's a threshold. So on page 7, would someone read these 5 bullet points, the exemptions to the SAFE Act? Or raise your hand if you would be willing to read. It's these bullet points here. Thank you, Candy.
Okay, exemptions. Sellers can finance their own primary residence without being licensed as an RMLO. If the property is the seller's homestead, or if the seller is extending financing to a family member, then the seller is exempt from obtaining the RMLO license. Sellers can finance up to 5 transactions in a 12-month period and maintain their exemption. Sellers do not need to be licensed to finance commercial real estate or unimproved property unless the property is being sold to build a 1 to 4 family residence.
So developers that are going to be lending out, they need to have RMLO. People who are seller financing a lot of transactions are going to need to be get their residential mortgage loan originator's license. So in Texas, the requirements are similar to ours. Education requirements, submit fingerprints, background check, pay the fees, take the exam. They must also demonstrate some level of creditworthiness themselves. So they're also going to be looking at their own finances, make sure that, all of their taxes have been filed and they don't have any liens or judgments against them, that sort of thing. The Texas Department of Savings and Mortgage Lending is their version of TREC. So the Texas Department of Savings and Mortgage Lending website, that is who regulates all of these lenders in the state of Texas. And I think a lot of agents think it's Texas Department of Insurance. They think TDI somehow is the ones that are responsible for the lenders, and it's not. TDI is Texas Department of Insurance. That would be title companies and any third-party insurers. But the lenders, it's the what they call the SML, the Savings and Mortgage Lending. It's the sml.texas website. And in fact, it's right here, sml.texas.gov website. And so a complaint against the lender would literally go there. So in terms of giving out referrals, as it says down here at the bottom, because I know a lot of you think that, somewhere in the law it says that you must provide 3 or more. And that has never been a thing. That's never been a law. It's a good rule of thumb. It's a good practice, and you should provide your client multiple different referrals in order to lessen your risk yourself and your brokerage risk, but it's not a law. So as it says here, as a realtor, there's no requirement for you to recommend any particular number of lenders. Remember that you must always disclose any relationship with a third-party lender upfront, but it's wise for us to recommend a reputable lender that we have a history with, that we can know a little bit about their style, and if we think that they're going to be a good match for this specific client. Now, some builders, they have their own in-house lenders, and I know that that might frustrate real estate agents sometimes because they feel like that this in-house lender from the builder is somehow treating the buyer unfairly because they have their own incentives that they're giving. And some agents feel like that the builder themselves, if they're going to give an incentive, that they should give an incentive carte blanche. That if they're going to offer an incentive, they should give it to the buyer who's using their lender or using any third-party lender. But that's not the case. And when you really dig in and understand how all this works, it starts making more and more sense of the builder is going to have a certain income stream from doing the loan, an origination charge, and other things. And so they're able to discount all of that because they're able to discount their income and have assurances that the buyers are actually qualified and have some assurances that they're working with a reputable lender And it makes sense for them because imagine if you're a builder and you're working with 25 different lenders to close transactions, it makes things a heck of a lot easier if you're working with your own internal lender. So there's never an obligation to use their lender, but if you want the incentive that they're providing to go along with that lender, then you should use that builder. So we introduce our client to, well, one of the first questions we should ask our client is, are you going to be buying new construction or resale? If they say new construction, learn a little bit about what it is that they're looking for, and get them out there and show them some properties. You may have a relationship with a lender and let them know, hey, these guys are going to be going new construction, but they would like a pre-qualification letter. The builder's lender most likely is not going to pay attention to the pre-qualification letter that you have from a third party. They're going to want them at the time of contract to get pre-qualified through their own lender anyway. So if it turns out that the buyer buys new construction or resale, the lender that they use might differ between those two, or it might not. All right, it's 10:05. We're going to jump on our first break, come back, and we're going to pick up the conversation with talking about specific loans. And we're going to start talking about conventional loans. I'll see you back at 10:15. It's 10:15. We are jumping into chapter 2. We're going to go over conventional loans. We're going to talk about government loans in chapter 3, what FHA and VA. But first, chapter 2 is all about conventional loans. And there are obviously big differences between government-backed loans and conventional loans. So starting here, page 10 in your book. So there's two general categories of loans: government loans, FHA and VA, and conventional non-government loans. When we talk about lending, the three tenets, this is a test question, the three tenets and fundamental tenets of lending is the buyer's willingness, their ability, and their collateral. And someone's willingness is not how much they promise, but rather what is the history of what they have done in the past. So how they gauge someone's willingness is one of my very favorite font lines of all time. Is the very best predictor of future behavior is past behavior, and they're going to look back to the credit to measure their history. So to measure history or willingness, there must be adequate lines of credit, usually at least 3 lines of credit, and at least a year or 2 of borrowing and repayment history. The fewer lines and less history, the more heavy and more weighted every piece of derogatory information on their credit report comes from. And so their willingness has a lot to do with their FICO score, but not just their FICO score, because their FICO score includes things other than just their repayment history. So they're going to look at the credit report and they're going to look at every single line that's on their credit report to determine what is their repayment history like. And that is how they weight the willingness. And then someone's ability. And so it really has to do with their ability, which is income, their job, the security of their job. If their job is unstable or seasonal, then it really doesn't matter how much they earn because it's not stable. So they're looking at stable income. So part of the guidelines that they're looking at is the stability of the income and what kind of income. And what I mean by that, and we're going to talk about this later as well, is it tips? Is the income bonus? Is the income overtime? Are they self-employed versus W-2? What type of income? Because all of this matters, because if somebody over the last 6 months worked 80 hours a week and made a whole lot of money on overtime, then is that overtime for this person? Is that their norm? So they're going to look at the last 2 years. How much overtime does this person work on average? Because if that's just a one-off, then they're not going to include the overtime as part of their calculation for their ability, which could then affect what they would be qualified for. So the income and the expectancy of the income would produce the strong ability. So the ability together with the willingness helps assure the lender that this borrower will repay the loan. The third thing is collateral. And when you think collateral, we're thinking willingness, ability, and collateral. And collateral, you might first think, well, their bank account, a car? What's collateral? And in this instance, it's the property is the collateral. So the big question becomes, is this property sufficient collateral for the loan? And they're going to lend heavily on the appraisal to determine whether or not the property is, what in their mind, what would be considered um, collateral, sufficient collateral. So once both willingness and the ability are established, the lender must be able to sell the underlying collateral or the property to repay the original debt in the event of default. So the collateral can never be overlooked. But in the beginning of today, we talked about the difference between a pre-qualification letter and a pre-approval letter. A pre-qualification letter can be created based on someone's ability and their willingness, because we have all of those pieces of information, but you can't really do a so once they send them all the way through underwriting and they look at their ability together with their willingness, then they can approve the buyer, what's called buyer approval. And so if a lender just simply runs someone's credit and looks to see if they have, how much income do you have? I make 4,000 a month. I make 8,000 a month. I make 100,000 a month. Whatever the borrower makes, the lender's going to write that down. Then they are going to pull their credit, maybe even a soft pull, figure out what their FICO score is, and generate a pre-qualification letter from that. But there's a lot of details that are missing. And the difference between a pre-qualification letter and pre-approval is a pre-approval, they're going to submit that buyer to underwriting. And the underwriting is going to do what's called a subject to. We conditionally approve this buyer subject to you finding a property, and then we're going to approve the property. So that's why the pre-qualification letter, no, the third-party financing has buyer approval and property approval on it, because it's rooted in how the lenders move forward through a transaction in lending. They have to approve the buyer, separately approve the property. So in order for a pre-approval, which is a conditional approval, they have to run the buyer through underwriting. And the underwriter is going to ask all the questions they would if the whole thing were being ran together with the property. Give me the tax returns. Give me the bank statements. Give me the credit card statements. Oh, I see all these deposits here. What are they? And we need to make sure that these deposits are sourced and source the funds and letters of explanation and all the things that come out the other side. And the lender says, okay, we have approved the buyer. Now all we need is a property. That way, on the third party financing, you can even tell the seller that the buyer's already been approved. In effect, the contingency that the buyer is asking for a little bit differently, and we'll get to that later. Okay, so collateral, this is all to do with the actual property. The collateral can never be overlooked, nor can the valuation of the collateral at the inception of the loan. If we are not being truthful or fair in our ability to determine the sufficient collateral for the loan and the actual collateral itself, the entire system that we have today would fail, which it did in 2008 when lenders were manipulating the appraised value of the home by going to the appraiser and saying, if you can't meet value on this one, I'm not going to use you anymore, and twisting their arm to make a change. So and then afterwards, if they didn't actually meet value, then say the retribution is going to be, we're not going to hire you anymore. So now the lender has to hire a company, and the company sends out an appraiser. That appraiser is licensed, and it's their job to provide their opinion, not the company's opinion, and nobody can alter that person's uh, numbers, and no one can talk to that person after the appraisal has come out. Before, lots of communication, but after, no one can talk to them again. So they don't have any fear of loss of business or retribution to create a fair system that is not tampered with by a lender and a agent who are both salespeople trying to ramrod a transaction through a lender, and creating maybe some dangerous loans out there that should never have been taken in the first place. Artificially inflated appraisals do not serve the best interest of the consumer or the community. Their property serves as the lender's only protection, and attempts to circumvent a sound appraisal undermines the core of lending to the detriment of everyone. This is why the appraisal is so critically important and why it is performed by an independent third party. That can't be an agent who happens to have gotten their appraisal license. It has to be a third party that is not the agent and that is not the lender. A third party that has no ties to this. They can't have any relation to the borrowers. They can't have any other fiduciary duties to the borrowers. So the agent and the lender both stand to gain from the sale. The transaction must be arm's length so that no party has an influence on the appraisal in the transaction. If the appraisal is unrealistically inflated and the buyer defaults for whatever reason, the lender is left exposed. Or whoever is holding that note, by the way. And that most likely is not the originator, it's whoever bought that loan. Now we're going to talk about conforming loans. And that is what every loan mortgage banker or mortgage officer, they are borrowing money from a third party or lending their own money, and they're trying to sell this loan on the open market as into this what we call the secondary market. So they're going to originate the loan and then they're going to sell it, and they're going to make money from selling that loan. So it must be conforming, because if it's not conforming, then they can't sell it and they have to what's called portfolio it, as we talked about before, and they're stuck with that loan for the next 30 years. And again, that could be a end game event for a lender. Conventional loans are often sold to GSEs as well. And this is the government sponsored entities. This is a GSE, which is your Fannie and Freddie, same thing. So whether it's an FHA loan or a conventional loan, they're both sold in the secondary market. So they both have to conform. It's just that the conventional loans don't have FHA insurance because the buyer put 20% down. So it's not a different type of loan, and people buy FHA loans not conventional. It's that the FHA loan is offering an insurance to insure whoever's going to buy this loan. The difference between the small, tiny down payment that the buyer did, 0 down or 3% down or 5% down, that difference between the 20%. And so really it's when you look at what the secondary market is, they're buying all loans and they assume all of them have 20% equity. But if they don't, then they're looking for an insurance policy to make sure that that 20% equity is either insured or it's already there based on the buyer having skin in the game. So conventional loans are often sold to the GSEs, government-sponsored entities, Fannie and Freddie, and when they are called conforming because they conform to the agency guidelines. They are often packaged together and sold in pools. Maybe they'll take 100 loans and they'll sell an entire 100 loan pool. And the lenders who are buying them they feel secure because they know that the underwriter and the lender had to do their job to make sure that every single one of them is conforming. And if it's not, they got to buy it back. So it makes some assurances that the people who have or that are writing the check for the secondary market continue to buy them, because if the confidence is lost in the secondary market, we're going to have a real problem. We're going to have a real problem. And that's why it is so important that we don't lose the CFPB, because the CFPB is the company that, at the end of the day, handles the primary the PMI. We're going to talk about the PMI in a moment. So, conforming loans. The Housing and Economic Recovery Act of 2008, which again, you probably realize that was called the Dodd-Frank Act, but they changed it, changed Fannie Mae's charter to expand the definition of a conforming loan. Affected with the November 2008 release of the conforming loan limits, there are two sets of limits are provided for first mortgages: the general conforming loan limits and high cost area conforming limits. There used to be this thing called jumbo loans, and conventional loans had no loan limit. So as long as the lender wanted to push the loan up to $1 million, they could, but that caused some issues in the financial crisis. So they had to figure out what is a fair loan limit in these different market areas to ensure that the insurers would have the liquidity to be able to fund these loans. And so that's where our loan limits came from, and every single municipality has them. You have first the first mortgage loan limits. You got a first and a second. Mary Beth.
So I have a question about that. Because obviously loan limits can be totally different in Texas versus California. So is it specific to areas
By county.
by county? Okay,
Yeah.
thanks.
Yeah. So if you go to the this right here, this link, Freddie Mac article news loan limits, you will see that they have it broken down by county. And a lot of the counties are the same, but you might get into it like a Travis County that might be different, or a Harris County, which might be different. So these inside mega cities that defy the rural areas. So knowing what the conforming limits are, and we're going to take a field trip and go and take a look at a few of them here in a little bit. So your first mortgage has a conforming limit. These amounts apply to all conventional mortgages that are delivered for the whole loan purchase or mortgage-backed securities, which is this whole secondary market thing. And then non-conforming loans. So we have conforming loans and non-conforming loans. When conventional loans do not conform to Fannie and Freddie's guidelines, they're called non-conforming. And there are some reasons maybe they're not conforming. The loan is too large. The property specific limitations, such as condos that have too many renters, which will be called non-warrantable. Because if they look at a condo regime and it's more than 50% tenant occupied, they'll make it non-warrantable, so it won't conform, which means they can't sell this loan in the secondary market. Low or no documentation for income, assets, or both. High loan to value, the combined loan, credit. Hold on, let me do a mute. There we go. Credit either by score or by itself. The scores are too low, or the legal status, such as visa status or non-human entity, meaning for a business who's taking out a loan. So here you go. So here's some reasons that a lender might fall into a situation where the loan is not conforming, and that's okay. They can do a non-conforming loan all they want. They just can't sell it, and they have to let that loan fully amortize over 30 years, and they're stuck with that money until they refinance it, sell it, or pay it off in full. And now here we come into the PMI thing, primary mortgage insurance. Sometimes people call it MI, mortgage insurance. Some people call it PMI, primary mortgage insurance, whatever you want to call it. There are a lot of people out there that think that MI is the spawn of Satan and wish that would go away. And the reality is that it's actually needed and very important, because without it, our system wouldn't work. As the mortgage markets developed in the latter half of the 20th century, companies were created to offer non-government insurance to allow borrowers to borrow from Fannie and Freddie with less than 20% down. So they created private mortgage insurance companies with these premiums that gave an inducement for lenders to exceed the 80% loan to value, meaning the lenders were comfortable lending money if the buyer was putting 20% down, because if they foreclosed, there was enough margin in there for them to be able to take the property back and sell it and not lose any money. But less than 20% down, they're just not comfortable. So somebody has to insure it. And it's Freddie and Fannie that do, but through this PMI program. So one reason why the CFPB is so essential is that without regulation, the PMI companies can do whatever they want. And CFPB have been regulating the PMI companies, because nothing stops the PMI companies because they're unregulated outside of CFPB. And this means that if a borrower becomes late on a mortgage, they could quadruple the PMI if they wanted to and increase that interest. What happens when you're driving your vehicle and you get in 4 accidents? Does your insurance stay the same? No, it goes up. So what happens if the buyer misses 4 payments? And then they recover, and then misses 2 payments and recover? Does the PMI go up? It doesn't, not currently. But the loss of CFPB, which is sort of in some gray areas right now, could destabilize the entire housing market by making homes no longer affordable to borrowers by changing their payment, and that means it would increase the foreclosure rate, thereby making the investors uncomfortable moving forward because now they're looking at the MI companies trying to figure out what are they going to do? Because if the borrower is showing some signs, maybe they're going to increase it because they want to recoup what they think is going to be a loss coming soon. The lender decides how much of the loan to insure, usually between 75% and 80%. They don't insure the entire loan. They insure the difference. PMI is applied to the entire loan, but they're taking out an insurance on the 80% or 75%. They're putting 5% down. Maybe they're only going to get 25%. So they're trying to figure out how much of an insurance they're going to get. So the PMI is levied on the entire loan amount. The premium for the PMI is calculated on a yearly basis, paid monthly. The premium is set by the mortgage insurance company and will vary with the down payment amount, the loan type, the credit, and the terms. So the private mortgage insurance companies are not owned by the agencies or the government-sponsored entities, but they are regulated by the CFPB, which enforce the provisions of the Homeowner Protection Act of 1998. Now, some laws were changed, the laws were passed to help eliminate the PMI. And there are a lot of things that can happen naturally to make PMI go away. So first, the Homeowners Protection Act of 1998 gives borrowers 3 avenues to eliminate PMI. Number one, there are 2 scenarios for the borrower to request that the lender or servicer drop the PMI. A, when the principal loan balance is first scheduled to reach 80%. So they're going to go to the amortization schedule. And if the amortization schedule says on year 6, they're going to have 80% LTV, then on year 6, they can go to the lender and drop the PMI. That is a request that can be made. B, when the principal balance of the loan actually reaches 80%, they can go to the lender. The market has had a faster appreciation. They can ask the lender to remove it, but they don't have to in this scenario, especially if we have hyper inflation. They can, if the like we had in like for instance in 2020 2021 when the home values doubled, a lot of the MI companies said no, we're not going to remove it. We're gonna wait because they didn't trust what had just happened in the market. And so, but in any event, they can order an appraisal and they can determine whether or not they're going to or not. But number 2, the act requires the lender to terminate PMI on the date when the principal balance is first scheduled to reach 78% of the original value. So buyers just having some flexibility in knowing when it can fall off. And then 3, if PMI was not terminated under the borrower request, cancellation or automatic termination of the act dictates that PMI coverage cannot be imposed beyond the midpoint of the original amortization period. So at some point, it's going to fall off on its own. And there are some exceptions on these conventional loans. Now, second liens, whole different scenario. A second lien is for someone who has really good credit usually. They don't usually allow a second lien on someone who has credit that is marginal. They've got special kind of loans, maybe a 80-20-10 or a 80-15-5. So for consumers with excellent credit, there are some lenders who will extend tandem or piggyback loans, which we call a second loan, often referred to by their numerical values, 80-10-10. In this case, it would be an 80% first, so they go get a regular mortgage. Then they're going to get a 10% second, so they're carrying back $200,000 property. They're going to borrow 180. They're going to have a second, which is $20,000, and then they're going to put 10% down. So that doesn't actually work because it's 80-10-10. So it would be 200,000 and then yeah 20 80 80-10-10 80% 10,000 and then 10,000. And in case of a $200,000 20,000 20,000. But again 80% equity for the first, 20% for the second, and then 80-20 80-10-10 80-15-5. So the last portion of this is always going to be the down payment, whether they are putting down 10%, whether they are putting down 5%, or like I said, the 80/20 loan where they're not putting down any at all, any at all. So in this case, the first is an 80% loan, the second is a 10% loan. The first is an 80% loan, the second is a 15% loan. Or they're borrowing 100%, they're getting an 80% first and a 20% second. Now, the reason that they do that is because maybe they've got their funds tied up, maybe they don't want to mess with the cash that they have, but they're able to pay this 20% off faster. And then that means that the first never had mortgage insurance, ever, because there was never mortgage insurance because it always had the LTV. Because this, if this forecloses, this gets paid off first. So the lender's like, I don't care if they have a second. The second is taking the risk, not us. So there's never going to be PMI on the first. So there's no mortgage insurance, which could save them $200-300 a month. And then this 20%, the borrower is going to have a higher interest rate, but that interest rate, they can throw larger amounts of cash at this, make it go away, and they will forever have a better first with a lower interest rate and never had insurance, never had mortgage insurance. So it could be a very powerful thing for a buyer. Okay, who has questions regarding the second loan, junior liens, the 80-15-5 or 80-20 or 80-10-10? Do we all understand that pretty well? Good. Because this is, I have, I've had situations where I've had A+ clients who wanted to not put money down and they were trying to figure it out. And this isn't something that the lenders will typically offer up as an option. And there's been situations where I've offered an 80-20 to my client, 80-20 meaning 80 first and getting a second for 20. And they take that and it actually get a deal done where it would have not gotten done before. So sometimes us, when we're getting a pre-qualification letter and we're having these extensive conversations with the clients, we learn stuff, then we can share our knowledge with the lender and say, hey, have you explored this idea? And let them go explore it, but at least be the idea generator, throwing some ideas in the ring to try to solve for X, whatever that X that you're trying to solve for is. How many of you have heard of a contract for deed? So this is what I like to call almost like having between a buyer and a seller without the third party instrument, without the promissory note attached, without a third party that's going to go and deal with the foreclosure. Now, that means that the lender is going to have a bigger role to play in that transaction in the event that it's going to foreclose. In the event of default, the seller simply repossesses the property from the buyer. There's not a separate security instrument. This could be a very clear seller financing. The seller is seller financing the property. It's a contract for deed. It's usually very simple, but the title is always vested with the seller, and they're not going to convey title until it's going to convey. So we don't see a lot of contract for deeds. We do for land though. A land contract. We see them quite often because there's not a lot of lenders that will offer a down payment, a fair loan for land because the the buyer on an owner occupied home is going to do a little extra work to try to make sure they don't foreclose on their primary residence and have the home ripped out from under their feet. But if it's a piece of land somewhere, maybe they're not going to work so hard to try to make sure that it doesn't foreclose. So you don't see a lot of zero down programs or 10% down or 3% down on land, other than VA. We're going to get into that in a moment. But in this situation, contract for deed for land, if you look back to the turn of the century before we had the savings and loans, before we had Freddie and Fannie, and before we had FHA, everyone had to put 50% down. Well, those programs were designed for owner occupancy, not non-owner occupancy. So that still exists in land because there's not a program for it the way we have the programs today for owner occupancy. So this whole concept of lien theory is important because the order in which the liens appear um, is very, very, very important on the deed because that's what the lender is going to agree to, and they're going to have their attorneys reviewing the lien order and the deed, and they're not going to agree to throw the money into the pot and fund a loan if they're not in what they call superior lien position, meaning above all the other liens. A senior lien is one that has the priority position for payment. So the lien order on the deed becomes very important. The deed of trust taken by the lender generally requires the first lien position, meaning that when the home goes to the foreclosure, that's what gets paid first. If there's any money left over, it goes to the subsequent liens. Any other lien must be subordinate to the first lien. Therefore, a junior lien is any lien that takes a secondary position to the senior lien. There can be more than one junior lien. You could have a whole bunch of junior liens. Some of them could be mortgage liens, second liens. Some of them could be an HOA lien. That's far down the list. Could be an IRS tax lien, could be child support lien. But all of these liens are going to get filed against the property and they'll have to get paid back. And at some point, when a home forecloses, the judicial foreclosure process says that whatever funds are raised from the judicial foreclosure sale, the money is going to first go to the lien order, and then whatever is truncated, um, they don't get paid. They just don't get any money because there's not enough. So the whole foreclosure process is about making sure that the home is sold at the courthouse, make sure that the money is brought in good funds, and then they use that money to pay off the liens in order. Now, short sales. A short sale, we have got a lot of experience with short sales. This is a situation where the lender, they are willing to accept less than what is owed. Candy.
I just wanted to ask real quick on the first and secondary loans or liens. How would that work with the piggyback loans? Is that which would be primary on that one?
So the piggyback loans, your 80-10-10s, 80-15-5, first is going to be the primary loan, which is the 80%, the primary mortgage, the one that's going to have the better rent, the one that's going to be conforming. And then the rest of them is just filed against the deed, and the buyer is taking more and more risk and has a higher repayment, or the lender is taking more risk and they do a higher interest rate. Your primary mortgage is always going to be first priority, always. And then the remainder of the liens are going to be in the order that they were filed most of the time. Okay, so short sales. I think all of you are probably familiar with the concept of a short sale. That someone has purchased a home and the current, if the home was sold in the open market today, the proceeds would be insufficient to pay off the first note, the first lien. Or it is, but there's second liens filed as well. Someone could have a whole bunch of equity, but there'd be an IRS lien against the property, and there'd be no way to file it. I've had situations where there was sufficient proceeds to pay off the mortgage loans, but there was a water softener against the property that had filed, and it was $12,000, and so they couldn't sell the property because they didn't have sufficient cash to sell the property unless they brought money to the table. So a short sale really is that all it means is that the seller has to bring money in order for title to close because there's liens against the property and the proceeds are insufficient to pay it off. And the buyer doesn't have the cash and can prove that they're in a hardship scenario and don't have the cash. So when you purchase a home, most of the time, especially if someone buys a home today and they put down 3%, 3.5% down, do you think that they can turn around tomorrow and sell the home and break even? Likely not. So there should be an expectation that the property needs to amortize, they need to pay it off over time, that there's going to be some time before they reach the break even point. And You can look at the amortization schedule too and see at what point, they're going to pay down the principal balance, which is very low because most of it's going to interest. So the principal balance is pretty much staying there for the first 5 years. So you're really talking about appreciation coming up to give them some relief to be able to sell it. So there should be an expectation that if someone sells a home immediately, that they're going to have to write a check, and they're not going to make a profit or break even. But there are situations where people have a hardship scenario. They're unable to make their mortgage payment and they don't have the cash to sell the property and the property is underwater. Then they can go to the lender and say, this is going to go to foreclosure. I have no way to make my mortgage payment. I have no way to keep myself afloat here. But I'll work with you and try to help you sell this property and help limit your losses. And they go to the lender and say, look, I'm willing to do whatever I can to help you a stopgap to recover as much as you can, because we know that it's going to be very expensive to foreclose just from the attorneys involved. So then the lenders are going to look, number one, are they in a certified hardship scenario? Give us your hardship letter. Let me see your bank statements. What happened? Did you lose a job? Was there a death? What happened? And they're going to take a look at all of that scenario. And then they're going to do not a heartfelt response, but a spreadsheet response. Based on your scenario, we determine that you're not in a hardship scenario and we're not going to approve the short sale. And a lot of short sales are not approved because it's quite clear that the buyer just simply does not want to bring money to the table. They have the money, but they don't want to bring it to the table. And they're asking the seller to take a loss. In situations like that, the lender realizes that the borrower has options. They can rent out the property. They can do whatever they can to try to continue helping the lender not lose their money. So not all short sales are going to be approved. There needs to be a certified hardship scenario, and the lender is going to do a lot of research and take their time in trying to determine whether or not it's in their best interest to do a short sale. And then foreclosure. When the borrower fails to make the payments and they are 45 days delinquent in Texas, a notice of default is filed at the county and they officially go into foreclosure. And then they look to see, all right, dust it off. Who is the trustee? Who is the trustee associated with this? Because remember, we had the three-part instrument we had a promissory note, and then they had this trustee, and the trustee is getting get kicked into the scenario only when the notice of default is filed. Then the trustee is notified this mortgage is in pre-foreclosure, and then the trustee then starts their process. And the trustee oftentimes is an attorney, and they're going to start talking with the loan servicer, and they're going to be loan servicer, call these people and try to figure it out. So they're going to call and they're going to offer them, if it's an FHA loan, maybe there's a program. Maybe there's a deferment program. Maybe there's a forbearance program and try to get them into a program. But at some point, the foreclosure moves forward and it's going to be this third party that is going to actually deal with all of the details associated with the foreclosure from start until finish. And then again, back to portfolios again. A portfolio loan is a loan originated by a lender and kept on their own balance sheet. It's their money, um, and it is up to them on what they're going to offer in terms of rates and qualification. You can kind of call it a hard money loan, but the real definition of a hard money loan is that the property is not collateral for that loan. And in these portfolio lenders, the property is collateral for the loan. So they're just going to portfolio it. So maybe one of the lenders, actually Chase Bank, a lot of them, they actually have a requirement to portfolio a certain amount of loans. So um, it just means that they have special programs. And maybe it's called a doctor loan, where you might have a business owner or a doctor who has 5 or 6 or 7 different investment properties and they don't conform and they're never to conform. But they'll have a no doc loan that says, all right, here's $10 million and no doc loans, go fund them. And then they use up that money and then they don't have that program anymore. So they usually have a a purchase or a purpose in mind for the types of loans that they are going to portfolio. It's not usually, I have a client that has bad credit, will you portfolio it? It's usually, I have a lender who has 10 homes and the guidelines say they can only have 6 homes. will you portfolio this loan? And they look at it and it's A paper and they say, sure, we'll portfolio this. So it's that type of situation, usually not what we would hope that they would do, which is um, portfolio a loan that is for a first-time home buyer who can't qualify. That's not usually their purpose, but it could be. Okay, moving on to government loans. We're going to have a very deep conversation about FHA and VA, and a lot of our loans are backed by the government, and we're going to talk about what FHA is, and what it's not. So all government loans have either insurance for FHA loans, which is called MIP, mortgage insurance premium, which is the insurance underneath FHA that makes it possible, or a guarantee fee. And a guarantee fee is for the VA loans. So FHA either has their mortgage insurance that's coupled with FHA loans, or the guarantee fee, which is for VA loans. And that's called the VA funding fee and the VA guarantee fee. When a borrower has less than 80% loan to value, which means they're coming in with less down payment. Let's start with FHA. FHA was created to strengthen the construction sector to create a bustling housing industry, which obviously it did, and to foster widespread homeownership, which it did. Its guidelines for underwriting risks and for appraising properties offered a baseline for all other residential lending, and the mortgage insurance program served as a model for the primary mortgage insurance that came later. Today, FHA programs primarily help borrowers qualify to buy or to refinance when they otherwise would be impossible for them to do so. FHA does not provide loans. They don't have money. They don't have trillions of dollars that they're lending out. Instead, they insure these loans. And the same investors who are buying the conventional loans buy these loans. So the entire system, the whole system, is based on having a secondary market that's interested in buying these loans. And the moment the secondary market doesn't want to buy them anymore, the entire system shuts down overnight. And no more low down payment, only 20% down. Thankfully, that's never happened, and the system is pretty stable. But it's stable because of appraisals, and it's stable because of the underwriting guidelines that are in place, and it's stable because of the insurance that will help an investor make them feel comfortable forking over their money, knowing that it's less risk. So, page 16, FHA does not provide loans, it insures them. FHA provides mortgage insurance, which gives assurance to lenders. The mortgage insurance backs the loan and minimizes risk for the lender. The insurance helps buyers obtain loans at market rates when they otherwise couldn't due to poor credit, lack of funds, or other factors. And because it's insured and because FHA is backed by the government, they actually will have special programs designed to help people. So, key points: FHA loans, backed by the federal government, offers many types of loan products. We're going to talk about the loan products in a moment, whether it be a rehab loan or a condo loan or 1 to 4 family. Allows for minimal down payments as low as 3.5% down. Allows for higher debt ratios, so they can be carrying a little bit more debt, for instance, on credit cards or installment debt like houses or like cars. Less strict credit requirements, so their scores can be a little bit lower than what you would typically see on the conforming conventionals. And there are over 8,000 FHA lenders nationwide. And it can be used to rehab or refurbish a home. Loan uses. So there's 4 main uses for an FHA loan. Our typical 1 to 4 family, which is pretty much our bread and butter of what we do. Condos, which is a different loan type. So we're going to talk about that in a minute, because I'll bet you, and I know this is true because we are looking at all of your contracts, a lot of agents put 203B on the type of loan for the third party when they're doing a condo. But did you know it's a 234C? So it's a different section for a condo than it is a 1 to 4 family. Completely different kind of loan. So again, 1 to 4 family, a condo, manufactured home. This is a property that's become secured as real property, and it's done so by the appraisal district and followed the rules to get that done in the first place. And homes that need rehab. So a home that is in bad condition, and someone can go and get quotes from third parties, and then the appraisal will do the hard task of trying to figure out what would this home be worth after all of that is done, and then they'll loan that amount, and then they will fund paying the third parties so that they can have a habitable home from buying a home that was inhabitable, helping to spur that market as well, where people can put as low as 5% down on a transaction like that. So again, eligibility. We have income, we have assets, liabilities, which we're going to touch lightly on, and then credit histories. So this is the work of a lender. These guidelines change on a continual basis, and rules and regulations come and go. I don't necessarily think it's a good thing for an agent to know that the minimum FICO score is 540 or 560 or 580 or 620 because it's changed about 10 times since I've had my license. And so I think it's always a good idea for you to get them with a lender, but and have them run their credit, but having a general idea of what the market is today is helpful. First, they have to have a credit score. In order for them to have, we're going to get into this in a moment, the manual underwritten versus the automated approval. FHA works on automated approval. So if there is no credit score, then they're going to have to manually underwrite that file. So borrowers with a minimum decision score of 580 are eligible for the maximum financing up to the loan amount. Borrowers with a credit score between 500 and 579 are limited to a maximum of 90% loan to value, which means they need to put down more. So if you tell a buyer, oh, you got a 500 FICO score, you can't buy a home. The question is, yeah, you can buy, but you're gonna have to put 10% down instead of 3. What is your cash on hand? Sometimes they may have more cash. They're obviously not paying their bills, so maybe they have more cash in their bank. A credit score below 500 is not allowed. So if it's under 500, it's not allowed. So then, of course, if there is no score, is that under 500? Yeah, it is. So they have to manually underwrite it. But the thing is that a lender, it means that they don't have a score at all, which means they don't have the 3 trades don't even have them. Experian, Equifax, and TransUnion don't have a file on them. So your lender can help create a file and seed the file, but they also want a number, a specific time that they've had a file. If the buyer has a decision credit score below 820 and a debt to income ratio beyond 43%, the loan must be manually underwritten. 620. Also applies to energy efficient mortgages. We're going to talk about the EEM mortgages in a second because they can fund a loan, but then there's an amount that they can put on top of it that's separately approved that will increase the amount that will allow them to mortgage in some energy improvements or allow them to be able to buy the property for a little bit more because the payment's going to be less. We're going to get into that to the next page. Chapter 13, bankruptcy they have to have it released within 12 months and 2 years after Chapter 7 bankruptcy. What are their assets? Only enough assets necessary to fund the loan. Reserves and a history of savings are positive. Gifts for down payment may be allowed from a relative. Down payment and closing costs may be borrowed against assets owned by the borrower, including a 401k. They can borrow from their IRAs or their 401k plans, and must always be fully documented. We have this happen all the time. In fact, we have a situation right now going on where we have a buyer that used earnest money and the source of the earnest money could not be sourced. So the lender came back to us and said, well, we can't use the earnest money, so the earnest money had to be refunded. So now we had this scenario where the buyer agent was trying to get us as a company to recommend to our seller to refund the earnest money to the buyer before closing. How many of you sounds like I said refund the earnest money to the seller and add the earnest money to paragraph 12A closing costs. So when they do property back in the amount, been released to the seller. That's what we did, and that is what happened. So when we talk about that the deposits have to be sourced, they are going to go through 3 months of bank statements at least, and they're going to look at every single deposit. And they have to know where that money came from. Oh, this came from their paycheck. This came from a tax refund. This $5,000, where did it come from? Oh, I had it in a box at home. No, not going to work. So then they have to take that $5,000 out of the equation and see with that and say, okay, there's $10,000 in the bank. We have to remove that from our calculator and pretend there's only 5,000 in the bank. Can we fund this loan like that? So that's what that means by fully documented and fully sourced. Debt levels, what their debt needs to be, which we're not going to get too much into that. Now, loan limits. I'm going to put this into our chat here because I want to share my screen. I'm going to put this into the chat. So here's your FHA mortgage loan limits. So you'll see it's sorted by county, state, MSA code. So let's type in, let's go to Texas and Travis County. So here are your loan limits for one family, two family, or multi-units, a duplex, triplex, fourplex. So this is Austin, Round Rock, Georgetown, this entire area, which is you do it by county, but then they do it by MSA. And they talk about what the conforming loan limits are. VA has loan limits and FHA has more loan limits. And it's listed on the HUD's website for everyone to see, and it changes. These were set November 20th, 2024. And about every 2 years to 3 years, they're changed. I don't know exactly what the interval is, but when it changes, it could be a bad thing. It could be a good thing. I had a scenario where I was working with a client and they were marginally qualified, first-time home buyers. They had every single thing into this loan, and they had some hoops to jump through. And Michelle Iconen did a fantastic job jumping through every single hoop. And then there was a delay, and that delay, and I don't remember what it was, but I think it had something to do with their employer, with their verification of employment. The loan limits decreased in the middle of the transaction. And that meant that the lender couldn't loan the amount that they needed to at that point. And the buyer had to bring more cash to the table. And they were already at the point where they were 100% in. And it went down by $30,000. And the seller was not going to reduce the price. We were already on extension and it blew up the sale. And there was nothing that anyone could do about it. And in that situation, they lost their earnest money. They initially went in for a 5% down conventional because their FICO scores didn't meet the FHA's. And then they flipped to FHA. So they lost their earnest money because the third-party financing started with conventional, and that's what they started with. So we got through it. The seller refused to sign an amendment to push them to FHA. They were going to lose their earnest money anyway. So sometimes you have these scenarios that don't work out and it's no one's fault, but loan limits are a very, very, very big deal because the lenders cannot loan more than that in those areas. The principal of the balance has to be that number or less. FHA loan products. We kind of touched on this a moment ago, but we have the 203B. 203B is your normal 1 to 4 family home. What we see, the most common. Our condos are section 234C. This is a purchase or resale of a condo unit. Just know that we blew up this. Let me fix this. We should know as agents when we're filling out the third party financing what section this is. So piggyback this, dog ear it, put it somewhere so that you know. So you fill out the third party financing section because most agents will put the 1 to 4 family section on the third party for condos. We have the 203K. The 203K is rehab loan. They can purchase a home and fund it in its upgraded state, and they carry back paid invoices for the third parties who are going to put in new flooring, put in new appliances, whatever it is that they're going to do. And so the first installment of the funding of the loan is used for the purchase or refinance, and the remainder is placed in an escrow account and paid to the contractors as the rehab is completed. Where we were before, in 2020, 2021, that wasn't possible, but we're back to these types of things being possible because it's going to take longer to put this deal together because you're going to need the third party trades to be able to work this out and to get the quotes and for it all to make sense and an appraisal to be done to make sure that it works out. Section 251 is for ARMs, adjustable rate mortgages, and 255, which is for reverse mortgages. I teach SRES, the senior real estate specialist class, and we have an entire half day that we spend on the section 255. Okay, so I owe you a break. It's 11:10. Let's come back at 11:15, and then we're going to jump into the energy efficient mortgages and spend a little bit of time there. So I'll see you back in 10 minutes. Welcome back, everyone. We are covering a lot of information. I am cognizant of that. So we're going to continue layering it more and more onto this. So if you have questions, please do not be shy. We just walked through the FHA guidelines and talking about the different types of FHA loans. And then we have also FHA energy efficient mortgages, energy audits and energy efficient mortgages. So the energy efficient mortgages, they come in two types that affect a loan: improvement costs and then energy efficient loan limits. The improvement costs is when they're going to finance in a upgrade when they're purchasing it. Maybe they want to get solar panels and they purchase a home and they finance in the solar panels in along with the property. And then they add the solar panels and it's part of their mortgage, which is a much better option than to get a second mortgage or a second lien for solar panels later. The cost of the improvement that is eligible for financing is either a minimum of $4,000 or 5% of the property value capped at $8,000, whichever is greater. For example, for a home valued at $75,000, the maximum cost of improvement to be financed would be $4,000. 5% of the home's value, $75,000, is $3,750, which is less than $4,000, the minimum. A home valued at $150,000 could qualify for $7,500 worth of improvements, which is 5% of the home's value, and greater than $4,000. So a lender will help you with determining whether or not this is an option for someone. And then the loan limits. So this is the loan limit that they are going to allow. So if a property is a $300,000 property and they are going to have a loan limit can be increased, that's going to be on top of the mortgage. It's not separate. Says in most areas, the maximum loan eligible for an energy efficient mortgage for a single family home is $160,000. That's very old. That's changed since then because this was about 10 years old now. Lower limits apply in certain areas, but a buyer's final loan amount can exceed the FHA loan limit by the cost of the energy improvements. So if they're getting a $300,000 home, then the EEM limit would be $160,000 on top of the $300,000, which is $360,000 homes. So there's just one rule that the savings over time has to be greater than the actual improvement cost itself. So in order for an energy efficient loan to be approved, the savings that the buyer can expect to receive over the life of the loan must be greater than the cost of the improvement. Qualifying for an FHA loan. FHA loans always use this concept of automated underwriting. They're going to type in some values and they're going to click a button and see if they get underwriting approval. If they get underwriting approval, everything is good. They start underwriting the file. If they don't, then it's a manual underwrite. It's a lot more work for the lenders. FHA needs a complete file, and the automated underwriting system just makes it easier for the lenders because it has some checks and balances built into it already, versus them having to do what the software does, but do it manually and do it on PDF forms and fill out the entire thing and then send it to FHA and see if they're going to insure it. Again, remember that at the end of the day, it's the job of the processor, or not the processor, but the underwriter, to protect the institution that is the lenders that the lender works for. The loan originator, your contact person at the bank that's the lender, that your preferred lender, they want to close this loan just as much as you do because they have just as much to gain by closing this loan financially as you do. However, the person at the bank who's protecting them, or the lender, whoever it is the underwriter. And the underwriter is trying to make sure that the lender has put together a file that they're going to eventually be able to sell on the secondary market, that it conforms in every single way. So the underwriter has to know the underwriting requirements, all the FHA guidelines. And there are literally books written about the guidelines. And they're looking to make sure that this conforms in every way. And if it doesn't conform, then they push it back and they put conditions on it that says, look, we're giving you uh, approval, but you've got these 10 conditions that you have to solve. And if you can't solve the conditions, we can't fund the loan. So that's why a lender will submit a file in its most complete form to the underwriter, and the underwriter will begin looking at every detail and then kicking it back when there's something that doesn't quite fit what they think is going to be their ability to sell it on the secondary market. We talked about this before, but the buyer's willingness, the ability, and the collateral is what the underwriter is looking for. FHE uses more relaxed guidelines in conventional lending for measuring willingness because they've got a little looser guidelines on FICO score. Willingness differs from conventional lending because FHA allows weaker credit scores. So what is willing? Again, it's the buyer's repayment history. That's what the willing is. But they have willingness is the credit profile and their payment history and all of that. So they have a lower willingness score than conventional because they will allow a lower FICO score. That willingness is really about their what they've shown as the past willingness to repay the debts that they have. Borrowers can access FHA insured financing no sooner than 3 years after foreclosure. FHA more closely inspects ability. It requires 1 full month of pay stubs and 2 years of W-2s for statutory employees in lieu of a full verification of employment. So they can either do ask the lender, or they can ask documents from they can ask the employer for the documents, or they can ask the employee the documents. But I can tell you that FHA has an easier ability for buyers to be able to qualify for a home because of the insurance than conventional. We're not going to get into the ratios because it's a little bit confusing, but the ratio has a lot to do with debt and how much debt the housing expenses are going to have, your HOA, your property taxes, what debt is going to be on the front end, which is going to be everything to do with the house. And then the back end debt also is a big deal, which is the debt from your car payments and all the other sort of stuff. And so they have a requirement of 31 front end and 43 back end. And so usually people's mortgage payment is the biggest chunk of their debt. So in any event, there's ratios here, and the lenders are going to be doing the mental gymnastics and the spreadsheet analysis of what is the front end and back end debt. But if they have too much credit card debt or too many auto loans, sometimes they're looking at refinancing those or selling them to get them off of their own balance sheet so that they can qualify for these kind of loans. But the ratios are more gracious for FHA and even more gracious for VA. Now, what is the down payment requirement for FHA? So 3.5% down up to the loan limit, and if it's over the limit, it's 5% down. Or if their FICO score is lower than 620 or lower than 580, but above 500, their down payment is going to have to increase. They go from 5% to 10% and sometimes even higher. Now, so the down payment is usually 3.5% or 5%, but it could be 10% based on FICO score. And then the mortgage insurance premium. The the because they are getting this loan for less than 20% down, they have to pay upfront mortgage insurance, and that is going to be 1.75. The upfront mortgage insurance premium is 1.75% for either 15 or 30 years. It's required for all loans. It can be financed, which means it can be calculated and then added to the cost of the loan, or it can be paid upfront. Sometimes the upfront actually will cost less because they're not paying amortized insurance, they're paying just the initial, which can be less. And then the annual MIP. Okay, VA loans. This is a pretty substantial conversation that we're about to have because VA borrowers have access to a loan type that nobody else has. It's an incredible program. One of the very first questions we should be asking the borrower if they have any access to a VA loan. And sometimes it could be a surviving spouse that has access to a VA loan that they don't even know about. So let's jump into this. The GI Bill 1944 was a very important piece of legislation that allowed U.S. military to have access to be able to purchase a home with a special government loan. And the VA acted as an insurance company, much like FHA does for non-VA borrowers. Active duty members, honorably discharged veterans, reservists, and unremarried spouses of deceased veterans whose deaths are service related are eligible for a VA loan. The VA loan benefits. Would someone read the benefits on the bottom of 21? Can you raise your hand? Candy's like, I don't understand why no one is raising their hand the entire day. It just doesn't even make sense to me. All right, Candy, thank you.
Okay, no down payment up to the county VA loan limit, no mortgage insurance, lower interest rates compared to conventional loans, no minimum credit score, although many lenders require 620 or higher.
And keep going.
Okay. Surviving spouses may be eligible if death of veteran is military related. No limit seller contributions to buyer's closing costs, although some lenders have a 4% cap. Gift funds allowed from family members for paying off debt, closing costs, etc. Easy qualifying with more flexible debt to income ratios, no set cap. Only a 2-year waiting period after Chapter 7 bankruptcy or foreclosure. Loan amounts up to 1.5 million, minimum down payment required over county VA loan limit. VA loans are assumable by qualified buyers, veteran or not, and no prepayment penalty for VA loans, for any
Okay.
VA loans.
Thank you. All right, so I'm going to ask you all, we're going to do a little quiz. What is the minimum FICO score for a VA loan?
Now we're on this paper.
What is the minimum FICO score today?
There is none.
There isn't one.
There isn't any. But you'll notice that up here, it mentioned some lenders may require 620 and higher. So some lenders have what's called overlays. And overlays additional qualifications that they put on a loan for their own purposes. There is no FICO score. So if someone is quote unquote direct with VA and have no overlays, there's not going to be a FICO score requirement. Their FICO score could be 10. And as long as they can have the willingness to repay, which has nothing to do with their FICO score, they have the ability, meaning they have the income, they're going to fund. So because of a FICO score situation, if you have a lender that says, yeah, we just can't do it, their FICO score is too low, you know that you're speaking to the wrong lender for that VA borrower. They have overlays that they've applied to this transaction, and it means that there's another lender that can do what they cannot. one question that you should have before introducing the VA borrower to the lender is asking them, do you have any overlays? Do you have any requirements that exceed the VA requirements for approval of loan? Good question to ask them. So home eligibility, this is the whole thing. It is an entitlement. Military service men and women are required to serve 90 consecutive days of active duty wartime. That's why it says servicemen and women, because they're active duty. So if they're currently in the military, they need to have had 90 days of active duty during wartime or 181 days of active service during peacetime, in order to be able to get their VA benefits kicked in while they're serving. And the spouse of a service member who has died in the line of duty or as a result of a service-related disability may also be eligible for refinance or purchase of a VA loan. The entitlement program, which comes below, who's first eligible for it, anybody who has been honorably discharged. Talk about the entitlement program. VA entitlement is not the same thing as VA eligibility. So once they're eligible, their DD-214 will show what their eligibility is, and lenders have access to an online system that will provide that DD-214, which is their eligibility certificate. Entitlement is the amount the VA will guarantee. There is an amount that they have as part of the benefits that they were given from the military, which has a lot to do with how long they were in the military and what rank they had while they were in the military. As of January 2018, the amount was $435,000 in all counties in Texas for the conforming loan limit. Obviously, that has changed now. And I'm not exactly sure what it is, but we'll look it up here in a minute. I don't have it off the top of my head. Now, VA has a funding fee. Think of the funding fee as almost like an origination charge from the borrower. When they do the very first use of a VA loan, there is no funding fee. But subsequent uses can have a funding fee. And that funding fee can be as much as 1.5%, which could be expensive. Could be as high as 2% on third or fourth use. But the first time they use their entitlement program, there is no funding fee. So a $300,000 home, it's zero down, no funding fee. Use it a second time, it's going to go up. Maybe a $3,000 funding fee. And if someone is 100%, or actually it's 10% disabled or more, the funding fee is they will never pay a funding fee. So if they have any amount of disability, 10% or more, they will never pay a funding fee on the subsequent uses either. Now let's talk about VA loan assumability, because there is a right answer, a wrong answer, and then another wrong answer. There is a caveat that you as an agent need to remember here. Conventional loans are never assumable. Just put that on the table. Just remember, conventional loans are never assumable. A conventional lender is not going to want to take their loan and give it to someone else who they don't know. But FHA, because it's insured, they allow assumability. It's the benefit of using FHA insurance. So that low interest rate can be assumed to somebody else. It's the benefit of using FHA insured. VA also has assumability. However, it can be assumed by anyone. But there's some dangers here. And the danger is a VA borrower to VA borrower assumability transfers the substitution of entitlement. Someone has an entitlement to a loan and they're a VA borrower and they get a VA loan. And somebody else is a VA entitled borrower. What will happen is VA will allow it to be assumed by the other borrower, and they will do what's called a substitution of entitlement, which means that their entitlement will transfer to the other person's entitlement. And the original borrower's entitlement will be restored. So they can then go buy another property using their VA entitlement. You can assume a loan if you're not a VA borrower, but there is no substitution of entitlement, which means the original VA borrower's entitlement is locked. And if they foreclose, the VA borrower loses their entitlement forever. Now, it used to be a possibility of losing it. And you would want to go with the underwriter and see what it actually said. But that's just not the case anymore. So to safeguard, you need a qualified VA borrower to assume the loan and agree to substitute their entitlement for yours. Otherwise, if someone assumes your loan and later defaults, you would lose the VA loan entitlement you used on that property. And we certainly would not want to be in a situation where we had a VA borrower of ours lose their entitlement because they did a loan assumption to a non-VA borrower, and that VA borrower subsequently foreclosed on the property and they lose their entitlement forever. That would be a travesty. So it's not for us to decide. It's up to us to advise the client of what the liabilities are. And by the way, it's not a guarantee that when a VA borrower and a VA borrower does an assumption together, that the substitution of entitlement will happen. That is an agreement that the parties make. So we want to make sure that if we're on the front end of putting a deal together that is going to be a loan assumption on a VA, that the buyer, as part of the contract, agrees for a substitution of entitlement, so that they're going to use their entitlement and the sellers will have theirs restored if, after speaking with the seller, that's what they require. And make sure that that's in the agreement. But let the seller know that this is kind of how the construct of this works, and we need them to be aware of it. So this is a good page to dog ear to remember this. VA loans can be assumable, meaning another person, veteran or not, can essentially take on the terms of the payments of your VA loan. This can be a powerful marketing tool for homeowners if interest rates are on the rise, which they certainly are higher now than they were back in 2018, 2019. Lenders and servicers will need to approve most loan assumptions, and sometimes they're not approved. VA homeowners should understand that a loan assumption could put their VA loan entitlement at risk. To safeguard it, you need a qualified VA borrower to assume the loan and agree to substitute their entitlement for yours. So this is the very best language I've seen regarding this particular topic. Okay, moving on to another VA benefit that our buyers have, specific to Texas. So VA loans are a national program that is for any state, but in Texas, we have an additional program, the Texas Veteran Land Board. The Veteran Land Board funds for purchasing a home are lent in conjunction with a VA or an FHA or a conventional loan. Texas Veteran Land Board could use any kind of underwriting type of loan, meaning that the type of loan that they're getting could be any of it, but they're going to have an entitlement associated with it. So it's not a standalone program. It is always for primary residence or the intent of primary residence and cannot be used for refinancing. The lender must be on the Veteran Land Board website as a participating lender, and there are not very many of these. But once you understand what this program is, you're probably never going to want to do a normal VA loan again. You're always going to try to be pushing for this, or at least telling the client what this is about. So they've got good load limits, over 600 and something, I think it is currently. When used with a VA loan, anything over that limit is a down payment. That's fine. The basic eligibility for the veteran housing program is that the veteran must be living in Texas long enough to obtain a Texas driver's license and have served in at least 90 days of active duty. If used with a VA loan, the minimum VA service requirements apply. What happens here is they have a discount rate on the interest. So the interest is going to go down almost by a half a point or even a point. That's a really big deal. And something that the land board has that no other loan has is a zero down land program. They can buy vacant land that they intend to build a house on later and put zero down. There is no zero down programs for land on planet Earth, guys, except for this one. The Texas Veteran Land Board has built into the Texas Veteran program. That's why it's called a land board. And they go through that particular, in fact, they even have a designation for this. It's an incredible program that they can go buy a 2-acre piece of land with nothing on it with zero down, and 5 years from now build a home on it because that's what their intent is. And so know what programs are out there. Again, texasveterans.com is the website that you can go and learn more about this. Very few lenders are part of this because most of them work for national companies and they have not taken the time to, join some of the state programs. So it's the smaller lenders that are going to participate this, especially your credit unions. And then Texas Veteran Housing Assistance Programs, a veteran assistance. When offering the assistance program to veterans, lenders usually charge a 1% origination fee and a 1% participation fee. There can be no discount or buy down fees with the veteran land board loans, and there can be no buy up to eliminate points or fees because the rate is a set rate. The seller may pay all or part of the closing costs on behalf of the buyer, so the loans can be very compelling alternative to standard lending, especially when the interest rate discounts available to discount veterans with a 30% or more rating. So again, this is a very powerful program. And on this topic, we're going to move over to the topic of affordability programs in general. And some of you took the TSHAC class last week. So part of that's going to be on this. We have a affordability crisis. Homes are appreciating faster than people's paychecks are appreciating. So we're looking at dual income. People are having a difficult time sometimes qualifying for living in some of our major metros where home prices are 800, 900, $1 million. So if people are getting a loan, obviously they have to qualify. Not everyone is going to always qualify for living in these major metropolitan areas. But there are programs that will help people purchase a home using these programs. Fannie and Freddie has My Community, and Freddie has the Home Possible program, which used to be called Make a Home Affordable, has now been renamed to Home Possible. So you have My Community and Home Possible programs that allow smaller than 3.5% down payments. And when coupled with approved homebuyer education classes, that's like take a 2-hour homebuyer class, and once they get the certificate, then the PMI companies will discount the cost of the PMI as well. So from 1.5% down to half sometimes. So the program, lower or no credit scores, higher debt ratios, allow them to buy a temporary buy down, no minimum buyer contribution. So the buyer can just get contributions from the seller, unlimited amounts, in order for them to be able to qualify. And cities use HUD grants to offer these programs. And so usually it's municipality based. So City of Austin will have these programs and different counties will have these programs. Then they have the Community Reinvestment Act, which was passed in 1977, and it does the same thing. It encourages commercial banks and savings and loans to help meet the credit needs of all segments of the communities where they serve. So in the communities that they serve, they are putting together programs that will allow people to purchase a home with less when they have less income, when they have a lower FICO score, and when they have less cash in order for them to buy a home. Requirements. The Community Reinvestment Act sets requirements for financial institutions to issue loans to support activities including building and rehabbing affordable housing, financing for areas recovering from natural disaster, credit and home buyer counseling, construction and community facilities in low-income areas, and environmental cleanup. So it is giving the municipalities the cash and the resources to be able then to use the opportunities under Freddie and Fannie and use those loans to go rehab these homes to get them in a position to be able to use them as low income. Now, this is one that we know well. The Texas Department of Housing and Community Affairs, TDHCA, and then the TSAC, which is the Texas State Affordability Housing Corporation. Both amazing programs. The TDHCA, they have a $400 million annual sitting there in funds through a combination of federal grants, tax credits, and mortgage loan programs with down payment and closing costs assistance. A majority of the households served by TDHCA are at or below 80% of the conforming income. Two programs offered, the Texas Mortgage Credit Program and the My First Texas Home Program, which is truly a first-time home buyer program. The class that we took last week, they're offering them many times in the future. So I recommend Googling and finding the next one if you haven't taken it, because it's going to open a lot of doors for you when you're having conversations. I asked my staff, does anybody that's working in our relocation department to be familiar with all of these programs, so that when they're on the phone with these people, we can be talking to them about solutions that they may have never even heard of before, which is down payment assistance programs and closing cost assistance programs, reduction in the MI costs, and even a reduction in their interest rates. And then TSAC, very similar, serving the household needs of low-income residents. It provides financial acquisition programs to help developers build affordable housing, and offers homeownership programs to help low-income families acquire housing. And again, down payment assistance, all the things. And the overall common goal here is for people who ordinarily couldn't buy a home, have those doors open for them so that they can buy a home. And there is a lot of programs, from the Texas Veteran Land Board to the TSAC and TDHCA and other programs, like some of the bond programs that we have. And one that they don't really list here is the Good Neighbor Next Door program, which will, if you are a police officer, fireman, first responder, they will grant them a down payment. And then if they live in the home for 5 years, they will pay it back. Again, another Texas program. Okay. Again, we're going to go to lunch at 12:30, so we're going to power through the next 30 minutes, and then we're going to jump into lunch. But we're going to talk about loan types. Now, we already talked about FHA and VA like that, but now we're going to talk about loan types in the types of fixed rate mortgage, ARMs, and different kinds of loans like that. So let's jump into the fixed rates. Fixed rate mortgage is a 15 or 30-year mortgage that the interest rate's not going to change over time. It's fixed. And there's an amortization schedule that has to be provided to the buyer at closing that explains exactly how the interest is going to be applied for every single payment that they make. And if they miss a payment, then it can recast the amortization schedule, or they can put those payments at the end and recast the amortization schedule. But the amortization schedule is a very important document, because it is the disclosure of how the interest is going to be applied, and the buyer has to sign that, which is why the amortization schedule is always included in the loan docs. So fixed rate, the majority of loans taken out since the advent of the secondary market, remember those people who are buying these conforming loans, have been a 30-year fixed rate mortgage. Or then later people refinance from a 30-year to a 15-year, because the payment's going to maybe remain the same, but not if the rates have gone up. Mortgages are paid monthly in a fixed rate mortgage, and the total amount for both principal and interest remains the same. Just what is applied to principal versus interest changes a little bit every month. In a loan, interest is front loaded, meaning that you pay more interest up front. Thus, most of the payments in the first 5 years of a loan go towards interest. This is why a principal payment up front can be huge for a buyer. And it can knock off 5 years of the loan if they make a 13th payment every single year just by simply making one principal payment. Obviously, they don't want to make an interest-only payment, so get this right. They want to make a principal payment to pay down the interest, because the interest in the first year is 90%, which means they're barely touching the principal. So if they can knock a couple $1,000s off the principal, that's going to compound over 30 years, and that's going to be a lot of interest that they've saved. So these principal-only payments are a big deal. And yes, a principal-only payment will recast the amortization schedule. Origination fees and points are that this is paid, charged by the originator. Some loans have an origination fee, or what it costs to originate the loan. Could be 1%, could be more. Standard fee is kind of 1%. And that is what the lender is going to walk away with for their company as their compensation for originating the loan. It's literally an origination fee. They get a bonus, or that's their compensation for originating the loan. Then we have the adjustable rate mortgages. They got a really bad rap, by the way, unnecessarily bad rap. And it's not that that adjustable rate mortgages are bad. It's just it's the wrong product to be used for a 30-year mortgage. and they were being used for a purpose other than what they should have been. People were unable to qualify for a 30-year mortgage, and so they got into an adjustable rate mortgage. And most adjustable rate mortgages have what's called a teaser rate. They come in two parts, the adjustable rate mortgage. They have what's called a start rate, which is also called a teaser rate. And then once you're outside of that teaser rate, then you have what's called the new rate or the adjustable period. And those periods will adjust based on the type of loan and how long the ARM is for. Could be a 4-year, could be 6, but there is what's later called a cap, with the highest amount someone could pay in an interest rate. So an adjustable rate mortgage is not uncapped, it is capped, but it starts with a teaser rate. And that teaser rate could be very low. It could be 1%. And it could be 1% for the first 3 years. And so you see, sometimes that lenders could not qualify the buyer. So they said, well, why don't you get an ARM and then refinance it in 3 years? And then they didn't fix their credit or they didn't make more money. Something happened to their credit and they couldn't refinance it and they were stuck with the ARM. And then they fell out of the teaser rate and now they were adjustable and it went from 1% to 5% and their payment went up by $700, $800, $900. And they couldn't afford their home and their home went into foreclosure. So what is a good use for an ARM? Maybe it's adjustable at 1% for 4 years. And someone says, I'm going to buy my kid a condo and we're going to keep that condo for 4 years. And it's going to be a 3-bedroom and they're going to rent out the other 2. So it's basically now I'm getting a 1% interest loan on this condo. And in 4 years, I'm going to sell it. And if I lose money, it's going to be pale in comparison to what I would have paid for their housing costs every month. And so it's a scenario that can be had, and then if they're not, the option is a very well qualified buyer that understands what they're getting themselves into, and then sell that property in 4 years, or convert it into a conventional if they decide that they like the income from it. Kid moves on out of college and they want to continue renting to college students for whatever reason that makes sense to them. So, all right, origination fees and points, and adjustable rate mortgages and the teaser sections. So there's some things on the next page, and I'm going to ask for a new volunteer to read, two volunteers, one to read some of the features of ARMs, and then another person to read questions to ask a lender regarding an ARM. Can I get 2 volunteers, please? Thank you, Meg and Melissa. All right, so Meg, you'll go first, and then Melissa next.
Here are some of the features of ARMs. Start rate or teaser rate, adjustment periods, cap on number of adjustments, cap on the rate increase per adjustment, cap on the interest rate over the life of the loan. For example, the loan cannot exceed X%, and prepayment penalties.
Thank you, Melissa.
Questions to ask regarding an ARM. How long do you plan on staying in your home? Number 2, how frequently does the ARM adjust and when is that adjustment made? Number 3, what is the interest rate environment like? Number 4, could you still afford monthly payments if the interest rate rises significantly? Number 5, can the buyer refinance or roll over to a fixed rate loan? When and at what cost is there a penalty? Number 6, is there a prepayment penalty? Number 7, what are your adjustment caps? And number 8, is there any negative amortization?
Excellent, thank you. All right, so there's no guarantee that the ARM is going to go up. It actually could be that, that it stay the same or even go down. But the ARMs are attached to an index, and the index is what's going to ultimately determine the interest rate that's going to get charged, and those indexes are continually changing. And there's 3 indexes that they have. They have the Treasury Index, they have the 11th District Cost of Funds, which is basically New York, and then the LIBOR, which is the London Interbank. So those are the 3 that they use, and sometimes they'll even use an average of the 3. So I'm going to read this because it's pretty detailed. Most ARMs have interest rates that are tied to an index, such as a 1-year Treasury Index. Interest rate caps, averages, and payment caps should be included in any discussion your client has with their lender if they're going to be using an ARM. Another index is the 11th District Cost of Funds Index. It averages the previous 12 months average monthly rates of the depositors held by the savings institutions at the 11th District Federal Home Loan Bank. The mortgages tied to this index usually change monthly. A third widely used index is the 6-month LIBOR index, the London Interbank Offering Rate Index, which is the rate on dollar-denominated securities traded between our two countries, which is the frequency of mortgage rate changes. There are frequencies and indices varying from 1 month to the other for LIBOR, but the 6-month index is currently the most widely used and it is slowly replacing the others. So they typically have interest rate caps on 6 months of 1 year and a lifetime cap, but no payment caps. When considering an ARM loan, it is important to review the length of the start rate as compared to the adjustment periods. How long is that teaser rate going to be for? Because oftentimes it's an unbelievable rate. 1%, 2% beginning. And how long is that teaser rate going to be? 6 months, a year, 3 years? It's very important. Monthly ARMs usually have a very low start rate, even as low as 1%, but that rate is usually fixed for only 1 to 3 months, but it can be a lot longer, up to a year, 2 years I've seen. After the start period, the rate has no period cap, so it can rise to the fully indexed rate after 1 or 3 months is up, but the payment stays at the initial payment, allowing the borrower to make a payment that is fixed for 1 year that is considerably lower than it would have been. So what they're saying is they're going to say, all right, we're going to make your payment for the first 12 months fixed at the teaser rate. But the teaser rate only is going to last for 2 months. So months 3 through 12, your payment is lower, but your loan is going into negative amortization because you're paying less in the interest and it's going to be tacked onto the loan. So the loan is getting, the balance of the loan is actually increasing every month because they are still paying a teaser rate, and that teaser rate doesn't even last as long as the payment that they're making, which puts them in negative amortization. So one of the questions on one of these loans is, does your teaser rate, is it the same length as the payment, the original payment amount, and does the loan go into negative amortization? So there's a lot of questions and a lot of different types of these ARMs out there. And you want to make sure that the buyer is not using an ARM because they can't qualify for a conventional or FHA for 30 years and put themselves into a ticking time bomb that's going to result in them going into foreclosure. So lastly, caps. Lots of test questions regarding this cap thing, but the last consideration for ARMs is the cap. Once again, there are 3 types of caps: a lifetime interest rate cap, payment cap, and annual interest rate cap. What is the cap? So most of them don't have a payment cap, but some of them do. So when talking with your lender about ARMs, a lot of lenders will only offer, especially the type of lenders that we use for origination, they don't offer the types of ARMs that used to be offered that had uncapped and negative amortization. So most of them don't offer those. It's going to be a much more secure type of ARM. But again, we need to find out and ask the questions if they're going to be using an ARM at all. Then we have buy downs. Buy downs is there's buy downs and then there's temporary buy downs. If the 30-year fixed rate today is 6%, a 2-1 buy down would offer a payment based on a 4% rate the first year, 5% the second, and then 6% for the remainder. Most of the buy downs that we see today are that type of a buy down, a 2-1 buy down, where they're going to purchase the rate down and they use some type of incentive to do it. Maybe the lender's offering a $50,000 incentive. So they figure out what the interest is going to be on the first year and the interest is going to be on the second year. And they simply prepay the interest for the first year and then the second year. So that the borrower, when they buy the home, is going to have a lower payment for the first year and the second year. So they're getting a 6% loan like everybody else, but they're doing a reduction. Now, we do have some lenders out there, or some builders right now that are doing a buy down, and that the whole remainder of the loan is at 3%. I just closed a transaction where they had a 3%, they had a buy down for the first year and the second year, and then it stayed at 3% forever. They're pulling out the kitchen sink and all the tools available to try to make the homes affordable. I'll tell you, it's really difficult if you are a resale in a situation where you have a builder offering that kind of an incentive. It is a really far disadvantage that that seller is going to have. So one of the things that you might want to have a conversation with your client about is, Mr. and Mrs. Seller, I want you to pay attention to these incentives they're giving you as a buyer right now, because these incentives are fantastic for you up until you sell the home and they offer that to someone else against you when you're trying to sell your home. And having that conversation above them, the light bulb goes on and they're like, oh, that's right. So my recommendation is, if you're going to buy a home in here, that you're going to buy the home and you're going to own it for as long as the builder is building. And then once the builder is gone, then that's a better time for you to sell your home. But if you sell before then, you are at a disadvantage, because you're going to be competing against the builder, offering closing costs and incentives on a brand new home that you can't even begin to offer. Because I'm sure all of you have been on a listing appointment and you're up against a builder, and it's a difficult scenario for you to be in. And somehow they'll find themselves in either my office, Michael's office, or Andrew's office. How do we solve for this? Well, I mean, really, how you solve for it is either they're going to take a loss, or they're going to rent it out, or they're going to stay in the house. A, B, or C. That's really it. There's not, a secret magical answer to that. It's just literally a fact that you have to get around. Either they're willing to accept a loss, or they're going to wait it out, either by living in the property or renting it out. So there's also this concept of an interest-only mortgage. I personally have never, in all the transactions I've transacted, had a client that opted for one of these, but it is a mortgage that will allow the transaction to pay interest and the principal never decrease. One thing that I would really like to talk to you guys, though, about is bi-weekly mortgages, because that's something that I've had happen 2 or 3 times. It's not as common, but I have had scenarios where a lender offered it in a very specific situation of a client that was very, very focused on not paying interest. Some of you might have certain faiths that don't want to pay interest, and so they do bi-weekly mortgages, and they can call the interest something completely different. But in any event, that's how they get around not paying interest. This is a situation where you are going to pay a mortgage every 2 weeks instead of once a month. And it allows you to pay a 13th payment, because the way the number of weeks work, based on the number of months, we have 52 weeks, but 12 months. So obviously, if they're making a payment every 2 weeks, they're going to end up making a 13th payment. And that 13th payment is going to allow them to cut 5 years off the interest. But this is something that someone could do on their own if they wanted to. Getting a regular 30-year product and just sending a mortgage payment every 2 weeks, they could certainly do that. Or writing a 13th check every year to their mortgage payment. But essentially, here it goes. Biweekly mortgages require the borrower to make a half-month payment by automatic draft every 2 weeks, thereby creating an extra half-month payment every 6 months, because there are 26 weeks in a 6-month period, or 13 biweekly payments in 12 half months. Essentially, the borrower makes 13 payments per year instead of 12 over a 30-year period. This can reduce the term to between 21 and 23 years. So, I mean, now they're talking about, 7 to 9 years, depicting on the interest rate. The downsides of a bi-monthly payment is that payments do not fall on the same day each month. On a bi-weekly schedule, they float earlier and earlier in the month, every month all year long. Typically, the payments are required to be automatically drafted. Another option would be just to simply add 1/12th payment to each monthly payment if you wanted to get a normal 30-year product, which most people do. Okay. We are going to jump into contracts. They specifically want me to talk about only certain paragraphs. So we're going to do that. In TREC promulgated contracts are promulgated to protect the public from improper terms that exposes them to risks, but we're all using the same promulgated language. The 1 to 4 family residential contracts, TXR 1601, paragraph 1, the initial focus of the 1 to 4 family contract is the very first paragraph, which is parties. If the buyer expects to use agency, FHA, or VA financing, the buyer can rarely vest title in the name of a non-human entity, like a corporation or a partnership. I have a lot of people coming to me and saying that they would like to purchase a home in the name of their LLC. Typically, those are going to be conventional loans, not FHA or VA, because it's for owner occupancy. But if they're going to go conventional, then that third party entity has to have credit, which means it needs to have a Dun& Bradstreet number. It needs to have assets. And just like a buyer, it needs to show that it has a ability to repay and a willingness to repay, which means it needs to have a credit score, which is a Dun& Bradstreet, and it needs to show that it has made on-time payments and these types of loans before. And most of the time, you'll get a couple of investors that pop together, create an LLC, and think that they can just get the LLC approved. And that's simply not the case. LLC actually has to be an LLC. That's an actual company that is paying off debts. Paragraph 3 states that the down payment amount in paragraph 3 states what the buyer will pay for the property. Paragraph 3C is our sales price. The down payment and the amount the buyer is borrowing equals the sales price. So paragraph 3A, cash portion, down payment. 3B, sum of all financing. Sum of all financing because they can get a carryback for the seller as a seller finance for a certain portion and third party for the rest, or an 80-15-5 where they're going to get a first and a second loan in here. And so it's the sum of all financing, not just loan amount. And then 3 obviously is going to be the sales price. We should be in every case always asking for proof of funds for whatever shows up in paragraph 3A down payment. We should be asking the lender or the buyer agent for proof of funds for that amount. If there are any loan funding fees or mortgage insurance premiums, those amounts can be added to the amount financed, but excluded from 3B. I know that sounds confusing, but your loan amount on the third-party financing is not going to always match this because of that. Most of the time, we don't get involved in that at that level. But if you were to properly fill out a third-party financing, sometimes they're going to mortgage in the mortgage insurance. And the mortgage insurance is going to be $1,500 or $2,000 or $3,000. So on a $300,000 home, it's actually $303,000 if you've done it correctly. So the true amount to be financed on the third-party financing would be $303,000, not $300,000. But TREC says for the ease of use, you can put whatever the loan amount is here minus anything that the lender is going to stack into the loan later. But the third-party financing technically should have that piece of information, which most agents don't worry about that. They put the loan amount in paragraph 3B and they take that same number and they add it to the third-party financing and it never comes up later. The next paragraph that they want us to cover is literally a ticking time bomb for anyone to step their toe into paragraph 12 with the changes, but they're not going to get into the paragraph 12 that you all want to talk about, which is the commissions. They want to talk about the closing costs only, because they're not going to get into that in this book. But they want to talk about paragraph 12 because they want to talk about the closing costs that the buyer has agreed that the seller will reimburse them for. And this list has a list of exactly what can be reimbursable, which is this paragraph 12A2. Buyer shall pay the following expenses: buyer expenses, appraisal fees, loan application fees, origination charges, credit reports, preparation of loan documents, interest on the notes from the date of the disbursement to 1 month prior to dates of first monthly payment. That's the prepaids. Recording fees, copies of easements and restrictions, loan title policy with endorsements required by the lender, loan related inspection fees, photos, amortization schedules, 1/2 of the escrow fee, all prepaid items, including required premiums for flood and hazard insurance, reserve deposits for insurance, your property taxes and special governmental assessments, final compliance inspection, courier fee, repair inspection. The lender puts if the appraiser puts something on the appraisal, if they come back to make sure that it was done, sometimes the appraiser will have to come back and they will have a reinspect fee. Underwriting fee, wire transfer fee, expenses incident to any loan, private mortgage insurance premium, VA loan funding fee, or FHA mortgage insurance premium, as required by the lender, brokerage fees that the buyer has agreed to pay, and other expenses payable by buyer under this contract. So if you look at paragraphs 12A1C, it says an amount not to exceed a dollar amount to be applied to other buyer expenses. And these are the buyer expenses. And so the seller can agree to pay up to reimburse the buyer for any of these expenses listed here. Discount points is one of them. So if the seller agrees to pay $10,000 for the buyer's closing costs because it's a dollar amount, the seller should not expect to get a refund, although the seller could get a refund of unused dollars. It could be that the closing cost was only $8,000 and there's a difference of $2,000. The seller should expect to get a refund of those $2,000. But the buyer might have a discount point that costs $5,000. And the buyer think, well, now this discount point is only going to cost me $3,000 because I'm going to use this extra $2,000 that ordinarily would go back to the seller to do a buy down point. So they can then try to figure out how they can spend the rest. And that is a possibility because a buy down point, a buyer can always add a buy down point, and the seller would then have to reimburse them for that buy down point. But if they choose not to, whatever's left over will go back to the lender. And some of the lenders have caps on just how much a seller can contribute. And most of the time, FHA loans, that's 6%. They can contribute up to 6%. And that has changed from what we usually recommend, which is 3%. But they can contribute up to 6% before the lender is going to come back and say, you've exceeded the credits, and the remainder of this has to be refunded to the seller, which can happen sometimes. The seller may contribute to the buyer's closing costs and other prepaids. True closing costs or prepaids should be written in the blank in paragraph 12A1B and must be the lender's guidelines for maximum contributions. We should be having a conversation with the lender about how much to put here. The buyer and the lender should have a conversation here about if the buyer doesn't have sufficient funds and they need the closing costs paid, we can estimate and use the rule of thumb, but I think that the lender is the one that should be figuring this out, not us as agents. But I think most of the time the agent will say, well, okay, it's a $300,000 property, so let's just go ahead and ask for $9,000 in closing costs, and that should be enough. If you want to know what the actual number is, again, go to the lender. We've got 10 more minutes. The next thing they want us to talk about is a condominium. Paragraph 12 of the residential condominium contract calls for the buyer to pay for any association fees up to a specified amount to transfer the property, with the seller paying any excess. That is addressed in our HOA addendum. So paragraph 12 is slightly different in the condo addendum because the HOA addendum is embedded into the condo contract. And so paragraph 12 changes slightly on the condo contract because of the inclusion of the HOA addendum into the contract. This is a much longer form. So what we're going to do is we're going to go ahead and go to lunch now because I'm not going to start talking about third-party financing and then leave. Let's come, it's 12:21, so you're going to get 9 extra minutes. We'll come back at 1 o'clock after break, and then we're going to go all the way through every line of 1901 third-party financing, and we're going to read every word of it. So again, it's 12:21. I'll see you guys back at 1 o'clock, and I'll miss 1 o'clock, 1:01 to be exact. Any big takeaways from the first half of today's class? Let's do a little bit of sharing here. Tina, what was your big takeaway from the first half? Anything that stuck out at you?
Sorry. I think the Texas Veteran Land Board one stuck out to me just because I didn't know that we had that they could buy, you said raw land and then build on it with 0% down.
Mm-hmm. Yep, that's a big one. Good, thank you. Isolde.
Yes. Hi.
Hi, how are you?
Good. How are you all?
I'm wonderful, thank you.
Yes, I thought I would stop by at least to this is just the time that I had free, and I'm looking forward to hear whatever I can learn always.
Well, welcome. It's good to see you.
Thank you. You too.
Meg, anything stand out at you from the first half?
Yes, I didn't realize that the third-party financing addendum and then the amount financed in the 1 to 4 family contract can be different. That was a little eye-opening to me.
Mm-hmm. Yep, but we can't use it as an appraisal contingency. It has to be rooted in fact. Exactly right. Candy. You're like, oh no, you called on me. Look at that look of surprise.
Oh no. The energy efficient mortgages.
Okay.
That was pretty cool.
It
I
is
didn't know
cool
about
and
that.
it's very well there's a use case for that in Austin, Texas. Maybe not maybe some of the other metros, but Austin is known for energy efficient homes, and so there's a lot going on here regarding that. So thank you. Mary Beth,
Yes.
any standouts, anything interesting from the first part of today?
Yeah, one little nugget that I actually enjoyed was early on when you talked about the NMLS number that, I always call the lenders and talk to them when I have offers to know, but I forgot that I knew that you could look them up and see how long they've been in business or, where they work or if they're their own broker, because that tells me if they're a broker that they're going to broker it out, which means they're probably not fully underwriting whoever it is. And so, because I do know some lenders who will fully underwrite, which means they're fully qualified before they ever make an offer on something versus just being conditionally pre-approved. So
Yep.
I liked that reminder. So thank you.
Nice. Excellent. Well, thank you. Anybody else want to go? Gavin, Kelly, Suman, Rosemary, Chris.
I'll
Anybody
go.
else? Gavin.
There was a lot of useful information, but I would say learning the different type of loans and the qualifications for those loans.
That's definitely important on this when your boots are on the ground talking with clients, having a good understanding of lending. It's also the more that you understand these is also going to help you be able to, um, when you're dealing with lenders, strategize about trying to overcome problems with a solution and throwing them ideas. A big part of my value proposition, I think, is working with the lenders and helping them come up with a solution to problems. And typically your biggest issues in real estate have to do with lending, and being able to work with the lenders and throw solutions out there is very important because I'll tell you, a lot of lenders are new. I learned something in about 2009. I was working with a lender, and the lender that I worked with was someone that we know pretty well at this company. He's kind of retired at this point, but his daughter got into the business, and I used her as my lender because she was a preferred lender. And she had told my clients that there were some medical stuff that they had on their credit report. And I said, I thought medical didn't count. And she said, well, medical doesn't count, but the problem is the medical is in dispute. And because the medical is in dispute, it does matter because if there's any disputes. And so they were trying to get the dispute resolved, but it was becoming more and more difficult to get the dispute removed. And that's what was being asked of the clients. And these are clients that were actually friends of mine. And I had faith in this lender, and they ended up going to DR Horton, and the DR Horton person said, no, that doesn't sound right at all, qualified them for a brand new home, and they closed on it. And the lender was wrong. The fact that the medical was in dispute didn't matter. They didn't understand the guidelines, what they were looking at. And I walked away from that experience not trusting lenders, at least not trusting with my transaction. And when I hear a problem, guess what I do? I call somebody else that I trust and I say, hey, I want you to open up the guidelines and pretend like I'm stupid and tell me what I'm looking at here and explain it to me so I understand. Because if I can't explain it to somebody else, it means I don't understand it. So explain it to me so I can understand it well enough to explain it to somebody else. And so every time there's a problem, I make sure that I get a couple of different people and read the guidelines myself so that I understand what it says. So I will never find myself in that situation again. And I found myself in that situation dozens and dozens of times since, where a lender told me something that turned out not to be true and we were to close a transaction. Another example was I was closing a transaction. It was actually an agent here, had two condos in a brand new converted apartment complex converted to condos. And they were old apartment complexes from the 1960s. And someone bought it, gutted them, and turned them into condos. And the amenity center hadn't been built out yet. And the first one had already sold cash. And my client, or one of our agents, who left the business in the middle of this transaction, and I was left to close them, the buyer got to the closing table and was told that because the amenity center hadn't been built out, that they couldn't close on the transaction, and that the fact that that there was no um, predating certification of occupancy for the original apartment complex was at the time was in the ETJ, and in the 60s they didn't actually have certification of occupancy, so there wasn't one filed, that they couldn't close this loan. And I was able to close the loan by doing a little bit of digging and finding out that they were, in fact, wrong with the guidelines. So we have to always call the lender. What problems are you facing? What issue do you have? And then be working on getting to know what that issue is, understand it very well, and make sure that when somebody calls you, like the listing agent or the buyer agent, depending on what side of the transaction you're on, you can explain it, you understand what the hurdles are, and you will be able to help them overcome it. So we're not a lender, we're not going to get in their lane. But when a problem comes in, it's I think up to us to know enough about it to make sure that we're working with the right person. Lots of hands here. That's okay. Rosemary, hi. Rosemary,
I was
maybe.
glad to hear about your viewpoint about norms, because for the last 20 years, I've been hearing such horrible things about them, and that, nobody really wants to take one on. So I'm glad you kind of explained it a little bit more specifically so I could understand it better.
Yeah, I think that the arms there's definitely a use for them. But there's an impractical
Were you
use.
able to hear me?
Yep. Yeah, I was able to hear you. I think there was a little bit of a delay, but I was able to hear you. And I think there is a lot of confusion, and arms really did get a bad rap because people were using them for the wrong thing. So thank you for sharing. I appreciate it. Okay, so make sure that we know what the lender is facing in a transaction, having a good detailed conversation with them to figure out what it is and understand whether or not they have in-house underwriting or not.
You're welcome. And just so you're aware,
There's a delay, Rosemary. A significant delay.
I was
Actually.
gonna say, just so you're aware, I wouldn't mind reading it all, but my screen is blurry and it's not clear at all, so I can't see it. So I'm taking notes and listening to you.
Okay. I'm hopefully you can follow along by having the PDF. The PDF I'm going to put back in our chat again. I sent it out in an email yesterday. It's also in our library, our calendar, and as well in the chat. So if you download it from the chat, you can go to page 41 and follow along in the book. That way you can see it. Thank you for letting us know.
Okay, thanks.
You're welcome. All right, so look, there's a big difference between in-house underwriting and not, and I think that it's another thing that you should be maybe even pre-qualifying your lenders, determine whether or not you're going to use them or not, to find out if they have in-house underwriting. A friend of ours,
Thank you.
Avis Wukash, has a saying that she likes to say. Her favorite saying is, "Always use a lender that you can find and choke." That's her favorite saying. And I totally get it. What she's saying is that, you know, first you want to use a local lender, somebody who is not going to hide from you. If they're behind a 12-digit number at Chase and they work Monday through Friday and they have holidays off and weekends off, and sometimes they even quit in the middle of a transaction and you get assigned to somebody else and don't even know that they quit and it was 2 weeks later and you just keep calling and getting their voicemail, but nobody answering the phone. Those are the realities about using some of the large behind a phone number and a 5-digit number, extension number kind of lender. Rocket Mortgage, all of these. Having a relationship with a lender that is going to understand your 12 to 14 day business day closings. You know, maybe it's 30 days, but really between, you know, all things considered, there's 14 business days in a traditional closing. That's fast track, which means the lender has to be working in the evenings and working on the weekends and taking a vested interest in getting this closed. And your traditional employee at a large institution is going to care about your deadline. They're going to close it on their timeline. And if you get to the end and it's not closed, it's not their fault. You can leave them as many nasty messages as you want on their voicemail, and they're going to call you back on their cycle. So it's better then for you to have a lender that's local, but it also matters if that lender who's local has in-house underwriting, because I can walk into my branch office here at Wells Fargo and sit down with a mortgage loan officer and have a conversation with them, but they have an in-house underwriter that's in another state. And the underwriter has a very important role to play in lending. Their job is to ensure that the lender is protected, that the originator and the processor has made sure that this loan that they're packaging is sellable on the secondary market, that loan is properly packaged. And so the lender, the loan originator, and the loan and the underwriter, they're at war with each other, doing a completely different thing. The loan officer is looking for any way possible to close this loan, and the underwriter is looking for any reason possible to decline the loan. So by very nature, they're at war with each other. They're not on the same team. And so knowing that, a lot of communication has to happen between those two people that's productive, because when the underwriter says no and the loan officer says, well, I need you to look at this guideline because the guideline says this thing over here. And there are some times that you have very specific situations where there's an unusual situation, and that happens, and every loan seems to be an unusual situation that creeps up in every type of loan. That your really good loan officer, and I'm going to call out Michelle Iconin because this is something that she does really, really well, is that she memorizes and knows the underwriting guidelines. And when there is an issue, she is a self-proclaimed underwriting nerd. And she goes through and looks at the underwriting guidelines nerd to make sure that she can understand what's going on and then pitch her case to the underwriter. And if that has been happening via email, a lot will be missed. And there are some institutions where they're in a different time zone. They're only accessible once a week. and they're only accessible via email and they can't even have a conversation. And so for a lender to be able to get up out of their desk and walk into the underwriter and say, hey, this is what I need you to hear, and have a productive conversation will go a long way to making sure that the buyer is closed, that you get out of underwriting quickly, that you get the clear to close quickly, that and then even at the funding table, there will always be issues going on where something will come up and the docs are dated the wrong date, or there's something, a missing piece of paper in the docs, or there's a missing signature, and you need the closer, the underwriter, and the loan officer and the bank people all working together to give you new docs to fund the loan, and you're having a problem at closing and no one's responding, and 5 hours later you fund, when in fact using someone who has a smaller a team that's more accessible would be able to get that thing closed quicker. So the lenders that we have here that we use all have these things in common. Otherwise, they wouldn't be here. I asked the questions: in-house underwriting, overlays with VA, and do you table fund, and all the questions. So these are questions, and you're not required to use the lenders that we have as our preferred lenders. But if you're using an outside lender, you should ask these things. And guess what? When you're the listing agent, you're going to get served a lender. It's not going to be your choice of what lender you're using when you're the listing agent. So you need to know what you're up against. If you're in a multiple offer situation or just in a regular one seller, one buyer, you still need to ask uh, this buyer agent the questions. Do you have a pre-qualification letter? Yes, great. Now I'm going to call the lender. Is the down payment in liquid funds and in their name? Yes, great. Have you got these people under underwriting approval? Yes, no, fine. Have you sourced the down payment? Do you have buyer approval? Where are you with these people? How are they marginally qualified or very well qualified? What are the biggest issues you expect in this loan? And then call your seller. All right, talk to the lender. From my analysis and from my understanding, this should be a pretty easy go based on what I've been told with the lender. Can't guarantee it, but no warning signs yet. Kind of conversation. Okay. So that last list that we talked about of questions to ask a lender is an important one. And they even gave you a form for it. Way back here somewhere. I guess I lost it. Did I just fly through a flyer? I guess it was chapter 3. This one, how to choose a lender. We have embedded this into our buyer rep agreement, or buyer form, not buyer rep agreement, but our buyer packet. This is from Texas Realtors. We've expanded on this, but you should have a set of interview questions that you ask a lender when you're a listing agent, and then when you're representing a buyer, talking to them about what type of lender you recommend that they hire, and then knowing what questions to ask. All right, so we talked about the 1901, or we talked about our Trek 1 to 4 family. Now we're going to jump into the 1901 third-party financing addendum. This is the one form, I think, that most people struggle with the most in real estate. So we're going to go through this entire form. We've got plenty of time to take a slow roll through this, and we're actually going to be taking a pretty slow roll through the rest of this day because we've got just enough time right now to get through it. So, okay, let's jump in. First of all, paragraph 1. Paragraph 1 is the actual paragraph of paragraph 1 itself is a very important statement. And sometimes we just read the title and jump onto the paragraph 1A conventional or the loan type. But I want you to read the text in paragraph 1 because there's some very important information in here. And it's what could put a buyer in breach. It's called the spirit of the agreement is written into this paragraph 1, where it says the type of financing and a duty to apply and obtain approval. And so this form is a contingency. The buyer is simply asking the seller to be able to safeguard their own earnest money and to provide timelines so that they can, in certain circumstances, be able to protect their earnest money. Some of this falls into federal law, where the federal law says, notwithstanding any other provision, the buyer cannot suffer forfeiture of earnest money. That's federal law. We're going to get into that in a paragraph 2 in a moment, but some of this is in federal law and some of this is part of the agreement that's signed between parties right now. And this says the buyer shall apply promptly. Shall is a requirement. Buyers shall apply promptly for all financing described below and make every reasonable effort to obtain approval for the financing, including but not limited to furnishing all the information and the documents required by the buyer's lender. So when you call the lender as a listing agent and ask them, how are things going? Is there anything I can do to help you? Well, things are going okay, but I've asked the buyer for page 3 of the Wells Fargo bank statement of August 2024 6 times and I haven't gotten it back yet. Now they're mad at me because I asked for it 3 times. There's a reason that usually happens. And I think that when an agent doesn't understand what's happening in the background and then they hear a buyer's level of frustration with a lender because the lender asked for a bank statement, the buyer kept sending a bank statement, but someone didn't approve it and there was a reason why. So having a good processor is very, very important because the processor works in conjunction with the loan originator. The loan originator has the introductory call with the client, builds a relationship, says, I want to work with you. We're going to do everything we can to get this loan approved for you. And we're going to, jump through hoops to make sure it happens. But then they hand the file over to a processor. And the processor's number one job is to collect all the documentation from the borrower. That's what the lenders call their buyer, the borrower. And now they're asking for statements of bank statements, credit card statements, tax returns, all the things. And there's a long checklist. And they have a system. And their system is not unlike our rooms system where there's a label for every document. They have a label for every document too. Bank statements, whatever. And there's a label for a specific one. And they have a processor that's going through and looking at every single bank statement. And every bank statement has to have all 4 corners. If there's a page folded in, not going to work. And if it says page 7 out of 7 and they get to 6 out of 7 and there's no last page, they can't accept it. And the borrower sometimes doesn't send page 7 because page 7 had printed in big letters, this page is intentionally left blank. So the buyer says, well, I don't need to send him that. That's ridiculous. But in fact, they have to receive it. And if the processor is just very much, a blue personality, likes lists, but not very much yellow, and they're just going down the line and they're just doing their job of yes, no, then an email is going to get sent to the buyer saying that, we request this document. They send it again. Nope, we request the document again. You didn't send the whole thing. And the buyer says, I sent it 3 times. And then they tell their agents, I sent it 3 times. And their frustration is 9 out of 10 right now. And they're ready to fire the lender because nobody bothered to call them up and saying, hey, there was a fold on page 3. It covered the page number and that's not allowed by FHA. Or page 6 of 7 was missing or 7 of 7 was missing from the document. Well, this is why I didn't send it. I understand, but FHA guidelines require all 7 pages be sent and we can't accept it until it is. Answering that piece of question or giving them that piece of information would then result in them doing something differently next time instead of just going to their sent items and clicking resend, sending the same one over and over again because they didn't know that there was a thing about it that was wrong. So us agents, when we call the lender, we're asking them questions. How can I help you? What do you need from me? What documents are outstanding? And you learn that piece of information as the listing agent. Then we call the buyer agent. Hey, I just spoke to the lender and they've been trying to get a bank statement from the buyer for a couple of weeks. At this point, this actually could cause a delay in the transaction. I need you to call the buyer and I need you to make sure you get that solved. And can you follow up with me when that's done? I want to do everything I can to help you guys move this thing along. That is a productive conversation for 2 agents to have. Respectfully, calm, polite, respectful, all the things. But if paragraph 1 turns to be false, where the buyer hasn't made every reasonable effort to obtain approval for the financing, including furnishing all the information and documents required by the lender, then the buyer can go into breach. And if the buyer goes into breach, they may have breached the contingency that they asked for because the breach puts the contingencies at risk. So the spirit of the paragraph 1 is important to outline. Then in paragraph 1, it talks about conventional financing. You're going to see that there's a place here for a first and a second. Do you remember that 80-15-5 loan or the 80-10-10 loan we talked about? An 80 first, 10% second, and that third portion was a 10% down payment. Here, you would put an 80% first and a 10% second. And that's why this exists. And you'll notice that you don't have that for FHA. Why? Because FHA doesn't have first and second program. Conventional loans do. So this is, or you could do a FHA first and a conventional second, but your second is not going to be FHA insured, and your VA, your second is also not going to be VA insured because they have to be primary lien situations, not secondary. So all liens would be a secondary lien. So you can have an FHA loan here and then click off A and click off second without a first. That's possible. I've seen that before. Unusual. Obviously, you're trying to solve a specific problem by doing that. But in any case, these can all be used in tandem. It's not one or the other. So how do I fill this out? I call the lender and ask them, how do I fill this out? Because it's not for me to decide what their down payment's going to be, if they've decided on a 15-year or a 30, and it's not a guess. I'm not going to just fill it out based on, what I think might happen. And if a buyer agent has not spoken to the lender at all before submitting an offer, how in the world did they fill out the third party in the first place? We're not supposed to make guesses. Again, with this being a contingency where the buyer is looking to safeguard the earnest money for the buyer and make sure that they have specific time frames that they need in order to close a transaction, the lender should have been involved from the beginning. That means asking the lender, how much time do you need for us to be able to put the date in paragraph 9, which is closing? How much time do you need to close this transaction so that they can help pick the close date, and then they can help you fill out these fields so that you know what the buyer's loan estimate's going to be and the interest rate, all the things, and have them help you fill this out. And if you can't get a hold of your lender and the lender's not answering, go to NMLS, find their branch manager, and say, hey, I really need help. I know she's out right now, but I need help from one of you guys. And have the branch manager help, or call the processor, or call somebody else. But if the buyer's got to put in an offer, sometimes we will have a scenario where we will reach out to a lender and we'll get a pre-qualification letter. And then you're doing house hunting. And 3 weeks later, you finally find the house. And during those 3 weeks, you haven't spoken much with the lender. And all of a sudden, you find out they went on vacation at the worst time possible. So what are you going to do? You got to be in contact with somebody else who's going to take over their file and help work this. Now, lenders are like us. Mary Beth does most of her business from the beaches of Belize, apparently. And that is no different than a lender, right? If they're out somewhere, then they're going to have to do their business from the beach of wherever they are. And so a lot of work gets done, productive work goes on, and that's not a bad view to be negotiating a contract. But just make sure you get a hold of your lenders. All right, so that's paragraph 1. In paragraph 2, again, conventional financing for your first and second, your Texas veteran loan. Remember when we talked about VA, but then Texas has its own loan? That's what this paragraph B is right here. The Texas Veteran Land Board, which is a zero down land program, or if they're going to use this in conjunction with the VA to get a better rate. Then we have our FHA insured. This is going to change. This FHA insured section is going to change based on if it's a condo, if it is a 1 to 4 family, or if it's a rehab loan, 203B, 203K, or the 236C. It's going to be different. You need to have it written down somewhere so you know how to properly fill out this as well. And again, the rest of the stuff lender is going to help you with. Our VA loans are here. USDA. So a USDA is typically it can be typically a governmental backed program. There are some USDAs that are bond programs that are conventional, but most of them are not. Most of them are underwritten. But these are typically rural loans. The U.S. Texas Department of Agriculture, all USDA loans are underneath the Texas Department of Agriculture because these are rural loans. You go out past Taylor, where they're considered rural areas, and they have these special zero down programs that will help people finance and spur the economy in some of these rural areas. And we have a lot of them. Interesting. Elgin used to be one. They're not. Hutto used to be one. They're not. We used to do USDA loans in Hutto all the time, every day. But Hutto grew up, and it's no longer a USDA guaranteed area as its city has grown. So those lines get pushed further and further back, but these loans are there to help people with zero downs. Then we have reverse mortgage financing. A lot of agents forget that someone can buy a home with reverse financing, which is very cool. They can move their cash, they can sell a property, boom, cash, throw the property and take all of that cash and move it into the new property and pay it off, and then pay them every single month forever. Or even with a down payment, they can refinance, or they can buy a home using reverse mortgage financing. So I teach a class on that specifically. We're not going to get too much into that. The SRES, Senior Real Estate Specialist class I teach, gets very much into the reverse mortgage and how those works, as well as intestate sales and all the rest. And then other financing. What if we've spoken about all the rest, what could possibly be other financing?
Usually hard money loans. Isn't that where people say that they're going to be cash, but it's really a hard money loan?
Absolutely. Oftentimes you're going to find out that under other circumstances, it was first party financing. And it was truly a hard money loan. And sometimes it's not going to have a security against the property as collateral. It's something different. But even if it does or does not, this is not a conventional loan. And it is not a cash transaction. And people were writing those up as cash transactions, but they didn't have the money in their pocket. They didn't have it liquid. And it was unclear on what it would take for that third party to fund that loan. And because there was no other option, the hard money loans were being written up as cash, and then they were getting to the closing table and they couldn't close because whoever was funding that cash transaction chose against funding it. So when we have a cash transaction, it should be assumed that when the offer comes in, that they have that in the liquid funds, and then you're going to go back and ask for verification, and you're going to ask for a bank availability letter from a personal banker showing that the funds are meet or exceed the contract price, or a copy of a bank statement or a copy of an online bank statement. Any of those things are okay, but it must have the name of the account holder, and it must match exactly as to what it says in paragraph 1. Sometimes grandma is the one giving the money, and she showed, there's a copy of the bank statement, and grandma passes away and goes intestate, and that money's frozen, or she changes her mind. So again, if you don't have the cash liquid, then the seller probably should pause until they accept that offer, until that they can show them they actually have the cash to be able to close the loan and not go under contract with this buyer. Because if the seller goes under contract with this buyer based on a verbal promise that they have the money, they're stuck with this buyer and they do not have an out. And now this buyer is going to spend every single day of this closing date trying to figure out how they can find the money. And it probably won't happen. It's going to waste the seller's time. Or it may happen, but at least the seller should be advised, look, we don't have proof of funds yet. So typically best practice for us is to wait for we have proof of funds before you sign a contract. But it's your call. It's not for us to decide. But this is what would protect you, because our job is to limit your liability. And then them say, yeah, let's wait. Got it. And then wait. And so thankfully, we now have other financing for the situation where someone is saying that they don't have the proof of funds, or the proof of funds is in someone else's name. And then if that's the case, then you get a pre-qualification letter or some type of letter statement from that third party that they are going to in fact fund this loan, get the third party signed here, and then the seller and buyer agree to the contract based on this. So this is paragraph 1, the spirit of the third-party financing contingency and the different types of loans. This is more of a disclosure than anything, because the protections that the buyer gets is not in paragraph 1. The protections that the buyer is asking for exist in paragraph 2 and paragraph 4. They do not exist in paragraph 1. So I get this question a lot, and this happens all the time. Maybe even happened to you in a transaction where maybe the seller agreed to FHA and the buyer got declined for FHA. And or do it the other way around. The seller and buyer agreed to conventional financing. And then the buyer was declined for conventional and they're going to try to go for FHA, or either way, whichever way you want to flip it. And can the buyer move forward in the new financing type, or is the contract going to fall apart because they're trying a different way? When we go back and remember what this form it was written for, it was to give the buyer contingency. And that's all. It is a contingency to the buyer, protecting their earnest money. If the buyer tries to go a different route, it's the question is now whether or not their earnest money is going to be protected or not, going this different route. According to Trek and Texas Realtors articles they have posted, if you get halfway through and midstream and you switch financing midstream, which is exactly the language in the article from Texas Realtors, it's okay. The buyer has the right to try to figure out whichever way to get this thing approved, and they don't need the seller to sign an amendment to try to go a different route, unless the buyer requires that the seller provide them a new contingency on the new type. And if the seller doesn't agree to it, then they have the right to exit the contract, get their money back, and move on. But if the buyer is willing to take the risk and wants to take the risk, sometimes it's Mr. and Mrs. Seller, we want you to sign this amendment because we're going to switch financing types because it never hurts to ask. The seller says no, and the buyer says, fine, I'm going to continue on trying. And the seller has no right to terminate the contract. They can scream, yell, and pout and pound their foot on the floor, but nothing's going to change the fact that the buyer has the right to try to get their financing in order. I've had agents in the past sign a termination because the seller refused to change the financing type. And they threw the transaction away. Because the buyer wanted to go forward, but the agent thought that it was required. So it's so important to understand that there's no protections for the buyer in paragraph 1. There's some protections for the seller, talking about what the spirit of this agreement is. But remember, the buyer has the right to try to figure out how to buy this home all the way to the closing table before they can be tossed aside and the seller sell the home to somebody else, unless they mutually agree to terminate the contract in some type of amendment to terminate or termination notice. Okay, paragraph 2. Paragraph 2 is approval of the financing. Do you remember earlier we talked about buyer approval and that we had a pre-approval versus a pre-qualification letter? It's called a conditional approval. So you have conditional approval and you have conditional qualification, pre-qual. The difference between those two is whether or not the buyer has been ran through underwriting and had their 3 things verified: their assets, their income, and their credit history. And where did I come up with those 3? Right here, written on this form. Everything that the buyer and seller agree to is in the 4 corners of the contract. The buyer's asking for a contingency here to protect their earnest money. Under here, there's a checkbox under 2A, and there's a checkbox under this section here. But guess where there's not a checkbox? There's not a checkbox to waive because you have this checkbox here. This contract is not subject to buyer obtaining buyer approval. Under paragraph A, the buyer can either make the contract subject to the buyer being approved, and the lender now is going to look at the buyer's assets, their income, and their credit history to determine whether or not the buyer is going to be approved based on their willingness and their ability. And then remember what the third one was? The third one was collateral. So this is the collateral. And the only way that the lender is going to know if the collateral is sufficient collateral for the loan is to order an appraisal and get the appraisal back. So there's no way for us to waive it. It has to happen. So Paragraph A. This contract, if they check this off here, if they have a pre-qualification letter, then the buyer, when they are submitting this offer, they can check off this checkbox that says the contract isn't even subject to the buyer being approved. It's all subject to the property because they've already been run through underwriting. And you shouldn't ever take a guess on this. You should ask the lender, do we have buyer approval? Can I check off this box in the third party financing? And the lender will say yes or no. But there's a significant difference in the two. If you check off this box, don't make an assumption that the listing agent is going to see it or understand what you've done. Why? The dramatic pause. All right. I want to make sure that we are all following along as best as possible. When you're submitting an offer for your client and you have your client pre-approved, meaning that buyer has already gone through pre-approval, and you check this box that says this contract is not subject to buyer approval. If you check this off, you had better call the listing agent and tell them what you've done because they may not see it or they may not understand it. This is a very big deal because the contract, they're not going to be worried about buyer's assets, income, and credit history anymore. And that's usually what stops a buyer from getting financing. It's usually not anything to do with the property. It usually has to do with the buyer themselves. And a pre-qualification letter is just FICO score, how much do you make in income? Great, we're done. Then they find out later that, oh, I told you my income with my bonus and my extra tips and overtime. And so now my income is $1,500, not $6,000 a month. And lender's like, wow, I wish I'd known that before. Well, so would the listing agent, which is why they want you to send these people through underwriting and have underwriting approval for the buyer in the first place. So this means that you have underwriting approval for the buyer, and now it's quote unquote subject to. Subject to what? Subject to having an appraisal to determine whether the property is sufficient collateral for the loan. So we're going to read this paragraph. The contract, this amendment, or this addendum, this third-party financing addendum makes the contract subject to buyer obtaining buyer approval if this box is checked. If buyer cannot obtain buyer approval, buyer may terminate this contract within X amount of days. I see anything from 15 to 21. 18 is a number I see in here a lot. But again, I think a good conversation with the lender, find out what the lender wants to put in here because it could be depicting on the month and what day you are and how many weekends and holidays are in between. Within X amount of days after the effective date of the contract by giving seller number 1 notice of termination and 2 a copy of a written statement from the lender setting forth the reason for the lender's determination. If buyer terminates this contract under this provision, the contract will terminate and the earnest money will be refunded to the buyer. If buyer does not terminate the contract under paragraph 2A, this paragraph, the contract shall no longer be subject to buyer obtaining buyer approval. Buyer approval will be deemed to have been obtained when the terms of the loans described above are available and lender determines that the buyer has satisfied all of their requirements related to the buyer's assets, income, and credit history. So buyer's asking for the seller, I want you to take a chance on me. I don't know if I'm going to be approved, and neither does the lender, but we're going to take 18 of your days on market to figure that out. So this is a very important part of the contract. Or again, they've got a pre-approval letter. They check off that the buyer's already been approved, and now it's just subject to. And now the subject to talks about the property, and it also has 3 things. You have 3 things that the buyer needs, which is the lender is going to look at the buyer to determine, which is the assets, income, and credit history. And on the property side, they are looking for the appraisal, insurability, and lender required repairs. Those are the 3 things that the lender is looking for. And insurability would be FHA insured. Will FHA insure this property or will VA insure this property? So let's read it. Property approval. If buyer's lender determines that the property does not satisfy lender's underwriting requirements for the loan, including but not limited to the appraisal, insurability, and lender required repairs. Again, insurability here, sometimes people think insurability has to do with hazard insurance. Well, that's one of the insurances, but the real insurance that they're talking about here is the FHA insured property. Can FHA insure this property? And lender required repairs. And lender required repairs comes from notes that the appraiser will add to the appraisal. And so any kind of field notes added to the appraiser usually have to be solved in one way or another. Buyer may terminate this contract on or before the third day before close date by giving the seller notice of termination, copy of a written statement from the lender setting forth why the lender said no, and if the buyer terminates under this paragraph, the earnest money will be refunded to the buyer. If buyer does not terminate under this paragraph, property approval is deemed to have been obtained. And by the way, there's no number of days here. This is completely open. This doesn't fall under the buyer approval, which has a certain amount of days in it. This property approval is 3 days before closing. Okay. Now, security. We talked about the three-part instrument. We've got a lender, we have a borrower, and then we have a security instrument that's going to be the third party, who is going to be the one that's going to be doing foreclosures on the property if it goes there. But if required by the buyer's lender, each note for the financing described above must be secured by vendor's deed of trust liens. So the liens, whatever loan type, they're agreeing that there's going to be a subordination of the loans on the deed showing which order they're going to go. And the security interest, by the way, is there to protect the lender in this agreement. So the lender feels good about this agreement because the parties agreed to this. So the lender wants to see the security, not the buyer, not the agent, but that's there. So they can agree to protect this third party lender. Now, paragraph 4, this overrides everything. This overrides everything because there's a federal law that is out there that says that for a VA or an FHA loan, if it doesn't appraise, the buyer gets their earnest money back. Period. End of story. Done. If the property doesn't appraise, the buyer has the right to call it quits and get their earnest money back. Period. End of story. Done. But the buyer doesn't have to execute their right. Just because they have a right doesn't mean they have to. So let's say you have a $300,000 property and it appraises for $295,000. What's our problem there? Who's going to lead the class in discussion on this one?
It's 5,000 below of the offer price.
Okay, so we have a $5,000 appraisal shortage. So if we have an appraisal shortage, what are the buyer's rights on an FHA or VA loan?
They can terminate the contract, but they don't have to.
Exactly right. Now they've got really 3 big options. They can call it quits. They can come up with the $5,000 themselves, or they can ask the seller to, or I guess in between, work it out somewhere in between. So those are the real options that they have. They can just say, nope, I'm done. I don't really care. And that ability to terminate the contract is called leverage. It gives them leverage to negotiate this thing. Now, it's important that we understand that in a cash contract, the amount they agree to in paragraph 3 is it. They have to, if they want to order an appraisal before they order a contract, fine. But they must really trust their buyer agent because that buyer agent needs to give them a very sound CMA because they have no protections over their earnest money. And if they later do an appraisal, it's not a lender's appraisal, it's a buyer's appraisal. It has no effect on the contract whatsoever. It's FYI. And if it appraises for $100,000 less than what they bought it for, well, guess what? That's on the buyer. Unless the seller somehow lied. For instance, the square footage was off by 600 square feet. There might be a DTPA claim, Deceptive Trade Practices Act claim. But normal situation, there was no, material fact issue, and the buyer just, found out later that it was a $20,000 difference and they want out. They don't get an out if they're paying cash. But like Gavin said, if it's FHA or VA and it appraises for less, then they have the right to walk away. And that's called leverage. And the VA loan and the FHA loan, you're stuck to the property for a while. 30 days, 60 days, 90 days. And right now it's 90 days. So if an FHA client pulls an appraisal and it appraises for less and they terminate and another buyer comes along also doing FHA, that case number is going to still be in the federal government's case system, and that appraisal is going to be the one that they use. They're going to use the same appraisal that the last person had. So that means it's leverage for the seller. The listing agent needs to know this because the listing agent might be thinking, let's just make these people go away and the next FHA loan will be better. But that's not the case because the next FHA loan is stuck to this property because they'd only use the first one if it's within 90 days. So there's not going to be a new appraisal. It's going to be the appraisal that the buyer terminated over. So it's to the seller's benefit to work with this buyer to make sure that they don't walk away. But the seller doesn't have to come down and the buyer doesn't have to bring money to the table. So it becomes a negotiation between the parties to figure out how we're going to all work together to get this thing to the closing table. I have seen situations where they split it. I've seen situations where the seller came down all the way, and I've seen situations where buyers have paid the entire amount. A lot of that has to do with what kind of market you're in. But it also might have to do whether or not there's a backup offer or not. So it has to do with the situation that you're in. And if you're new to these things, this is where your mentor and your manager is going to come in very handy to help you walk through this to make sure that your client is very well protected, because we should know what our negotiation power is in a transaction. If you're a listing agent and you know you priced high and they did an appraisal and it came in low, you've been on the market for 200 days and you don't have a backup offer and you're in a buyer's market, telling this buyer that you refuse to reduce the price probably is not going to go well for the seller because they're probably going to be looking at multiple price reductions and probably will net less in the long run. So the person who's going to win is the buyer. The seller should work with the buyer to work that out because they don't have the negotiation standpoint to back up letting that buyer go away. Versus a complete opposite situation. You're in a seller's market, you got 10 offers and it doesn't appraise. Hopefully the buyer's already waived that their promise that they're not going to walk away on certain loan types. Okay, so paragraph 4, though, says, under no circumstances can a buyer lose their earnest money if it doesn't appraise. Now, there's no way for the buyer to waive it. There's going to be an appraisal, and the buyer can't say, well, I want to cross out the federal law that says that I'm not going to back out. The buyer can tell the seller, I'm not going to back out, and show them the goodwill, but at the end of the day, it's not going to happen. Now, there are some tricks of the trade. I've had situations where a buyer they had to go FHA, they were in a multiple offer situation, and they wanted to waive the appraisal contingency, but they just couldn't. And there's been situations where they just threw a gigantic option period at them. But the danger is that, what happens if there's something wrong with the property? They're going to lose that money. And there's just no ifs, ands, or buts about it. But it depends on the buying power of the buyer and what they want to do. So get your mentors involved so you know how to properly negotiate this for your client. If the financing described above involves FHA insured or VA financing, it is expressly agreed. And this expressly means that this is an express agreement. It's written and it is the highest agreement two parties can make, that notwithstanding any other provision, this means it doesn't matter what it says anywhere else. It doesn't matter if you try to use special provisions to cross these words out, if someone crossed out these words, no matter what the agents tried to do to concoct some situation that's going to change this outcome, that the purchaser shall not be obligated to complete the purchase of the property or to incur the penalty of forfeiture of their earnest money if the property doesn't appraise. Now, there are some buts here because it says, unless the buyer has been given in accordance with a HUD and FHA a written statement issued by the FHA Commissioner, Department of Veteran Affairs, or direct endorsement lender setting forth the appraised value. Basically, what they're saying here is as long as the buyer paid for an appraisal and an appraisal came back, they can't lose their appraisal contingents. They can't lose their earnest money. But they can in this scenario. The buyer moves forward in a transaction and they choose not to order the appraisal. They're outside their option and they never order the appraisal and they just want out and they think somehow this is going to save them. They had to have ordered and paid for the appraisal in order for this to kick in. So as long as they paid for the appraisal and it came in low, then they have the right to back out. If the contract purchase price or cost exceeds the reasonable value of the property established by the Department of Veteran Affairs, the 3-day notice of termination requirement in paragraph 2B doesn't even apply. So over here, we had a 3-day notice that it said that in the event that the lender determined that the property wasn't sufficient collateral for the loan, that the buyer would have to terminate at least 3 days before closing. But this says that that doesn't even apply. So the buyer can, on the closing day, 1 hour before closing, say, you know, this thing didn't appraise. I want my earnest money back. Just give it to me. And we're gonna walk away. That's what the buyer and the seller sign up for when they're handling the transaction. So the moment, though, that the buyer and the seller agree to make the contract match what the appraisal says, the buyer loses their right to terminate. So the only way the buyer could have terminated on the close date was because the seller said, no, I'm not going to work with you. If the seller signed an amendment and fixed that problem, now they can sleep at night because the buyer no longer has the right to terminate. Make sense? Okay, good. So far, I think we're doing good. All right, so here we go. A, B, and C. The buyer shall have the privilege and the option of proceeding with consummating the contract without regard to the amount of the appraised value, meaning that this says, you know, if the buyer wants to move forward, they have that right. So they've expressly put that in here. If FHA financing is involved, the appraised valuation is arrived at to determine the maximum mortgage the Department of Housing and Urban Development will insure. HUD does not warrant the value or the condition of the property. The buyer should satisfy himself or herself that the price and the condition of the property are acceptable. And then C, if VA financing is involved and the buyer elects to complete the purchase at an amount in excess of the reasonable value established by the VA. By the way, I didn't touch on this yet. An appraisal for a VA is not called an appraisal. It's called a certificate of reasonable value. And they don't call it the appraised value. They call it the reasonable value. So if the VA financing is involved and the buyer elects to complete the purchase at an amount in excess of the reasonable value established by the VA, buyer shall pay such excess amounts in cash from a source which buyer agrees to disclose to the VA. So it can't be mattress money that they pull out from the mattress. If they're going to move forward, it has to be sourced money that's in a bank account somewhere if they're going to pay out the appraised value. If VA reasonable value of the property is less than the sales price, seller may reduce the sales price to an amount equal to the VA reasonable value, and the sales price and the sale will be closed at the lower sales price with proportionate adjustments to the down payment and the loan amount. So they have put all the things in here to make sure that if you have an FHA or VA loan and the buyer ordered their appraisal and it didn't meet value, that the buyer can get out all the way to the closing date, unless the seller fixes the contract situation and reduces the price. So now it matches the appraisal. The buyer no longer has the right to get out. So you've now closed that contingency for the buyer to get out and walk away from the transaction. Because one thing is the down payment, them bringing extra money. The other thing is them terminating the contract. Two completely different things. And we definitely don't want to lose the contract. So buyer and seller need to be properly advised by their agents of what their negotiation power is in that transaction. And then number 5, and I think 5 is an important one because I ask this question in a lot of my classes. What gives the buyer's right? What gives the listing agent the right to call the buyer's lender and ask the buyer's lender about the creditworthiness of the buyer? What in the world would give them that right? Seems like there would be a lot of consumer protection laws against that. And it's the 4 corners of the contract again. Because it says here in paragraph 5A, the buyer gives permission to the title company, the lender, the agents, everyone to communicate with the buyer's lender regarding the creditworthiness of the buyer. And so that's what gives the right here. And then paragraph B says that in a cash transaction, which this would not be used, in a cash transaction, we would have to use a different form. But the closing disclosure, by its very nature, at one point was deemed confidential, and the agents wouldn't have the right to see it unless the buyer gave it to them. So the title company couldn't send the closing disclosure to the agent. So the CFPB entered a statement that said that, well, okay, we'll give it to them. And so just to forebode any confusion, it says here that seller and buyer authorize buyer's lender, the title company, and the escrow agent to disclose and furnish a copy of the closing disclosure and the settlement statement to the parties' respective brokers and sales agents provided under the broker information page, so that there is no question whether or not they're going to have access to those pieces of information. Okay, can you believe that it's been an hour since we had lunch already? My goodness. Okay, so I think that we got through the third party in an hour is astonishing. So that's awesome. We're gonna take our break. No, we're not. We came back at what? Maybe I'm wrong. We came back at 1 o'clock, right? It's 2. No, I'm right. All right, so we're gonna take our first break. We're gonna come back at 2:12, first break after lunch. And then when we get back, we're going to go through the notice of buyer's termination of contract, because this has recently changed. You'll notice this has an effective date of February 2025 because of a change that's in the third-party financing. So we're going to go read the third-party financing again, and we're going to read what changed that affected this, which is really good for buyers and their agents. All right, I'll see you guys back at 2:12. A couple of new additions to this notice of buyer's termination of contract, which also, by the way, added into the seller's termination of contract. A new one was added there as well. So let's jump right in. So if a buyer is going to exercise one of their contingencies, then they can use this form to deliver termination to the seller. This form is promulgated by TREC, which means this form is required use. I get asked the question when people bring it up to the wire, can we use a different medium like a text message? And the answer is, as long as the client was told before 5 p.m. that the termination occurred, then the termination has occurred. But if the agent and their broker was told before 5 o'clock that the termination occurred and they did not then tell their client until after 5 o'clock for an option period, we can push it to the letter of the law and we'll come out the other side and we will win if the clients want to enforce their rights. But that's the reality. So let's look at what this says, because there's a lot of ways a buyer can terminate a contract, but they have to have a contingency. And a contingency simply is a pre-built method built into the contract, constructed into its construct, the ability for a buyer to exit under certain circumstances that the seller agreed to. Some of them are built into our contract, and so based on the seller signing the contract, they agreed to it. Some of them are specific addenda that the seller had to specifically agree to outside of the 1 to 4 family contract as an addenda. If the buyer chooses to exit the contract and it not be one of these items, it's typically going to be a breach, which means the buyer failed to uphold the promise that they made of purchasing the property. They have to have a reason. Now, if they don't want a reason, they have to purchase an option period, and then they can terminate for any reason inside the option period. But outside the option period, it is very much reason-based. Option period is unrestricted, but every other item is very much restricted to a specific situation. Number 1 is the unrestricted right of buyer to terminate the contract under paragraph 5 of the contract. Paragraph 5 is earnest money and termination option. This is saying that the buyer is terminating through the option period, and this is the way to correctly terminate under the option period if the buyer is going to terminate before 5 o'clock. And this should be delivered to a very specific place, because it very much matters where this was delivered to. So we're going to go and we're going to look at paragraph 21 notices. It says all notices from one party to the other must be in writing and are effective when mailed to, hand delivered at, or transmitted by fax or electronic transmission as follows. One party to the other. Agents are not parties. Agents can be good stewards of the communication, but they have to make sure it's party to party, which is why we have the email address of the parties on here. And if the parties want, a copy of it going to their agent. But it's a notice from one agent to another agent does not hold the definitions of the law of what notification is, because the four corners of the contract is very precise here. One party to the other. So if a buyer is going to terminate under any of the provisions, they have to notify the other party, often timely. So if the contingency has a time limit to it, this should be signed by the buyer, because this is a notice, and it be sent to whatever it says in paragraph 21. So, hello, Mr. and Mrs. Seller and listing agent. Hello, Mr. and Mrs. Smith and Tom. And the two would be the seller and Tom. And CC would be your contract coordinator or the title company or others, letting them know this is now dead as of this time, and that becomes a timestamp. And you can even put in the email. Client is terminating the contract. Today is September 8th at 2:21. And even put that in the body of the email to make it very clear. This is done, and this is notification of it. So the first one, option period. Second one, the buyer cannot obtain buyer approval in accordance with a third-party financing addendum to the contract. Buyers delivered to the seller lender's written statement setting forth the reason for the lender's determination. So, buyer cannot obtain buyer approval. That's in 2A in our third-party financing. So let's go to 2A. Buyer approval. I'm losing my buyer approval. So in this situation, the lender declined the buyer based on the buyer's assets, income, and credit history. And it says right here that in order for the buyer to terminate, buyer may terminate this contract within X amount of days after the effective date by giving seller notice of termination, which is the form we just filled out, and a copy of a written statement from the lender setting forth the reasons for the lender's determination. So they have a requirement then in paragraph 2B, buyer cannot obtain buyer approval in accordance with a third-party financing addendum to the contract. Buyer has delivered to the seller lender's written statement setting forth the reason for the lender's determination. So in the third-party financing, one of the buyer's contingencies, one of theirs out was 2A, which is right here, which is 1/8 of this form. How do you make that go away? Well, by checking off this box. The contract is not subject to buyer obtaining buyer approval if the lender's given them a pre-approval. Third item, the property does not satisfy the property approval. This is now 2B. Property approval in accordance with the third-party financing addendum to the contract. Buyer has delivered to the seller lender's written statement setting forth why the lender didn't approve the property based on their underwriting requirements for the loan. And remember, property approval are those three things: the underwriting requirements for the loan, not limited to insurability, lender required repairs, and appraisal. Those three things. So the lender didn't approve the property. Buyer was approved, maybe, but the property was not. And they're citing that the property is what was not approved. So maybe there's both 2 and 3. Unlikely it's going to be one or the other, but in any event, again, if the lender declines them, the lender has to write a decline notice. And that decline notice, they have to decline them. And once they decline a buyer, it's very difficult for them most likely they're never going to be able to approve that buyer if they decline that buyer. But property situation, no problem. The buyer can go and then buy another house. But again, this is if they're going to exercise the right under the third party, which the contingents they ask for property approval. Number 4, buyer elects to terminate under paragraph A. And you'll notice that this doesn't say elects because this wasn't the buyer's choice. The buyer was declined. Either the buyer was declined or the property was declined through the lending and it's done. But here is a choice, like the one up here was a choice. Buyer elects to terminate under paragraph A of the addendum for property subject to mandatory membership in a property owners association. And that one comes later for the HOA. Buyer elects to terminate under paragraph 7B2 of the contract relating to the seller's disclosure notice. I think that's an important one. I think that if more agents knew what this said, they would never let this happen. 7D, that's actually, did that say 6 or 7?
7B2.
Okay. All right. So in Texas, sellers of residential properties always have to provide a seller's disclosure to the buyer. And there's two scenarios here really. The property code says that the seller will give the seller disclosure to the buyer before they go under contract. It doesn't say after. It says that the seller of a 1 to 4 family home will provide the buyer a seller's disclosure substantially similar to the form that's in the property code before going under contract. So what happens if they don't? That's the question. So under over here, it says if the listing agent allowed this property to go under contract and allowed it to go under contract with 7B2 checked, it is a huge failure on that listing agent to allow this to happen because quite honestly, I'm all over the seller to start filling out the seller shield. I'm talking to him about it at my listing appointment. And I need it back often before I even get the MLS done because there's things on there that I want to see. And then I want to have it attached to the MLS documents. And then when I get an offer, I'm going to respond to it with the offer in an email. I'm going to take copies of it and put it at the property and put it in my binder and I'm going to put it everywhere. But in the event that you're all the way here, you've gotten to the point where you're negotiating a contract. And this could be a situation where a seller came to you and said, I have a next door neighbor that wants to buy my property and I want you to help me put this deal together. And there's not going to be an MLS or any of that. So, things like this could happen. But under our normal circumstance where we're listing a property and we're going to market it, we should have the seller's disclosure way in advance. And at this point right here, you still have the opportunity when you got the offer and the buyer agent filled it out with 7B2 checked to cross this out, check off 7B1 and send it back to them with a copy of the seller's disclosure to make sure that you're not granting them this out. Because this is a contingency that was given to the buyer that's very dangerous from a listing agent perspective. It says, buyer has not received the notice. Within X amount of days after the effective date of the contract, seller shall deliver the notice to the buyer. If the buyer does not receive the notice, buyer may terminate this contract at any time prior to the closing, and the earnest money will be refunded to the buyer. The buyer never receives an earnest money. If the buyer never receives the seller disclosure, they can get all the way to the day of closing and say, I want out. But if the seller does eventually deliver the notice between the number of days that they ask for it, buyer can terminate this contract for any reason within 7 days after the buyer received the notice. So the buyer is granted a free 7-day out. If they say, all right, well, within 5 days after the effective date, I want it, and they give it to them on day 5, you've given 14 days for the buyer to get out, long past the ending, the conclusion of the option period, mind you, way past that, and this costs absolutely nothing. So this would be a dangerous thing for a listing agent to allow, in my opinion, and this over here is talking about this. Buyer elects to terminate under 7B2 of the contract relating to the seller's disclosure notice. This would not even have been a possibility had they checked 7B1 and just given them the seller's disclosure prior to going under contract. 6, buyer elects to terminate under paragraph 3 of the addendum concerning right to terminate due to lender's appraisal. All right. So They don't have that in this book, shamefully. We are going to go and we're going to open up this can of worms. How about that? So the buyer's right to terminate due to lender's appraisal comes in 3 parts. Part 1 is a full waiver. Part 2 is a partial waiver, which means that if a conventional loan is on the third-party financing and the buyer wants to make sure that they send a strong message to the seller that if it doesn't appraise, the buyer's going to stick around and bring money to the table, which really has very few uses outside of a multiple offer situation for that particular situation. It's not going to come up that often. So, addendum concerning right to terminate due to lender's appraisal, buyer's right to terminate due to lender's appraisal. The financing described in the third-party financing addendum attached to the contract for the sale and the above referenced property does not involve FHA or VA. So remember, FHA and VA, nothing can overwrite that. If it doesn't appraise, the buyer must move forward and they cannot, that language notwithstanding any other provision, doesn't matter what it says anywhere else, including on this form, the buyer can't waive that right. They don't have to exercise the right to terminate, but they can't waive the right to terminate. So that's part of the built-in use of a VA and FHA loan. But on a conventional loan, you'll see up here, only use this form if one, third-party financing is attached and the third-party financing addendum is attached to the contract and it doesn't involve FHA or VA loans. So conventional loans only. Not cash either, by the way, because it doesn't matter what the appraisal says. This is a lender's appraisal, so there's a lending going on and it's a conventional loan. And they use the third-party financing. They've got 3 things here, and the 1 and 2, it kind of goes together. In this situation, let's say you're in a multiple offer situation and the buyer says, you know, we're under contract for 500,000. We initially were under contract, you had listed for 400, but we willingly went over by $100,000. And if it doesn't appraise, I still want to buy your home. I'm willingly bidding over, and I'm not going to fall back on my appraisal, because if I allow myself to fall back on the appraisal, you're probably going to take the other offer that might even be cash. So I'm going to contractually remove some of my obligations. So that's what this is about. Number 1 is a full waiver. No matter what it appraises for, the buyer's going to write a check for the difference because the lender's only going to lend up to the loan limit or the appraised value. And whatever difference, whatever on top of that, the buyer's going to bring in cash. Or a partial waiver. Buyer says, you know, I'm putting down 100, but I only have $50,000 left. So I'm going to give you a partial waiver. If it doesn't appraise by $50,000, I'll move forward. But if it appraises for less than $50,000 under our sales price, I can't move forward anymore. So I'm willing to kick in 50 grand and no more. That's what this would be used for. This is a paragraph 3, polar opposite, has nothing to do with paragraph 1 or 2. Paragraph 1 or 2 says we're moving forward no matter what. Paragraph 3 says, not only do I want to terminate if it doesn't appraise, but I want an additional right that the contract doesn't give me. You see, if we go back and we look at the third-party financing, that paragraph 4 that we were reading in the third party, the FHA required provision, this gave the buyer the right to terminate and get their earnest money back if it doesn't appraise. Nothing else does. Nothing guarantees on a conventional loan that the buyer can terminate. It says if the lender declines them, if insurability appraisal or lender required repairs, it says that right here. If the lender declines them because of appraisal, insurability, or lender required repairs, if they're declined for the loan, then they can get their earnest money back. But what happens if the lender's refusing to decline them because they've got the cash, they're in a perfect position to move forward, but it didn't appraise? The lender's like, you look, it didn't appraise by 5,000. You're putting $65,000 down. You only need to put $20,000 down. We can't decline you for this loan. And the buyer says, I don't want to buy this home if it doesn't appraise. The contract doesn't have that provision. It doesn't give the conventional buyer a way out. This addendum does on paragraph 3. You see, the paragraph 4 in the third party financing that says FHA or VA provision, this is the version of that for a conventional loan, hidden over here on this form called Addendum Concerning Right to Terminate Due to Lender's Appraisal. It's my opinion that if you're working with a buyer and the buyer has a conventional loan, that I would bet in this market they would be expecting that this provision actually exists. And they think somewhere in the contract it's giving them that right, and it doesn't, because nothing in the contract is. This says additional right to terminate. In addition to buyer's right to terminate under paragraph 2B of the third party financing, again, 2B is if the lender declines them, buyer may terminate the contract within 18 days, almost like the 2A, 18 days after the effective date if the appraised value in accordance the property obtained is less than, and you put the purchase price in here. So if it comes in less than the purchase price, the buyer if it doesn't appraise for the purchase price, I give you the appraisal and I get my earnest money back, giving the buyer leverage from the seller to renegotiate the price. So you probably should be using this form often when you're dealing with conventional loans, or at least having a conversation with your client about paragraph 3 here. And it's actually, we've included this now in our packet, and I have my team, our compliance department, reviewing these rooms for a conventional loan and calling the agent. The problem is it's already too late. At the point that we're going through the rooms, you've already negotiated it, and you're not going to be able to get the seller then to negotiate to give their earnest money back after the fact. So we've included it in the packet, so it's coming along for the ride. But so many people forget that this is here. Personally, I wish it was a paragraph inside the third-party financing that said conventional financing, and it be right underneath on a new paragraph 5. Under paragraph 4, FHA VA provision, it said paragraph 5 conventional loan, but it doesn't. It's over here. So we should be seeing this form used a lot more, and agents are missing it. All right, moving back. And that's what this talks about here, is that buyer elects to terminate under paragraph 3 of the addendum concerning right to terminate due to lender's appraisal. So this would be a situation, a conventional loan was used, it didn't appraise, and now they're using that form as the right to terminate because the seller refused to come down. Or maybe just sending this over, threatening to send this over will get the seller obviously to play ball with them and not. But again, at least the buyer has the leverage to terminate if it doesn't appraise. And then paragraph 6D. 6D is our objections paragraph. Could be anything from a lien or a IRS lien on the property, a encumbrance, an easement, a right-of-way issue, something to do with a cloud on title. This is all regarding that. Okay. Any questions regarding this? A lot, right? I told you, I saw your hand go up.
So I wanted to ask in that 8, what about death of a spouse or like something?
So a death of a party doesn't affect a contract. Death of a party makes the contract become an asset of the estate. So if a party dies, the estate of the party who has died now owns this asset, which is a contract negotiated with the seller at a preset price for a certain amount of time. And it's likely that it's not going to go anywhere and it's going to bust out of time, but a death of a party doesn't terminate a contract. So if a party,
Even if it's a party that is approved, like the income, the one that,
yeah,
okay.
yeah, because again, we have the right to assign contracts in the state. And so it's anybody can assign, contracts are assignable. So the contract is an asset. The buyer and the seller have agreed that the buyer can buy the property at a preset price until the close date. Just because the buyer dies doesn't terminate the contract. What it means is the contract now is its own asset. There are people who deal in these things. They'll go buy a property from somebody and then they'll go figure out who they're going to sell the property to. And then they have put together a package where they're going to sell the contract to somebody else and it's its own asset. So again, if a party dies, the contract doesn't terminate. It becomes an asset of the estate of the deceased. But arguably, number 8 can be used for a lot of different things. And I've seen 8 in here a lot. But there are the yellow book. Used to be 36 outs for a buyer, and now it's seller beware. And there's 38 of them, all different reasons why you'd want to terminate a contract. So that's this right here. You can buy it on Amazon. And we have the most common 8. But if you come through here, you will see that there's a lot more. Addendum for release of liability on assumed loan. So if they terminate due to an assumption, if they terminate due to the HOA form, if they terminate due to an issue with possession, it just goes on and on. There's hundreds of reasons why a buyer can terminate. They have the most 7 common, but all the rest of them fall under number 8, which could be a backup addendum issue, could be a contingency form termination. If you have a backup offer and they terminate due a backup, you use the same form, but now you get 8 and say due to terminating pursuant to the backup addendum. Okay. Next is 1914. You haven't lived until you've dealt with 1914, which is the seller financing addendum. The seller financing addendum can only be used if the seller owns the home free and clear. You cannot use this addendum if the property has a mortgage already on it. That's called a wrap. It's a different thing all entirely. Remember the deed that we talked about in the very first couple of minutes of the class? There's a 3-party thing in the deed. There's a borrower, a lender, and then there is a third party that's going to exercise the foreclosure, judicial foreclosure if that happens. So in a seller financing scenario, on the deed or on the note, the promissory note, there's what's called a due on sale clause that says if you sell this property, Mr. Buyer, Mr. Borrower, that the entire amount becomes accelerated and immediately due. So if they continue owning the property, they have 30-year amortization, but the moment they sell it, the entire balance becomes due. So if someone tries to do a wrap, they are trying to get around the due on sale clause, and there's a couple of small loopholes that people can try to jump through and exploit. But oftentimes it ends up putting the property in foreclosure, because if the lender finds out that you're trying to do a wrap and they respond within the right amount of time, the property goes into foreclosure and everyone loses. So wraps are dangerous. They're not allowed. Seller financing is with a seller who is not trying to sell their property to someone else and secretly convert their mortgage to someone else's name. It is free and clear, and they are going to act as a bank. In the first portions of today, we talked about that the seller can, through the SAFE Act, like the Licensing Act of Lenders, sellers can finance their own residence without being licensed as a RMLO, and they can do that up to 5 transactions in a 12-month period. So one seller can do a seller finance without being licensed, but guess what? An RMLO, residential loan originator, mortgage originator, needs to still be involved in a seller finance transaction. Because the federal law says that no seller can no buyer can face a loan that is unfair or deeply unfair, where the buyer can't purchase and maintain the actual payments. An interest rate of 10% is a point where the seller's probably going to put together a construct that's going to put the buyer in default. So they're not going to allow that. So an RMLO has to make sure that they run the credit of the buyer, to make sure that the ready, willing, and ableness of the buyer is there, make sure that the seller is not doing any predatory lending, is their term for that, and layer on top of it that the buyer has the ability, meaning the income, and that the loan is not predatory. And all the things are here. Now the seller is going to act as a lender, and they're going to move title to the buyer. They're going to become a lender, and they're going to have a promissory note, and they're going to have a deed of trust, and they're going to talk about all the things here. So we're going to go through this. First, agreements for seller finance can be completed, or agreements for seller finance can be complicated and may be subject to laws regulating loans. Consult an attorney and a financial professional before signing. Seller may have accounting or reporting obligations concerning the seller financing. TREC rules prohibit real estate brokers and agents from giving legal advice. Read this addendum carefully. Now, this was changed in November of 2022. This used to be at the bottom above the signature page, and they moved this to the top because seller finance transactions typically end up in the hands of the attorneys and everyone being sued. Because remember, seller financing usually occurs because the buyer can't obtain financing. So the seller is going to do seller financing on a buyer who is already unable to finance it on their own. And that usually means that the buyer is wobbly to start, which means a large degree of these end up in foreclosure. Credit documentation A. To establish buyer's creditworthiness, buyer shall deliver to the seller within a certain amount of days after the effective date of the contract a credit report, verification of employment, including salary, verification of funds on deposit in financial institutions, and current financial statement, and other things. The seller can require these things. But is your typical seller qualified to be able to look at a credit report and determine someone's creditworthiness? They may not see the score, but it takes more than that. So they should have an LO looking at this and advising them every step of the way. It should not be the real estate agent advising the seller as to the creditworthiness of the buyer. There should be a third party, and a loan origination fee will often be charged by the third party. One of our preferred lenders steps in and helps just give everybody advice through the transaction, and then they're paid a loan origination charge to their company. Paragraph B says buyer's credit approval. If the credit documentation described in paragraph A is not delivered within the time specified, seller can terminate the contract by giving notice to buyer at any time before all of the required credit documentation is furnished. So if there's one piece of paper missing, one document that they said that they would give that they didn't, the seller can use that as reason to terminate the contract. Maybe another offer comes in and they're looking for a way to terminate. If the credit documentation is delivered and seller determines in seller's sole discretion that buyer's credit is unacceptable, seller may terminate this contract by notice to buyer within 7 days after expiration of the time for delivery or its actual delivery, whichever is later, and the earnest money will be refunded to the buyer. So again, within this amount of days, the seller also has to determine the buyer's creditworthiness. A promissory note. The promissory note in the amount of paragraph 3B, which is going to be the 3B, included in paragraph 3B of the contract payable by buyer to the order of seller will bear interest at the interest rate of what percent? So again, it can't be predatory. So the buyer and the buyer's LO, the seller and the seller's LO is gonna have to figure out what is gonna keep them out of hot water here. Is 8% probably be fine? Is 10%? Maybe that would be considered predatory. So they got to be very careful here because they are still not exempt from the federal laws of predatory lending, but they are exempt from the federal law and the state law of being licensed. Buyer may prepay the note in whole or in part without a penalty. Any prepayments are to be applied to the payment of the installments of principal, not interest. The note will contain a provision for payment of a late fee of 5% of any installments not paid. So it's hard coded in the agreement here. Within 10 days of the date due, matured unpaid amounts will bear interest at the rate of 18% per annum or at the highest lawful rate, whichever is less. Paragraph 1, now this is going to be the promissory note. So in one payment due after the date of the note with interest payable at maturity monthly or quarterly, or in monthly installments of a dollar amount, or interest only monthly installments first month. And then, so breaking this up and whether there's going to be a lump sum or if there's going to be monthly installments, which is 99% of the time, it's going to be paragraph 2 here. And there's going to be a deed of trust. The deed of trust securing the note will provide the following. They get to check consent not required or consent required. And this is what happens if the property is sold. So consent not required, the property may be sold, conveyed, or leased without the consent of the seller, provided any subsequent buyer assume the note. B, consent required. If all or any part of the property is sold, conveyed, leased for a period longer than 3 years, leased with an option to purchase, or otherwise sold, including any contract for deed, without seller's prior written consent, which consent may be withheld in seller's sole discretion, seller may declare the balance of the note to be immediately due and payable. This is the due on sale clause. So they check this here, and the buyer sells the property, which they have that right. The entire amount is due immediately. And if they don't pay it, the property comes back. If they convey the interest to the property, the money is going to go back. The property is going to go back to the prior seller. So under A or B, buyer's liability to pay the note will continue unless buyer obtains a release of liability from the seller. Then what are you going to do with casualty insurance? Someone needs to have hazard insurance on the property. So the deed of trust will provide that the buyer shall or shall not obtain casualty insurance. And then what are they going to have an escrow account? So how many pages does a traditional lender have in their docs for a buyer? 150? Well, here we got 2. Does this sufficiently protect a seller in a situation like this, knowing what the traditional lender is going to fork over in terms of paperwork? I don't know, but I can tell you that this form is used a lot. A lot of attorneys are involved in these, and they have many, many, many addendums that is attached to this as a seller financing addendum. So if you have a seller that wants to do a seller financing, you should be getting them with an attorney who specializes in seller financing so that they can assist with the addendum to properly protect the buyer. Because why do I see sellers doing seller financing? Well, typically it's because they've tried selling it at a price that they can't get, and now they want to do a seller financing, and there are people that'll pop up, and they're desperate, but they're marginally qualified and they end up in foreclosure. So knowing how many of these actually end up in foreclosure, it's even more reason to make sure that the buyer and the seller have both been properly advised by an attorney.
How would the seller make sure that the casualty insurance is always like up to date? Do they get like some sort of
That comes in here under the escrow account.
Oh.
So escrow not required or escrow required. With each installment, buyer shall deposit in escrow with seller a pro rata part of the estimated annual ad valorem taxes and any required casualty insurance premiums for the property. So you want to make sure is that and usually it's a seller's attorney that would handle this for them, but sometimes sellers will handle this themselves. The buyer pays the check to the seller, and then the seller maintains an escrow account. So the payment would be taxes, insurance, and the property, and that the seller would pay the casualty insurance themselves through the escrow account. Make sense? Yep. Okay. Good question. Okay. More common, less liability, sometimes. Loan assumption addendum. All right. Why would we want to use a loan assumption? What is the benefit of this?
Lower interest rate.
Could be. So most likely, the seller is sitting with a lower interest rate, and that loan has been sitting on the property maybe 5, 6 years. Maybe it's 2.5%. And here today, our rates have come down a little bit. We're in the high fives for some types of loans, but there is a significant difference in the interest. And I think the real value and to understand the difference, and you probably all have watched me do this a few times, is go to bankrate.com, click on the amortization schedule, and let's do a $300,000 property at let's just say 5.75% interest rate. Here you have, we're going to make sure that there's no taxes, nothing else in here. Okay, so total interest paid, $363,000. What was the loan amount? So it is more than the original principal balance. So the entire repayment is $693,000, right? So maybe if someone has an underlying loan and their loan is sitting at 3%, it's $170,000 total interest paid. What was the difference? More than $250,000? Big difference. A big difference. So knowing the stark difference between, I think it was $697,000, so it was $190,000 difference, but in any event, it could be big savings for a buyer. And the thing is that the seller, although they're going to agree to it here, the seller is not the one that ultimately is going to say yes. And the process is actually pretty easy, and your loan officer is going to have nothing to do with it. If your client is looking for a low rate, the MLS is a field for loan assumptions. If you have a client that is really trying to buy something and what they're looking for just doesn't exist, and they've got a little bit of cash but not a ton, maybe this would be a good option for them. And you can show them properties that have underlying notes at 3% because the payment is going to be thousands of dollars different a month. And maybe they don't qualify for quite as much, but they have a little bit of cash down. So let's walk ourselves through it. What happens is first the seller advertises the loan assumption. You look at the rate and determine whether or not that makes sense for the buyer, submit the offer, and then the seller and the buyer submit terms, and then the buyer calls the loan servicer of the seller's financial institution that's carrying the mortgage, whether it's Chase, Wells Fargo, whoever it is. And they talk to their loan department and they get qualified through them for the loan assumption. And they take them through the entire process and they handle it on their side. And the seller is not going to even be notified at all if this is going on because anyone can assume a loan. No, we've got our addendum here giving the seller, that the seller is going to cooperate. But even if the seller doesn't cooperate, it's the bank's decision of whether or not they're going to assume the loan. And the thing about the loan assumption is that the lender is going to take it out of the prior person's name. Now, this is the thing. It's different for a VA. So VA loan assumption is a little bit different than your conventional loan assumption. It takes about 60 days, 90 days max to do a loan assumption. And recently I've done one of these because obviously the rates are higher today than they were before. And so this is ripe opportunity for us agents. I mean, what a travesty it is for some of these sellers to be selling their home, throwing away these 2.5%, 3% loans. It's wasteful that they're throwing them away. So agents should be trying to figure out how they can leverage them. The big question remains though, what is the difference between the sales price and the loan amount? And how is the buyer going to pay the difference? Because there's going to be a delta. Maybe they purchased it in 2020 and remember what happened, or maybe they purchased it in 2021 or 2018 with a 2% interest rate and they bought it for 400 and now that property is worth 600,000. There's a $200,000 difference. So does the buyer have $200,000 and take over this loan? Great deal. But maybe the buyer's going to take over this loan at 2% and then they're going to get a second for the other 200. And that 200 is going to be at a much higher percentage rate because It's a second loan. It has second position for foreclosure. It's higher risk for the lenders, and they charge 9%. So now you have to do an analysis. Is the 9% at 200,000 plus 300,000 at 2.5%, is that better than the entire thing at 20% down or 3% down at 5.75%? Someone's gonna have to do an analysis and help them out with that to try to figure out, does it even make sense? But at the end of the day, if the seller has an underlying note, the buyer and the seller can come together to agree that the buyer attempt to assume the seller's underlying note. The buyer then reaches out to the loan servicer of the seller's bank, talks to their loan department, gets in touch with a loan officer, and they take them through the application process and the approval process. And then once they're approved for the loan, they become they start the assumption process, but not for conventional loans, only for VA and FHA loans. And so before this should even take place, the buyer agent should have asked the seller for a copy of their original note, because the original note will say on it, this loan is assumable, this loan is not assumable. And that is the only way that's going to protect the buyer from going through the entire underwriting process and getting approved and then starting the assumption and getting declined because the loan's not assumable, which will happen. The bank's not going to tell them up front whether it's assumable or not. They're going to take them through the entire qualification and then decline them. So just know that all of that is how this loan assumption thing works. So first, credit documentation. To establish buyer's creditworthiness, buyer shall deliver to the seller within X amount of days after the effective date of the contract, credit report, verification of employment, including salary, verification of funds and deposit in financial institutions, current financial statements. Oftentimes, they're not going to check off any of these things because the seller is not going to review any of that stuff, and the seller is not going to send it to the lender. So it's here. You don't have to check off those boxes, but maybe they want to see what their credit looks like. Maybe they do want to see a copy of their credit report before they spend 60 days agreeing to this contract so that the buyer end up getting declined. They want some assurances that at least they're going to get approved. So maybe instead the seller say, look, I want you to go to Chase and I want you to get a pre-approval from them. Once you get the pre-approval, then we'll play with this because I don't want your credit report. I don't want that on me, which would be another very good way of going about this. B talks about buyer's credit approval, talks about the same thing that we just learned in the seller financing. If the credit documentation that they give, they don't like, the seller has the ability to bail, terminate, and the buyer get their earnest money back. Now we talk about the assumption. At closing, buyer will assume in writing the following existing notes and all obligations imposed by the deed of trust securing the notes assumed. And then they write down the underlying notes that are currently outstanding. And then the loan assumption terms. The payment and the assumption fees, they talk about if there's fees to assume the loan, which one of the things that the seller can do when they list is contact the bank and ask them for an assumption packet. Sometimes the bank will give it to them, sometimes they won't. But at the end of the day, here's the big deal. If the note holder fails to consent to the assumption of the loan, neither seller nor buyer may terminate this contract, or either buyer or seller can terminate the contract by giving notice to the other party, and their earnest money will go to the buyer. So it's all down to whether or not the note holder is going to consent, whether it's Chase, Wells Fargo, Bank of America, credit union, whoever it is. Unless sellers released from liability on any assumed note, a vendor's lien and deed of trust to secure assumption will be required. So we want the three-party agreement, but we want the title to change to the buyer and them assume the note very cleanly. Tax and insurance escrow is going to be handled by the loan servicer, and then authorization to release information. That information that we have at the bottom of the third-party financing, here it is exactly again, that the lender, that the seller and everyone authorizes that they can have a copy of these documents necessary in order to be able to assume the loan. And then notice to buyer, notice to seller, and then a due on sale clause. If you've not done with one of these, please get with Michael Potter. We've now done enough of these where we can walk you through. Unfortunately, in my opinion, this loan assumption addendum is a little overly complex for how a loan assumption really happens. I wish that this was done a little bit differently, in that Buyer will contact loan servicer and kind of do what they did in the third party financing, that buyer will make every effort to assume the loan by the servicer and leave this stuff to the servicer, but they don't. So some of this will have to be filled in, especially paragraph C. But paragraph A doesn't have to be. You don't have to have the seller get all of the buyer's financial information. It's better to send the buyer to get a pre-qualification letter and click on other here and say buyer to be pre-qualified by Chase. Be pre-approved by Chase or pre-qualified. Okay, it's 3:04. We are going to go on our second to last break, and then we've got 2 more chapters to get through. But the very next chapter that we're going to jump into is conditional qualification and conditional approval. Now, interestingly, that's the very first thing we talked about this morning when Mary Beth talked about the differences between the two, but we're going to come back from break and we're going to get into a breakout session. And we're going to talk about what documents that the buyer needs to have handy to give to the lender so that you can be thinking about that as well. So page 52, make sure that you're all on page 52 because you're going to need it. And I'll see you back after break at 3:15. Back, I think we're back. We are deep into our material at this point. We are all the way into chapter 7. We have 11 chapters. A couple of them are pretty short, so we should have just enough time to get through all of this. We have about an hour, an hour and 20 minutes. Conditional qualification and conditional approval. Would someone, I think this is a very freeing statement. Would someone be happy to read the first paragraph in this for me, page 52? Thank you, Meg.
Realtors are not a taxi service. Unless and until you have reasonable assurance that a buyer is credible, it is unwise to invest both time and use of your car showing a person neighborhoods, houses, and finer points of the city.
So it's important that you know how to pre-qualify a buyer. And you should also know the requirements of conditional qualification and conditional approval. So conditional qualification, conditional approval, you can call them pre-qualification and pre-approval, but they are conditional. And they're conditional because they're subject to, and what are they subject to? Appraisal for the property. Always recommend that a buyer obtain a conditional approval letter. This is a specific form, TDSML Form B. This sets the parameters of the property search because it states what the borrower can afford or will likely be approved for. It also shows that the buyers are serious and ready to get down to business. You can help buyers who don't yet have a lender by preparing them for what the lender will need. So, having a conversation with them at your buyer orientation about what documents that the lender is going to need, especially those buyers who haven't bought in a really long time. Maybe it's been 15 years that they've purchased. Things have changed considerably. And what they think that they know going into the transaction, they're going to soon come to one of 2 realizations. Things have changed or they're working with the wrong lender. And if you can set those expectations up right in the beginning, they're going to understand that things have changed and it's not a unreasonable lender that they're working with. It's a difficult climate in lending that they're now entering into. It's just everything has changed. So list the items the buyer will need to give to the lender. What are some items? Let's just not do a breakout session for this one and let's just do it together.
Tax returns and paycheck stubs.
Okay. Yes. Paycheck stubs.
Bank
Income
statements.
Bank statements. What other kind of statements?
Credit report.
Well, the lender's going to run their own credit report, but they will order one, yes. But other than bank account, what other accounts are they going to want credit statements for?
Credit card statement.
Credit card statements. Okay, what else? Hint, hint, it's plastic and it's in your wallet.
Like ID.
Yep, they're going to want a copy of your ID as well. Also, probably letters of explanation. From what was this deposit about? What is this about? All right, so these are the basic documents. Their ID, tax returns, bank statements, income statements, credit card statements, letter of explanations, and Sometimes even if they have assets, a 401k, $2 million in gold bars sitting in their safety deposit box, uh, they're going to want to have an idea of what it is that they have. So, pre-qualifying a buyer. Let's tackle pre-qualification by phone. This is the first step of turning a person into a prospect, so a small amount of time can produce big rewards. Do you remember when I said that, interestingly enough, not that most people are honest about their credit when you ask them? Uh, this is where that comes from. So, page 52 and 53. The idea is to find out the sales price by knowing the income and down payment that would allow for the sales price to happen, which I like to call reverse engineering their comfortable payment into a purchase right price. Because that's what you're doing. You're going to reverse engineer what they would consider a comfortable payment. And usually they kind of know what a comfortable payment is, how much they want to spend. And typically that's going to be somewhat close to what they can actually afford, but not always. So the lender is the one that's going to ultimately determine that. So I'm not going to get into ratios. We've already talked a little bit about the front end ratio and the back end ratio already, housing costs versus other costs. But on page 53, it says, for the purposes of qualifying without a calculator, round the numbers to get conservatively they're going to help you with the ratios here, and I stay away from that. But you need to know the approximate monthly house payment to plug into the numbers for the ratios. I like to know what a comfortable payment is, but I always get them with the lender and let them do all this work for me. But there is a trick to determining if someone has decent credit, because at the end of the day, it's not about what they can afford, it's whether or not they can be approved for a loan, in my opinion. Now, maybe they're approved for an amount that's not going to get them in the 10th floor at a high rise in Austin, Texas. Maybe now they're looking in Taylor or Gerald or Georgetown, which pretty expensive in some of these Georgetown areas as well. But right now I'm looking and I'm seeing $200,000, $285,000 properties in our market. So there is affordable housing in the suburbs. It's always been that way. If someone is not going to be qualified for, a large purchase price, they're probably going to have to go out further to become a homeowner. Let that property increase in value over time, sell it, and then use that as a down payment somewhere else. People tend to make more money over time. So the trick is to help determine if someone has decent credit. Keep in mind that most borrowers can get a loan if they can put 20% down or more. Pretty much anyone can. Also, try not to rule out somebody who sounds questionable. Simply refer that person to your lender more decidedly than a person who can that appears unquestionably strong. The trick in pre-qualifying credit comes in two parts. The first might seem quite obvious, but many agents are reluctant to ask. How is your credit? Excellent, good, mediocre, fair, or poor? And if the answer of this is anything other than I don't know, you should be able to get a good idea of the type of borrower you have. As it says, interestingly enough, people rarely lie about their credit when asked to pick a label for it. It is in avoiding the question or failing to admit their credit that you have a challenge. I'm not sure. I don't know. Okay, well, that's a whole different scenario. But how's your credit? Good, fair, poor? Where are you at in the credit realm? And they'll say, well, I think I've got some issues. Got it. Okay, let's get you with a lender and find out where you are. If worst comes to worst, we can get you on a lease, help you get a roof over your head for the next year. We can be working with our credit people to get your credit repaired over the next year so that next year, when you're concluding the lease, you'll be ready to buy. If you're ready now, great. We can hit the ground running, knowing what we're qualified for and what we should be looking for in terms of our price range. Building a plan, helping them. I mean, that's at the end of the day, you can't do much more than that because it's not you lending the money. You are helping them get in touch with someone who can. So always, though, you get them with a lender. A vast majority of Americans can get credit. So when they cannot, this obviously is a problem for us. So what do we do as an agent when you have someone who's just not willing to speak to a lender? Do we start the home search process? No. They got to work with us. One of the very first questions I ask people, and it's a very respectful question, is, are you going to be paying cash or obtaining a loan? Just simply ask that question. And if they say I'm going to be getting a loan, great. Have you spoken with a lender? No. Awesome. Are you willing to speak to a lender? I've got a couple that I can refer you to, because we're going to need the listing agent's going to need a pre-qualification letter for us to schedule an appointment to start seeing homes. And I always put it that way. Especially on luxury homes, they're not going to even let you in the front door without a pre-qualification letter or proof of funds. You got a $3 million property and you schedule to show it? Great. Send me over the proof of funds and I'll schedule a showing for this Thursday at 3. That is what you get with luxury properties. They don't want lookers, they want buyers. So everybody wants to see the $3 million, $5 million house. Show us that you can buy it and we'll open the door for you, kind of thing. So having a productive conversation with them, getting on the lender. Once they're playing game, great. Now let's talk about the next section, which is from the lender's perspective. And there's a lot to go on here. So number one, the conditional qualification, which is the CQ letter for preliminarily approving of willingness, credit and ability, income, assets, and debt ratios to satisfy the seller's needs for pre-approval. The conditional qualification letter versus the conditional approval letter is what most would consider loan approval, verified willingness and ability, underwritten formally with conditions that are met prior to closing. It's the same information that they're going to ask for on both of them. It's just whether or not they've taken that file and taken it to the underwriting department and underwriting it. Some lenders don't like it because it costs more money for them to be underwriting a loan twice because effectively they're doing it twice. They're sending it to the underwriter and underwriting the buyer, and then again when they get the property. And so some lenders are unwilling to do this, and some lenders do it for just about everyone. So it's a matter of having a conversation with a lender to see if they will do it. And some lenders will say this, well, we're gonna do most of that. We're gonna pull the credit and we're gonna take a look and we're gonna verify their income. And that's all that we really need to do. I've had lenders say that. I've had buyers be declined because they had source of income issues or deposit issues or serious issues with their ability to source funds that's in their bank account. So you really don't know until the buyer has gone all the way through the process. But again, some lenders, they don't like doing it. Would someone read so here is the list of the requirements for the conditional qualification letter versus the conditional approval letter. Would somebody read conditional CQ and someone read the conditional approval CA? Raise your hand. Mary Beth? And I need one more. Kelly.
Conditional qualification requirements: date, applicant's name, phone, and address of the issuer of the letter, company and individual, the loan amount, interest rate, term, and the loan to value or sale price, loan type, whether the issuer has received a loan application from the prospective borrower, whether the issuer has reviewed the applicant's credit report and or their score, whether the issuer has verbally or in writing received information regarding the applicant's income, cash for down payment, their debts, the assets, and that the applicant is eligible and qualified for the loan described, that the loan is not approved but is subject to certain specifications as listed.
Thank you. Kelly.
Date, applicant's name, phone, and address of the issuer of the letter, company and individual, loan amount, interest rate, term, and LTV or sales price, loan type, subject property address, that the issuer has verified the prospect, credit and credit score, income, cash for the down payment, debts, assets, and that the applicant is approved for the loan subject to the following conditions as listed.
Thank you. All right, so loan approval. So willingness to repay, ability to repay, and collateral in case the willingness or ability to repay break down. That is the sum of that. So again, in the willingness to repay, a person's willingness to repay a loan is purely speculative, but the lender speculates nonetheless. The only meaningful way to derive this willingness is to probe the prospective borrower's history. Best predictor of future behavior is past behavior. Look at their past payment history, and that's where they're going to derive the willingness. And then credit. Credit, Fair Isaac using FICO, they're going to look at payment history, identifying information, use and abuse of credit. We're going to talk about what abuse means. Length of history, inquiries into opening new lines of credit. Inquiries means how many current times have they tried to open a new line of credit, whether it be a loan, declined, whatever, but it's going to show up as inquiries. Types of credit and public records. Public records could be judgments, liens, bankruptcies, even sometimes there are criminal things that are under the public records. So let's talk about use and abuse of credit. Use and abuse of credit can simply be people who are borrowing more than 30%, 50% of what the credit line is. So if the credit line is $1,000 and they're at 800 or 1,000 or even go over their credit limit, that would be considered abusing it. And they really like to keep that number below 25%. I'm going to show you where that is in here as well. So as we get into the credit reporting agencies, TransUnion, Experience, Equifax, every single person in the United States has the right to request a free copy of their credit report once a year from each of the three major bureaus. They look at credit rating factors, and here's how they break it down. First, payment history, which is 35% of their overall score. Payment history takes into account paying on time over time. Then, amounts that exceed 70% of the credit limit at the time of the monthly reporting by the creditor on each account would be regarded as overuse of the credit. Exceeding the credit limit is abuse of the credit. Ignoring installment debts, by the way. So they're not looking at a car that you bought for 50,000 and it now has a $50,000 line showing 100%. Those installment debts are taken off. They're not even they don't apply that metrics here. This is revolving stuff. Number 3, length of credit history, 15% of your score. The oldest credit line, which is why sometimes they're going to tell you not to close accounts because you can lose your oldest account, which actually could hurt you. New credit and credit inquiries is 10%, and then types of credit 10%. So able, a borrower's ability to repay a loan is centered around their income. Unreliable streams of income must be carefully scrutinized. What are some unreliable types of income? We talked about a few of these earlier today twice. Tips is unreliable. Overtime is unreliable. Bonuses is unreliable. So it's these types of things. And also, short-term work is unreliable because sometimes people have, a seasonal job. They're going to look at that as unreliable. Income is considered reliable when it is both measurable and expected to continue. Then they go into assets. When assets are used as a compensating factor, they must be liquid and at the borrower's disposal. So what type of liquid assets? Bank accounts, retirement accounts, things like this that they use as what they would consider assets. Then we're going to look at collateral. This is the property in the world of real estate. The property, subject property would be the collateral. Even borrowers with the best intentions, willingness, and ability to repay will fail to repay a loan for one reason or another, and from time to time. The lender relies heavily on the appraisal to judge all kinds of relevant issues regarding the suitability, marketability, and the property before approving the property as collateral. They want to look at the condition, and then they want to look at the comps, and they want to determine whether or not this property is sufficient collateral for the loan. And it really is going to take an appraisal to do that. And the lender, it's the lender's appraisal. It's not the buyer's appraisal. So the lender pays for it, asks the buyer to reimburse them for the cost of the appraisal. And then the lender orders the appraisal, and the appraiser is working for the lender, which is why it's dangerous for an agent or for a buyer or even a listing agent unrelated to the buyer to get involved and try to influence that appraisal. So we have to be careful and also make sure that we are working in our client's direction. If you're the buyer agent and you're going to meet the appraiser out there, I know you've probably all heard this at one point from me or not, because I soapbox this a little bit, but I've seen agents get in trouble regarding this. They just take it upon themselves to meet the appraiser and show the appraiser's comps and try to influence the appraiser, but they don't tell their client they're doing that. And oftentimes the buyer agent's trying to prove value to the appraiser because they want it to meet value, because they don't want to end up in an appraisal crisis. But maybe the buyer is thinking, look, I want to be able to fall back on my appraisal contingency because I think I'm buying this thing for too much. And if it doesn't appraise, then I'm going to use that as leverage to renegotiate this contract. And if they find out that the buyer went out and without being at their direction, try to influence the appraiser, that might be a fiduciary issue. And integrity is one as well. So we must be working at the client's direction. So we must get their approval, let them know what we're doing, and then get their approval and go meet the appraiser. The fact that you're meeting with the appraiser is not the issue. It's whether or not you're doing it at your client's request and permission. So we have to be faithful to our client, and we have to also be obedient to them. So same thing goes with the seller. If we're going to meet the appraiser, we need to have a conversation with the seller and let them know exactly what we're doing and what it is that we're attempting to do, and make sure that we're working at their behalf. Once the appraiser has issued the appraiser and turned it in, then we no longer can communicate with the appraiser at all regarding the appraiser. It's actually against the law. So there's a firewall built then. So before the appraiser is done, the appraiser is going to call the seller to make an appointment to go see the home, because they have to put eyes on the property. They have to walk it. Different appraisals are done for different kind of properties, different types of loans rather. So if it's a VA loan, they're going to do a VA appraiser, certificate of reasonable value, and they look at different things. They take a huge issue with any diseased trees or wood rot or safety issues, much more than you would see in an FHA loan. But FHA loan also has habitability issues, has to have flooring and all the burners working on the stoves and that kind of thing. So the appraiser also is going to walk the property and look to see if there's any major condition issues that would be affecting the property. Settling cracks that makes the inspector concerned about the foundation, or pooling of water somewhere where it looks like there would be a major leak in the home, or if they see presence of mold or anything that really just sticks out at them, they will put a note on the appraisal that makes its way to the lender. The lender reviews it first, and now it becomes a condition because the underwriter is going to see it. And the underwriter then is going to have to make sure that they're going to look at these and ask for them to be cured, and they will show up as underwriting conditions to be cured before the lender will close on the loan. So, meeting the appraiser at the property, showing your comps with your client's permission is perfectly okay. Sometimes you're going to receive an SOS from the appraiser. You might hear a word in a VA loan called Tidewater. You might hear this word and you get an email from the lender, Tidewater. And that means that it's a specific VA term, meaning that they're not able to prove value and they're going to come in lower than the contract price. And they're asking for help. Maybe we know something that they don't. So they oftentimes will reach out to the agents and say, all right, something's not making sense to me. I'm not able to meet value. Why? What's going on here? And then the agents have an opportunity to turn in their rationale, comps, the rest of it. Maybe this particular lender, maybe this particular appraiser rather, doesn't have access to CTX MLS. And maybe inside CTX MLS, there's 4 really good comps that this person doesn't even know about. And we show them, and all of a sudden that really helps them a lot. So maybe there's upgrades in the home that they're not aware of. Maybe they didn't even notice that there's, solar panels on the roof. Who knows? But we want to make sure that we share with them the upgrades, the fact that they're in a multiple offer situation if there were one, because they will take that into consideration. And then all of the comps that you have in your CMA, send it to your clients. I'd like to send this to the appraiser, get thumbs up, then send it over to them before the deadline. And when you get a Tidewater, you're usually dealing with 1 day or less, because the lender wants that back. The lender has a date in which that they have a due date, and the appraiser is usually working on the appraiser the day before the due date, and it's usually turned in on time. And now it's going to be late, and they get a bad score if they turn in an appraisal late. So when they do a Tidewater, then they're not going to allow the deadline to be missed because they're waiting for you to respond. So if you don't respond, they're going to turn it in before the deadline, which could then stop you from being able to get that information to them, because once it's turned in, it's done. You can't really change it at that point. Now, if the appraiser has made a mistake, you can send it to the AMC, which is the appraisal management company that is the employer of the appraiser, and ask them for a reconsideration. A reconsideration means somebody else has to go out to the property, which means someone's going to have to pay another fee. And oftentimes the AMC is going to say, no, we're not going to do a reconsideration. But if there's a technical inaccuracy, we're looking at the appraisal and the square footage is really off, or, you use 3 foreclosure comps and this isn't a foreclosure, or, you're saying that it's a 1-story and it's actually a 2. If there's a technical inaccuracy, and I'm going to shy away from using the comp example because whatever comps they select is part of the art, not part of the science. And so they have all of the artistic leeway to pick their price from the comps, and all of the artistic side. You can't call them on that. You can only call them on the science side of things, which is actually a technical inaccuracy. You can then let them know that there's a technical inaccuracy, and then they will often fix that. And if they refuse, you can pull them in front of an ARB, an appraisal review board, and 6 to 8 weeks later, they'll be standing in front of a peer, and they'll be subject to having to report their rationale of why they did that, and they could be up for disciplinary action themselves. But by then, 6 to 8 weeks later, it's way, way too late for you in the transaction. So your only point to affect the appraisal outcome with your client's permission is maybe less than 24 hours within the time frame that they reached out to you, if they even did reach out to you. So if it's part of your normal practice to be in communication with the appraiser, you should be in communication, if you're the buyer agent, with the listing agent, and say, hey, would you mind asking the seller to call you when the appraiser calls, or when they make an appointment through showing time, so that I can meet them there and give them my comps, or leave a comp package on the counter for the appraiser with a note, call me, kind of thing. All of those things are okay. Okay. Fair housing, very big topic. We obviously, as a profession and in the realtor side of things, have subscribed to a very specific Article 10 in the Code of Ethics regarding fair housing. Now, it's also built into the License Act and the federal law as well, protected classes. But no difference is the world of lending. We've got the Texas Department of Savings and Loan, SNL, here in the state of Texas, and they have their own anti-competitive and fair housing language. When a borrower applies for a loan, it is an act of discrimination for a mortgage company to do any of the following. Would somebody read these bullet points of the not to do things for a lender? If you'd raise your hand. Thank you, Tina. Candy, you're next.
Refusing to provide information to a borrower on all loans being offered by the lender based upon the borrower's financial qualification, not their race, color, religion, sex, national origin, handicap status, or familial status. Refusing to give the borrower a loan based upon their protected class. Offering a loan but with different terms or conditions on that loan, i.e. interest rate, points, application fees based upon the borrower's protected class. When the lender appraises the property, basing the appraisal on the protected class of the borrower. Refusing to purchase the loan or setting different conditions and terms for purchasing the loan after it has been created in the primary market based upon the protected class of the borrower.
Thank you, Tina. Excellent job. All right. So obviously, lenders are going to have to hold themselves to a high standard. And I mentioned something earlier in the day. I said, if the seller and the buyer want to do a loan assumption, they both agree to that, and the borrower calls the seller's loan servicer, gets them on the phone, and says, I want to assume this loan, that they're going to send the loan servicer is going to transfer this prospective borrower to their lending department, They're gonna pre-qualify them, and they're gonna take them through underwriting, and they're not gonna tell them whether or not the loan was assumable or not. Do you remember when I said that? So that's because of federal law. And so that's going to be here on page 59 at the bottom where it says, when you apply for credit, creditors may not discourage you from applying, reject your application, or impose different terms or conditions like higher interest rates or higher fees on a loan because you receive public assistance. Ask for information about your spouse, etc. So this applying for credit thing, they cannot discourage you from applying. It's a federal law that's built into there. So if they tell you, oh, this isn't assumable, don't bother applying, they are violating their own fair housing. So they can't. So you should be asking as the buyer's agent in a seller finance transaction, you should be asking the seller to provide you a copy of the deed or note so you can see on the language of the note of whether it was assumable and not calling the loan servicer in the first place. And the loan servicer is not going to share with you the details of the note until you assume it. So as part of their pre-qualification process, they're not going to share that with you. So I just wanted to throw that tidbit and where that was here in the book and why I made that comment. Now, evaluating credit. So how the lender evaluates their credit. When evaluating credit, they also have a fair housing and special best practices. They may not refuse to consider reliable public assistance income. Now, source of income is actually a protected class. So if you're getting public assistance income and it is stable and expected to continue, they need to use that, and they will use that as sourced as part of your income. They may not discount income based on your sex or marital status. They may not discount or refuse to consider income from part-time employment, Social Security, pensions, or annuities if it's expected to continue. Just because you're part-time doesn't mean that it does not expected to continue. Seasonal employment has a shelf life, but part-time doesn't. Creditors may not, and just to supplement that, they're going to call the employer and they're going to ask those questions, and the employer is going to have a review that they're going to do that they're going to send in, which is called a VOE, a verification of employment, and on there is this expected to continue. Refusal to, and they may not refuse to consider reliable alimony, child support, or separate maintenance payments. A creditor may ask you for proof that you receive the income consistently because you may be getting child support, but does everyone make their child support payments? No, they don't. So they can't refuse to accept child support payments that have been coming in on a regular basis. But if someone is due child support and they haven't received that payment in the last 4 months, or they receive it on a irregular basis, they're not going to be able to use it as consistent income to evaluate the willingness or the ability. Okay, so then credit rights. You have the right to know whether your application was accepted or rejected within 30 days of filing a complete application. Know why your application was rejected. And by the way, this is why we have a adverse credit notice when we're dealing with leasing, because they also have the same right. If a tenant was rejected based on credit, we have to give them an adverse letter based on federal law explaining why were they rejected for why their application was rejected. Learn the specific reason you were offered less favorable terms than what you applied for. Double deposit is an adverse action letter in a leasing, or here you applied for a loan for 3.5% down and they said, no, your credit score is less than 580. We want you to put 10% down. You applied for 3.5%. They need to tell you why they're countering back and saying that you would only be applied for only be approved for 10%. And find out why your account was closed or why terms of the account were made less favorable, like they increase a credit card, for instance, increasing your interest rate or something like this. They need to tell you why. Your credit report includes information on where you live, how you pay your bills, and whether you've been sued, arrested, filed for bankruptcy. National credit reporting companies sell the information in your report to creditors, insurers, employers, and other businesses that in turn use this information to evaluate your applications for credit, insurance, employment, or renting a home. Disclosures. Lenders have a pretty big list of disclosures that they are regulatorily required to provide through companies like CFPB. Not different than we have a bunch of disclosures that we have to provide our clients. We have to provide our clients an IABS, a mud notice, all kinds of disclosures on muds, waters, PEDs, all the things. So they have their own disclosures. Part of it comes from this Truth in Lending Act, TILA, and the RESPA, Real Estate Settlement and Procedures Act, integrated disclosures, which are called TRED. Back in 2010, they started this Dodd-Frank Act, and then 2015 came around, and they got rid of our HUD. Our HUD was born in 1974. So was I, by the way. And it died in 2015. Thankfully, I did not. But now we have replaced from that a new form called, what is it called? It's not called HUD anymore. What is it called?
TRID.
Nope. What is the form that we get that we get at
Public disclosure statement or ALTA.
We call it a CD. But yes, closing disclosure. HUD is gone. We have a CD. Most of them use an Alta, but legally they're required to give you this CD. But the thing is the HUD was really easy to read. And then they brought out the CD because it was going to be easier to read. But it's so confusing that they then created an Alta statement because they can't use the HUD anymore. So they give you a HUD statement with a different name so you can understand what the CD is. That's the reality of what has happened. It's a little ridiculous, but at the end of the day, that is what the lenders are dealing with. They have to give them first disclosures, and one of those disclosures is the LE, the loan estimate. And the loan estimate is the very first one to come up. The consumer's name, consumer's income, social security number, property address, estimate of the property value, and loan amount sought. And then the loan estimate is 3 pages long. So this LE is the very first document. It comes in part of the good faith estimate, GFE, or the truth in lending. So we used to have a truth in lending and a good faith estimate. And they took those two things and they grouped it together, and now they call it the loan estimate, the LE. The loan estimate is 3 pages. Certain amounts will be rounded to the estimate, but here is the basic construct of what the LE or the loan estimate looks like. It's got the loan identifies core information about the borrower and the property. Brief description will be used to identify the loan's purpose, refinance construction, the type of product that's being sought, the loan type, conventional FHA, VA, the loan number, the rate lock information, the loan terms, which is the loan amount, interest rate, and monthly P&I, principal and interest, and whether or not there's a balloon payment and a prepayment penalty comes along for the ride, projected payments, and then principal and interest, same amount as listed in the loan terms section, mortgage insurance, how much the MI is going to cost monthly, estimated escrows, and estimated total monthly payment to include PITI. Costs at closing, closing cost details. The thing about the closing cost details, and this is something that every good agent should know. The lender has to quote everything, whether or not it applies to you in your contract. For instance, they have to quote, is it possible that the buyer will have to buy a survey? Is it possible that the buyer may have to purchase a survey? Yes or no? It's possible. So they have to add it. Now, they might look at this transaction and say, well, in this case, most of the sellers are going to hand over a free survey, but that's not the thing. So whether or not they're going to have MI, whether or not they're going to have to pay for a survey, or all of the things, they have to quote on everything. And that is what lenders struggle with when they do their LE, because they overestimate on the payment, because they have to throw in the kitchen sink, and they have to cost for everything. Because if something later pops up and they didn't have that on their original loan E, the lender has to pay for it, because that was the problem in the old structure prior to 2010, when we had the truth on lending, is the lender would give a statement based on what they thought the buyer was going to end up with, and then later find out, oh, well, you are going to buy extra survey coverage. Got it. Well, that's going to be extra. Well, you didn't tell me about that. Well, you didn't tell me about that. So now it's The buyer has to be quoted on everything. So it's always going to be an overestimate. And then there's this tolerance for change, and the tolerance is not very much. So I'm going to read this because this is the big thing this was the big takeaway for me. Because in some instances, the lender can be fined up to $1 million if their fee sheet is off. There is a zero tolerance for excesses in fees paid to the creditor or to a third-party companies for services the consumer cannot shop for, Section A or Section B. These costs cannot increase from the loan estimate to the closing disclosure. So the loan estimate is here's what this thing is going to cost, and at the closing table, they get the CD, the closing disclosure. And the loan estimate can never be less than the CD, the closing disclosure. If it's less and the closing disclosure is more, then they didn't quote on something and the lender now has liability. So they have to over disclose on the loan estimate always. So it's always going to be more. There's a zero tolerance for it, for things that they can't shop for. So property taxes, obviously you're not shopping for it. It's fixed. The, whatever it costs to have the title fee, it's promulgated. So these things can't, there's a zero tolerance for error. But there's a 10% tolerance for things that they can shop for. Things like interest, things like insurance for the property. So they can't underquote on the insurance because if they do, that could be a problem. It could be a big problem. And then, so that's their zero tolerance for change. Calculating cash to close, what the borrower is going to have to write a check for, obviously, is deeply in the LE and the CD, and it also is not going to change. And then disclosures regarding ARMs and those types of loans. And a comparison, they have to confirm, the buyer has to confirm that they received the initial disclosures. And then we have the closing disclosure. The closing disclosure is very close to the LE, the loan, the closing disclosure is very close in how the lending disclosure, the loan estimate looks. They're almost identical, but they just have a different title. So the loan estimate and the closing disclosure is very, very similar. Page 1, closing disclosure, closing cost details, closing cost details. How many of you seen a CD? It looks, most people have not gone through and looked at the CD in much detail because they take their eyes over to the closing disclosure or the ALTA statement and they read the ALTA statement because we understand how to read the ALTA statement. But the ALTA statement is not part of the law. It's not actually a document that is required to be provided, but most of the title companies provide it and they go over the ALTA statement. And when it comes to the closing disclosure, they typically don't go over it because it confuses the borrowers because the prepaid interest is added to the transaction, showing them what their effective rate is. And they see the interest rate that's on page 1 and they say, that's not the interest rate I was told. And then the lender has to say, I know that's the effective interest rate. That's the interest rate of the interest you paid plus all the closing costs. And then it changes the rate and it makes it really confusing. It's not good information for the borrower, but someone at some point thought that that would be good for the borrowers to see what their actual effective interest rate was when they add all the closing costs and fees that they paid when they purchased the home. And most people would agree that the buyer is wanting to know what their actual interest rate is going to be on the loan. And so that just confuses them, and that's not good information, not typically. So again, most of the time, you're going to see them going through the ALTA statement, not the closing disclosure. We've talked a little bit about processing the loan and the underwriting. They have woven that through most of this book. But they're going to get a little bit more detailed here. Processing is a specific and distinct part of the loan cycle that is best described as preparing and packaging the loan paperwork. The lender, your originator, the face of the company that you're having the first initial conversation with and introducing the buyer to, they again hand their buyer off to a processor once they have started the process and agreed to at least start working with them. You don't hire a lender like you hire a real estate agent. Interestingly enough, there's no fiduciary duty between the lender. The lender owes their fiduciary duty to the depositors if it's a credit union or their employer, whoever they work for, not the buyer. But there is sometimes a fiduciary relationship in place. It's just not with the buyer. The only fiduciary that exists in the transaction is the real estate agent and the buyer. So the buyer doesn't hire the lender through any hiring agreement. It's the lender starts providing quotes. And then if the buyer decides to sign the loan agreement, great. If not, then it dies on the vine. So at some point, the lender is going to hand over the file to a processor, and the processor then is going to start collecting all the documents of the borrower after they've sent the loan disclosures out. Here are your disclosures. Now provide us your bank statements and all the documents. So the processor, once past the point of qualification, the processor is responsible for verifying that the paperwork supports the assumptions and understandings that were provided to the loan officer. So there's an application that comes in, the buyer fills out the application, and then from the application, the processor is going to go down the line and make sure that all of those things are true. They're going to verify the income, verify the assets, verify the debts, verify the employment, verify everything. And there are required reports that they're going to need for their file, an appraisal, a title commitment, a full credit report, credit alerts, inactive voice response system, which is if they have defaulted on any student loans or federal loans, uh, insurance binder on the property to find out what the hazard insurance is going to cost for the PITI. And then after they have those reports in the file, then they have to do these verifications. And usually these are manual verifications, so they're going to pick up the phone sometimes and call people, like the verification of employment. The lender is going to call at the beginning and do a verification of employment to make sure that they're employed. And then right before they fund the loan, they're going to do another verification of employment. We've had situations here at Realty Texas where a buyer was going to closing and quit their job and had because they were working at a job and they were buying a property in Texas and they quit their job and went and get in the car to go to the closing table, and the lender called for verification of employment and said they're not employed here anymore and or declined for the loan. So buyers need to understand that their employment needs to exceed their closing date. Verification of rent, which could simply be bank statements and a copy of a lease agreement. Verification of deposits, which would be here are all the deposits. Show us where these came from and proof of where those deposits were, whether it is a canceled check or going to the bank and clicking the button on the clicking the check and getting a copy of the front and back and sending it to the lender so they could see what it was. And verification of mortgage if there's other mortgages that are not going to be paid off at the time they're getting the loan. Maybe they already have a primary home and they're getting a resort home or a second home, or this is an investment property. Those are our verifications. Once the processor feels like they have got a file and they've got an answer for all of what they anticipate the underwriter is going to ask for, then they package everything into a package and they submit it for underwriting. So once the file is complete and the processor feels like all the questionable documents are properly addressed, the file is stacked into the underwriter's stacking order and sent to underwriting, and underwriting will eventually get to it. Could be a day, could be a couple days. But again, there's also different types of underwriting: conventional underwriting, and then in-house underwriting. And then there's also PMI companies that also have to underwrite it separately. So the mortgage insurance companies also are going to underwrite this, and we've seen situations where they weren't approved for one MI and have to send it over to another MI company because they also have to be approved from the mortgage insurance premium company. And sometimes the MI company comes back and says, no, we want to increase the rate, and they'll tell you why. And then the MI is going to have to be a little bit more expensive. So then the lender starts shopping MI companies. That happens as well. Once you have gotten through underwriting, they once it gets into underwriting, there might be conditions from the underwriter explaining what conditions, what issues that the underwriter sees that they want solved. They are missing a bank statement, or they feel like they want to verify something from the employer. they will have a list of conditions. And usually the conditions are pretty easy to overcome, but if they're not, these conditions, when you read them, really the lender is going to pretty much immediately know whether or not this is going to be overcomable, whether or not the lender is going to be able to fund this loan based on the underwriting conditions. So sometimes, they're trying to cure these conditions. Assuming that the loan is approved, closing documents are ordered by the processor. Insurance must be adequate on the property, usually with deductibles with no more than 1% for everything except wind and hail, which can be 2% of the value of the home and cover the full loan amount. The only way that the insurance can be less than the loan amount is if the appraiser has valued the land against the replacement cost of the structure. And they can remove the land from the purchase because obviously there's very little that a storm can do to destroy the dirt. And so if an appraiser were to value the dwelling versus the house differently, then they can get insurance just on the improvements and not the land and break those apart, which would save the borrower money. The processor requests specialized attorneys approved by the lender or the investor to prepare all of the loan documents, and these attorneys are under strict orders not to make any changes to the documents without prior approval from the investor who will buying or closing the loan. The loan processor will likely review the closing disclosure before closing. The loan originator may review it as well, and we also have an obligation as an agent to review it, review the closing disclosure, and make sure that the amendments that we have added throughout the transaction, whether it was a cash in lieu of repairs, adding to closing costs, that all of the amendments that were signed as well as the contract is properly memorialized in the closing disclosure and that it's accurate. And sometimes the lender doesn't get an amendment. Sometimes the agents will do an amendment and have it all signed and send it to the title company. But guess what? No one sent it to the lender. How in the world is the lender going to know about something if the agents don't send it to them? It's actually quite often that the lender will, at closing, find out a different sales price. And the lender will say, wait, what sales price do you have? Which is part of what they call the balancing of the CD. The CD is going to go to the lender, and it's going to go to the agents, and it's going to go to the title company. And they all have to work together to make sure that it balances, and they'll go back and forth. And it's not unusual for the title company to make 6, 7 changes to a closing disclosure to make sure that it balances. And then once they have it approved, then they want your eyes on it again. And it's up to the agents to really audit it to make sure that it's correct, because no one's going to know it better than the agents, because we put the deal together. But we're not going to know the title policy amount and other things like that, or the property taxes or the prorations amount. So a lot of that is in good faith that they know what they're doing, but we're looking to make sure that the sales price, the closing costs, the home warranty, the survey, the things that are under our purview are correct and that the columns add up correctly. And sometimes they don't add up correctly. So don't make an assumption that it's going to add up correctly because it seems to be in some form where it looks like it should automatically add up. It doesn't always work that way. They're also going to take a look at the escrows as part of the closing. The lender requires often a creation of an escrow account for the collection and payment of property taxes and insurance. Borrowers may request that there be no escrow account, but usually the lender will ask that they have one and offer them a better deal if they do have an escrow account. Many conventional loans don't have an escrow account, but many home owner occupied conventional loans do, and VAs always will, and so will FHA. You're going to have them built into those. So sometimes the conventional loans won't have one. The escrow account is established with a 2-month cushion limit. This translates to a full year of insurance being paid in advance plus 2 months of insurance escrows and 2 months of tax escrows over those months that are contributed through prorations from the seller. What they're saying here is that taxes are paid in arrears. In 2025, the 2025 taxes will be paid in 2026. So when you close in 2025, the seller is going to give a credit, an estimated credit from January 1st until the close date, and they're going to multiply that by the tax rate. And the seller will give that money to the buyer as a credit. It will show up as a credit on the closing disclosure, which means it will be subtracted from the cash to close. So maybe we're in December and there's 11 months of property taxes that the buyer is going to be the buyer's going to be next year responsible for paying the entire year, but the seller's giving them 11 months of cash up front. And they had a $20,000 cash to close, but it turned out that they only had to bring $5,000 to the table, and they're thinking, woohoo, I'm going to go buy a washer, dryer, fridge now. But they need to understand that in that was money that the seller gave you to pay the property taxes, and you're going to have to pay the whole bill next year. One of the reasons that's good that the escrow accounts are there is that the lender is going to try to take as much of that money as they can and put that in that account. So it keeps it out of the buyer's account and into the escrow account so that the money is actually there in the event, when the event happens, when it's time to pay the property taxes, because the lender is going to pay the taxes and they want to make sure that sufficient monies will be there. Also, I would be amiss not to mention that when you're dealing with the prorations, that someone needs to have a conversation with the buyer about improved versus non-improved. You can buy a brand new home and last year the property be only 10% improved. And the property taxes be $2,000. And then before they built the home and after they built the home, it's $8,000. And at the time that they're funding the loan, they're looking back to last year and they're seeing an unimproved rate of 2,000. So then they factor that $2,000 as part of the PITI and only put that 3 months of that in their escrow account. And then as soon as you get into the new tax year, the appraisal district reassess the property for an actual fully improved rate and it explode the amount due. So be talking with the lender on a new construction to make sure that they are using the payment quote PITI and the escrow account funding on fully improved, not partially improved. We've had several blowouts with situations where that's happened. Highly qualified people getting conventional loans being told that this is what's going on, later calling back and upset at their agent. And it's one of the situations we had it on the office line. And the doctor, Dr. Pam, had no memory of that conversation ever taking place. And it was full amnesia, and was blown away that that conversation happened at the level that it details that it did. And so these conversations, having these recordings, in this particular case, the client had lost confidence in our agent and was very upset. And the conversation completely turned the tides from what was anger to an apology. And that's always nice to see. Okay, we've got one more chapter, or two more chapters in 15 minutes. So we've got only 3 more pages. So we're almost done, guys. We've got RESPA violations and escrow accounts and prorations. So let's talk about taxes. Taxes are paid in arrears. But what I'm going to talk to you guys about is about FERPTA. Federal tax requirements. No yawning, Tina. Federal tax requirements. Federal tax retirement, they have renamed that to federal tax requirements on purpose, tax requirements, or federal requirements, rather. And the reason is you could have a buyer who is selling a property as a seller, and the title company will ask them for an affidavit on their status, non-foreign status affidavit. Are you somehow connected to the ability where you're going to be able to have an income deduction on the money that you're getting from the property? If you sell it for $250,000, you get to claim that. What am I trying to say? Income, Mary Beth, help me here. Okay, if a seller sells a property for $250,000 or $500,000, they don't have to pay federal income tax if they make up to that amount.
So the capital gains.
Thank you. Capital gains. So in the world of capital gains, we get that if we're a citizen, but we don't get that if we're not. So if you have a foreign owner that has purchased a home and living in the house and they sell it, they're gonna be subject to capital gains for every dollar. They're not going to have the exemption from a single person for $250 or for the married couple up to $500,000. And so that means that the buyer is going to have to withhold that money and then send that money to the IRS, and the title company will help them. When it comes to the taxes portion of this transactions, the prorations and the amount that's being withheld and given to the buyer at closing matters. So if we find out it's a foreign seller, we need to get with the title company and make sure that they're withholding the right amount from the seller, because they have to withhold amount from the seller in terms of proceeds. Let me take you back a couple of pages to page. Of course, the pages of the contracts aren't in here, so it's about 50. Here, paragraph 20, federal requirements. If the seller is a foreign person, as defined by the IRS code and its regulations, or if seller fails to deliver an affidavit or certification of non-foreign status to the buyer that the seller is not, in fact, a foreign person, then the buyer shall withhold from the sales proceeds an amount sufficient to comply with the applicable tax law and deliver the same to the Internal Revenue Service together with all the right forms. Internal Revenue Service regulations require filing written reports if currency is in excess of specified amounts. Basically, what it's saying is if the seller is a foreign person, then they're going to have capital gains, and the buyer has to withhold those capital gains from the proceeds, and the buyer is responsible of giving it to the IRS. Now, the title company, thankfully, is going to help, even though the buyer is responsible for this. But the question is if they don't withhold an amount sufficient to cover it, the buyer is responsible to pay the difference, which could put the buyer in a jam after closing when the capital gains was $60,000 on the sale of the home and they only collected $50,000. There's a balance due for $10,000, and the IRS is going to send that to the property owner, and they're expected to pay the extra $10,000. It could be like that. So there is a company called FIRPTA Solutions, Foreign Investment in Real Estate Act. FIRPTA Solutions will insure the buyer. They will do the paperwork, they charge a fee for it, and if there's a difference, they will pay it out of their insurance. So that third-party company should be used. But taxes and the prorations at closing is important, not just for a foreign seller, but also what happens if the owner of the home was a fully VA disabled person. And you're going to buy the home and your client doesn't have that exemption. The client, the buyer, is going to be responsible for the non-VA exemption amount. And the VA borrower is not required to pay taxes for anything other than a VA amount. So then you're stuck. Now, what legally is supposed to happen is the buyer is supposed to receive a credit, not from what the seller's exemption is, but on what the liability of the buyer is going to have when they pay their taxes next year. So the seller is going to have to fork over a higher tax amount than what they would have paid had they kept it in the home. But it was their decision to sell their property, and it was their decision to do all of this. And so their exemption is lifted the moment the property is ownership transfers. So you need to make sure that the title company is not feeling sorry for the VA person and not giving the full credit, thereby leaving your client, who you have a fiduciary duty to represent, and make sure that they're getting every single penny due to them in the tax prorations and the taxes to make sure that they have received a credit sufficient enough to pay the property taxes when the bill becomes due. Does that make sense to everyone? Okay. Okay. Now, at closing, it's every realtor, and they're using the word realtor here because we are a realtor class, but Texas realtor responsibilities. I'd like 3 volunteers to read. Candy, I think I said you were next. So you're going to go first. And then Tina, you go second. And Gavin, you go third. So read, each of you read 5. So Candy for first 5, Tina the second 5, Gavin the last 5.
Okay. Responsibilities. Allow the closing officer to orchestrate the process. Help create an atmosphere of calm and ease among the parties. Be respectful to all present. Check the figures one final time, even if it was already done before closing. Make
Thanks,
sure
Cindy.
all all contractually agreed upon items have made their way to the closing disclosure if applicable, e.g. residential service contract, credit for the option fee, repair invoices to be paid at closing, etc.
Thank you. Excellent. Tina?
Make sure that any additional items from the contract amendment are complied with by closings or at closing, e.g. repair allowances, increases in sales prices, etc. 7, make sure you have any items you were charged to bring to closing, repairs, invoices, garage door openers, lockbox key, wood destroying insect report. 8, bring the transaction file in case any documentation is needed during the closing. 9, verify the buyer has brought certified funds. 10, help the parties work through any unfinished negotiations as a result of circumstances that have arisen since the contract and amendment were signed.
Excellent. Thank you. Gavin?
11, obtain a signed copy of the closing disclosure for the office file. 12, collect any commission dispersed directly to you and/or carry back any disbursement to the broker if the checks are cut at closing. 13, make arrangements for the delivery of funds if not dispersed at closing. 14, collect future contact information from your principal, such as new address and new phone number. 15, after closing, congratulate your principal and ask for referrals if they were satisfied with your performance.
Thank you. So obviously we want to attend closing and we want to be there with them, be in communication with the lender, explain to them when they're going to receive keys. If they are a buyer, which the assumption here that they are, that you're going to talk to them about filing their homestead, they can do that immediately. And so helping them with that paperwork, explaining to them how they're going to get keys, explaining to them how they're going to get their mailbox keys, explaining how they're going to get their pool key, and really more importantly, that they're going to come to the closing table and they're going to sign. The lender is going to then take the documents and send it back to back to the lender and email it to them, asking for them to verify signatures. And there's going to be a gap between the time they've signed, and when they get keys, because also the seller has to sign. And maybe the seller is going to sign before or after the buyer, but we should know that going in, if whether or not our appointment is before or after. If we're coming in at 9 o'clock and signing, and the seller is coming in at 3 o'clock for signing, then we know that there is a very good possibility that we're not going to fund that day and that we're going to fund the following day. And it's very important that the buyer fund that day because they have a moving truck standing out front. They don't get keys until they fund. So then maybe it's a call to the seller. Hey, is there any possibility of you coming in earlier, even the day before, to sign, because we want to make sure that we fund this day so the buyer can have access and be able to make sure that that happens. Typically, the rule of thumb is if all the parties have signed by noon, you'll get keys that day. But if the parties start signing it after noon, after 12 o'clock, then the likelihood of you funding that day starts becoming in jeopardy. And even if people sign at 8:30 in the morning, they still could have issues that cause a funding delay. And so it's never a guarantee, but we're going to try to set up a program that's going to be successful as much as possible. And RESPA rules, the Real Estate Settlement and Procedures Act, and the real estate fraud. There is a lot of fraud going on right now, and it's our job to make sure that we are safeguarding our sellers and our buyers as much as possible. When it comes to fraud, we've seen a lot of different fraud going on right now, both with uh, fake people, real people pretending to be people that they're not, seller impersonation, especially on land transactions, where they will call an agent and say, I would like to list my property. I've got 100 acres and I'd like you to list it for me. The only communication you have with this person is over the phone. They send over information and IDs that are fake but look kind of real. And there's even been transactions that have made it all the way to the closing table and funded. We have not, but we did get a transaction where the actual transaction was fully signed by all parties before we realized it was fraud. And in fact, it was the title company that realized that it was fraud, not our agents. And so we have that going on. We also have people breaking into title companies' computers and monitoring their sent items, and they have pulled out a copy of the wire transfer form, modified the wiring instructions, the wiring information, putting their own account numbers in the wiring form, and then emailing it from the title company's computer. So it came from them with a form that looked like their form. It was exactly the only thing that was different was the routing number and the account number. And buyers wire their entire down payment to a place where likely they'll never receive it back. We've had that happen twice where we've had buyers wire the money to the wrong place. And in both instances, we were able to get the money back. One of the two instances, we got 90% of the money back, maybe 85% of the money back. They weren't able to retrieve it all back, but they were able to get most of it back. So we have an email address for the federal government financial crimes unit. They're very responsive. They immediately send an email back, and then they get us in front of the case officer, and then we get assigned, and we let them know what happened, and then they immediately take action. I was actually impressed in both situations of how reactive they were. So we've at least we have help, right? And then the other one is people emailing the seller and trying to get the seller to send the wrong wiring instructions or pretending to be the seller and monitoring the entire transaction and then send the title company an email pretending to be the seller saying, here's my wiring instructions, so that the proceeds get wired out to a third party that's not them. So we have E&O insurance. Part of the reason why that we are have our cyber crime, our cyber insurance policy, which is difficult to continue having, is that we have email domain that we use across the board. Not all firms can qualify for it because they don't all use the same email address. You probably noticed this week that Gmail was breached again. All of their emails were breached, all of their accounts across the board. Microsoft has not been. Office 365 with multi-factor authentication, they simply cannot get into our accounts. We've had 2 accounts breached, and both of those accounts were agents who are not active and didn't really have anything in their accounts of substance. So we've been very, very lucky. But we pay very close attention to our accounts. And typically what happens is if someone gets access to our account, the very first thing they do is put in a forward. So all emails that go to that account get forwarded to another account. And I have a trigger organizationally that an agent puts in a trigger, it sends it to the manager inbox, and the manager immediately looks into it and calls the agent. Did you just put a forward in on your inbox? Well, no. Then we know it's immediately someone who's gained access to their inbox. We change their password, put it on security hold, go and see what's in the inbox and what's in the sent items box to see what type of liabilities, what kind of data they might have access to, applications, that stuff, and then let our insurance company know that we've had a breach of those 2 accounts and what documents they have. And so then they can do an audit, but they want us to tell us what's there, and if there's anything of substance, then they will do a forensic audit. If not, then they will just let us know, and it'll be there on our insurance policy as a possible claim coming later. And if we know about it and we don't tell them, and a claim happens and our insurance renews and we told them no, then we don't have coverage for that item. So we have to be very upfront every event that happens to make sure that we have coverage in the event a cataclysmic thing happens and we lose client money, and that we have to then refund that client money through our insurance policy. So it is exactly 4:30, and we did very well today. We got done right on time. I know it's a lot of information. Do not expect that to change for this GRI. I think the expectation of contracts to closing and day one being financed, that it's going to be kind of a heavy day, and we're going through just a lot of technical stuff. But like all these classes, it's a fire hose of information. You all did very good. I will see you back tomorrow again at 9 o'clock. It's Monday, Tuesday, Thursday, Friday. We'll have Wednesday off this week. And so tomorrow we're going to pick it up again at 9 a.m. I'll stick around for a little while for questions if you guys have any for me.
Thank you.
Thank you, Jack.
Thank you, everyone. Good job.
Thank you so much.
Jack, I do have a question.
Good. Meg, hi.
I just listed with on CTX MLS for my new listing this week, and I'm curious to know if I should go ahead and do like the flex listing in ABOR or just put it all in there and hit go live on Friday.
You know, it really doesn't matter. The flex listing is just going to let all the other agents know it's there. If you put it in there in flex, all it's going to do is you're going to have people yelling at you because they want to see the property and you don't want to let them in. So, I mean, you're just going to, you're probably going to cause yourself grief. The buyers are looking on Zillow and Realtor.com. They're going to come across the property. They're going to see it and they're going to see it that's open house and they're just going to schedule a time to come see it. But the flex listing, they don't let you put an open house in there. So it just makes you deal with all of these extra phone calls. So personally, right now, I don't see the value in it, but some agents do. So that's my opinion.
Good to know.
I think that the flex is just kind of a go around because of the coming soon or
Yeah.
clear cooperation, whatever. So there's
Yeah.
just, okay. Yeah, I haven't used it either.
It is a coming soon that does not syndicate.